except that it's my own inner voice saying those things. That's the problem. You're gonna choke. You suck. Thanks, Dom.
You got it, guys.
Squawk Bus. We'll be right back.
Check out shares of AMC Entertainment tumbling after the company announced a new offering of $200 million of common stock. Right now, AMC shares are off by more than 20%. When we come back, filling the void left by Spirit Airlines, the House about to hold a hearing on competition in the skies. But our Phil LeBeau did some digging into whether the bankruptcy really hurt options for travelers, and he will join us with the results of that right after this.
La-ti-da. I'll go enjoy today's resistance, 739.74 to break. Double bottom. Get back up here. Boom. $739.27 is the alert. Resistance 739.74. I felt her coming. Woo! Hey, everybody, Jim's sneezing again. And I'll be back. Let's have a good day. I got to get paper towels today, so that's definitely number one priority this morning when I get back. Becky Click. Becky Quick. I love you.
Lawmakers raising concerns about airline competition following the demise of Spirit Airlines. Phil LeBeau joins us right now. He's got a check on options for air travelers, and this is something a lot of people have been trying to figure out, Phil.
Becky, you hear a lot of people say, well, when Spirit went away, it killed competition because there is not as many options for you if you're flying, let's say, out of Fort Lauderdale or Orlando, Vegas, or Detroit. Those are the four biggest hubs, if you will, for Spirit Airlines. Well, we asked the folks at Cirium to crunch the data for us. Remember, Spirit only had about 1% of the market when it finally stopped flying at the beginning of May. And when Cirium looked at the data, yeah, there was an impact in those cities, but they still had plenty of options remaining. In fact, this is the total number of flights, the number of seats, that how much it went down in these cities. Substantial to a certain extent in Vegas and Fort Lauderdale, but we'll point out how that void is being filled by other airlines in just a little bit. Spirit, again, it stopped flying on May 2nd, and almost immediately you heard people saying, well, look, there's no low-cost option if I'm flying, let's say, Detroit to Chicago. That's not entirely true. You can buy a base fare on American or on United. Believe me, I know people who fly to Detroit, and I've been on a lot of flights to Detroit. You can have other options. You don't have to pay top dollar in order to do that flight. That said, the question is who fills the void, and Fort Lauderdale is a good example. JetBlue is stepping into the void that Fort Lauderdale had when Spirit went away, because Spirit was the largest airline. Well, that's not going to be the case anymore. JetBlue will be the largest airline, replacing Spirit. It's going to be adding 11 new cities from Fort Lauderdale. It'll increase the number of flights out of there by 75%. This is a case where the market is saying, okay, there's a void, who can fill it? And JetBlue has been aggressive with Fort Lauderdale for some time. They believe that this could be a real opportunity for them. As you take a look at shares of JetBlue, I know there's more than a few people who will sit there and say, well, yeah, JetBlue used to be low cost at one point, but it's not low cost now. The reality is you're looking at seat availability more than anything else. And also, as you take a look at the airline index, things have really changed, guys, since middle of May. Airline stocks are up, 18 to 22%, depending on the airline, and things have dramatically improved. In fact, we just saw the first estimates come out for the Q2 results. Far more optimistic than was expected just a couple of months ago. But that's the bottom line when it comes to Spirit.
Yeah, Phil, I'd love to take a look at that index we just put up and put it over oil prices, because it's probably the counter of what oil prices have done over that period of time.
100% oil. 100% oil.
And the idea for consumers, I guess, oh, there it is. Yeah.
There it is.
Mm-hmm. Yeah,
Right.
inverse of it.
The inverse of it, right. Pretty much watching what's happened with airline prices, with ticket prices. What's the expectation? It takes longer for ticket prices to come down, because obviously those declines in price have to move through the system too to get to the refined product.
Yeah, we talked about this some yesterday, Becky. I wouldn't expect them to come down. There is no expectation within the industry that you are going to see the airlines, now that jet fuel prices have dropped, that the airlines will say, okay, well, ticket fares are up about 20% compared to last year, roughly speaking. Let's drop it back because jet fuel has gone down. That's just not the way it works. You have two things that drive fares. One is demand, and demand remains relatively strong. Two, supply, and capacity has been limited by the industry this summer, up maybe 1.5%. So you don't have an oversupply of seats, and you still have a strong demand market out there, at least domestically. There's no reason to lower the fares. Their airlines won't be doing that. So if you're sitting around saying, well, jet fuel has come down, therefore we're going to see lower prices by the fall, it's possible, but I wouldn't expect it.
The airlines have not expanded the number of seats that are out there. Is that because you can't?
Correct.
In some cases? You can't do it just because the airports in major cities can't accommodate anymore?
No, mainly they're not. Becky, the main reason, Becky, they're not doing it is because it's good business. It's smart business. Now, look, there are some unique examples in there where they haven't been able to add as many flights as they originally planned. Chicago O'Hare is a good example. Both American and United wanted to add a lot more seats.
Right.
FAA came in and said, no, we're doing slot control there. Newark is slot controlled, LaGuardia as well. Look, the auction of Spirit gates at LaGuardia, that's the story to watch within the airline industry over the next year, because LaGuardia is highly valuable. You want to be in New York, and there are some in Washington who are saying it should be a low-cost airline. Well, you tell me the low-cost airline that's going to move in there, and if they're going to pay the price.
And pay for the slots, right. Phil, thank you. Great to see you. We'll talk soon.
You bet. You too.
It is 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick along with Joe Kernan. Global stocks tumbling as a tech-led sell-off spreads from Wall Street to Asia and Europe. South Korea's Kospi plunging 10% overnight. It was hit by steep losses in both Samsung and SK Hynix. Europe's technology sector also sliding sharply. It was led lower by semiconductor stocks. And we're watching all of that. Of course, the South Korean Kospi is still up 94% year to date, even after those declines this morning. In the meantime, the United States has temporarily lifted major sanctions on Iranian oil, allowing dollar-based oil trade for the first time in more than 40 years. WTI is trading at $73.78. And Apollo Global is again limiting withdrawals from its $26 billion Apollo Debt Solutions Fund after redemption requests surged to nearly 17% of shares in the second quarter. That was up from 11% in the first quarter. The retail-focused private credit fund will cap withdrawals at just 5% of shares. Right now, if you check that out, it's down by about 2.8% for Apollo Global.
40 years since they got dollar, since they were able to sell oil in dollar. 40 years.
For Iran, yeah.
This is like a carrot, and it's like, who knows, wacko, theocracy, great Satan, death is, who knows with these people, but it's a nice world. The rest of the world at this point. It could be a good place for the Iranian people at some point if you join, come into the, 21st century at some point. Maybe this will do it. Wow. I mean, to be able to sell oil in dollars. There's a lot of other things that could flow. Maybe it's bad to allow it to flow to such a horrible regime that kills its own people, but
not if it's used for humanitarian use.
Carrot versus stick, right?
That's the question. What will the funds be used for?
Right, but carrot versus, For more on the markets, let's get to Mike Santoli at the New York Stock Exchange. Hey, Mike.
Hey, Joe. Yeah, this global turbulence that you're just talking about there, kind of washing through the main leadership sector of this market, that would be memory chips, has kind of solidified the idea that the S&P 500 might be in a bit of a trading range. For a couple of weeks, I've been pointing to this date, May 14th. Okay, that's right there. We first got above 7,500 on the S&P. That equates to 750 here on the S&P SPY ETF. We got to 75.17. It closed a little bit higher than that over the subsequent week, 7,600, but never really got escape velocity beyond that. What happened on May 14th? The Cerebras IPO, as well as Cisco going up 14% as the market really grabbed for any type of AI exposure, and then both of those kind of moderated and fizzled. Here's what's happened since that date, since May 14th. You've had semiconductors up almost 20% going into today. Mag 7 down 8%. Obviously, a big inverse relationship going on right there. I would look for a little bit of a bid in Mag 7 type stocks. I was looking Microsoft might bounce a little bit because they have been kind of being sold to buy that one little segment of tech, semis and chips, memory chips in particular, that have been driving things. One final thing on the macro picture, real yields are higher, and take a look at the US dollar index. It is broken out. This is a 1 year, but this 100 level had been pretty strong. So you see kind of financial conditions tightening around the edges. As I mentioned, real treasury yields as well as the dollar. The VIX is maybe up off the lows, hit 20 this morning. So just keep in mind, maybe this is sort of a general kind of digestion reset type phase for the overall markets, guys.
Yeah, that's pretty interesting. But yeah, the 7,500 could be the high end of a range, huh?
Just for the moment, we'll see. You know how we rotate around, and we've been escaping danger through this rotation, and you got to see if that trick can still work.
Right. Okay, thanks, Mike. I'll see you tomorrow. Okay.
Yes, I'll see you.
All right, when we come back, Senator Rand Paul on Iran, global oil prices, and much more. And then IBM Vice Chair Gary Cohn talks about AI, the economy, and the Fed. Squawk Box will be right back.
Well, the roadmap has been set for the U.S. and Iran peace treaty deal. Join us now to talk about the latest. Republican Senator of Kentucky, Rand Paul, and we did have in there, Senator, and much more. And there will be much more. I wish we had a lot more time because we are going to talk about Fauci. I can guarantee you that because we've had a running discussion, the two of us. And I was just looking back at some of my records when it was patently clear exactly what had happened. It's at least 2 years. But now more data and more data points are coming out now to confirm it. But we'll get to that in a second. Iran is front of mind, obviously, for everyone. You, unlike a lot of your colleagues, think this is just what the president should be doing at this point so that we don't get into some multi-year situation like we have in the past in the Middle East.
You know, I think peace is typically preferable to war. I think that the president deserve some space to try to negotiate a peace agreement. I think there's a certain degree of irony that most of his critics, the War Caucus in my party, are for unlimited presidential power to start wars, to initiate wars. They don't think Congress should have any say, but they want to circumscribe the president's power to end a war. I think actually most wars end because as commander-in-chief, the fighting ends by order of the commander-in-chief. So I think a ceasefire and the initial part of an agreement really are all within the bailiwick of the president, and we should be wishing him speed and success. When people say, oh no, we're going to remove sanctions, they need to realize sanctions are of absolutely no value until you trade them. When we put sanctions on China or Russia, they don't change their behavior. When we put sanctions on Iran, they have not changed their behavior. In exchange for removing sanctions, we may be able to get something significant. If we can get removal of the highly enriched uranium, the 440 kilograms of uranium, I think that's a trade worth having.
You may not have been necessarily a fan of starting the whole process, but at this point, the pragmatic way, and you know, there are affordability questions, and no one wants $95 oil. We're back to 73 today. So you think that diplomacy has been the way to go, and you know, Israel and I'm sure others want to finish the job. I'm not sure what that means exactly, a sort of regime change, but you're ready to say let's take the deal that's on the table right now, or the best one we can take.
Well, I think it needs to be refined, but the initial trade, the majority of the initial trade is we stop our blockade, they stop theirs. We won't blockade your ships, you don't mine your harbor. And so opening up the Strait of Hormuz kind of gets us back to the very beginning. Isn't necessarily a huge advantage, but it is an advantage over having the strait blocked. I think the next step is really to concentrate on things that we can verify. People keep talking about, you know, of course, Reagan's statement, trust but verify. But one thing you don't have to wait around to verify is the enriched uranium. If they have an agreement to have it removed from the country, and I think we are at a position in negotiation that is stronger than it's ever been, I think if they negotiate that for release of sanctions, that's good. But you have to realize there are people in my caucus who don't want peace, who will never make any agreement, and they say, oh, the regime is not trustworthy. Well, that kind of attitude could last another 47 years. And so I think you do have to be pragmatic in it. And really, you're not getting rid of the enriched uranium without an agreement. You have to be open to an agreement. And this is precisely why you have diplomacy with people you don't like, with people you don't trust. That's the art of diplomacy.
Senator, when did you, let's switch to Fauci, because I can remember seeing emails that were out. It had to be 4 years, 3 or 4 years ago, where he was trying to convince other scientists to go with the story. We can get by with the natural origin story. It certainly looks unlikely. And they switched their position on what was staring them right in the face. It was like a walking, quacking duck, more or less, that it came from this lab. He convinced them because he knew he had funded gain of function research. And he told you was that under oath, under testimony, that had never happened?
Absolutely, and that's a felony to lie to Congress. And we've gotten more evidence over the last year. From the Biden administration, they revealed nothing. From the Trump administration, particularly with Secretary Kennedy, we've gotten a lot of information. That information has revealed that not only did he lie to Congress, he knew that he was lying to Congress. He knew he was making several continuous and contiguous lies to begin with, but he also, from the very beginning, was destroying records, sending letters and notes to Francis Collins, the head of NIH, saying, read this and destroy this. That sounds more like the CIA talking to each other, but not the executive branch. That's against the law and also a felony. So we've been negotiating with him for material and for testimony. This has gone on for some time. He slow walked us, finally agreed to come in voluntarily. That would have been this month, and then this week, or last week perhaps, rather, he says he's not coming in. And so we've issued a subpoena. I was able to get subpoena power for our committee last year, and so with the subpoena power, we will bring him in, unless he decides to fight it in court. So we'll see what happens, but I think he does need to come in and testify. Look, 15 million people died worldwide, and it was from dangerous research that he funded. What a judgment error. Probably no judgment error equal to this in modern medical history.
And it became clear early on, wow, if people connect the dots between what's been going on and what happened, that would have been very bad for him. And it is bad. Now he's pardoned, and he's got pardon going forward, pardon going backwards. I don't know whether those stand up, but 2 years ago, David Sachs, I'm sure you know him, he said this explains exactly how he orchestrated the pandemic, or at least knew about gain-of-function research, and then changed the story. And I tweeted at the time, can someone explain to me why Dems line up to defend this guy? Can you explain why Democrats have lined up to defend Fauci when it was clear as the nose on your face what had happened?
I think he represents Big Brother in public health. The Big Brother that tells you what to do, doesn't give you advice, but commands you and tells you what to do. And the left really is fine with an authoritarian approach to medicine. But to give you a degree of how much this dishonesty was, he knew in January that there were cases that did not come from the market, the wet market with the exotic animals. He already knew that, and it was admitting it privately. But then for the next year or two, he kept saying, oh, look at this paper. It looks like it came from the market. All of our evidence points towards the market. But privately, he was saying to others in January 2020 that they already knew that the original cases came not from the market, but from somewhere else.
Wasn't patient zero was in the lab, wasn't he?
Yeah, we think that patient zero, there were 3 people sick in Dr. Xi's lab in November of 2019. We think by the time you get to December, there are thousands of people sick, and it's raging through the community. The rumor mills were out there. The doctors were talking about it. By the time you hit January, we're probably talking of tens of thousands of people, and everybody knew it was going human to human at that point, and the Chinese government was suppressing this. They felt their own guilt, but then Fauci felt his guilt because he'd been an adamant and enthusiastic supporter of gain of function. You remember he wrote in the Washington Post in 2011 that yes, there's some danger, but the danger is worth it. Even if a pandemic should occur from this type of research, the danger is worth it. I don't think the danger was worth it. There's been no great discoveries from gain of function, and he should be vilified throughout history and throughout all time for this unreasonable risk he took with all of our lives.
I mean, I could almost defend that because, research, you do it in a P3 or a P4 setting, and it's dangerous. There are things like that. But then to know full well what happened, and then to sort of connect the dots, wow, I could be, someone could point a finger at me for this, and then to completely mislead really the world for a couple of years on the likelihood of where it came from. What about the pardons? Will there be any effort to look at the legality of those for him?
Yes, the pardon will be examined as well. There will be questions about, did he seek the pardon? What specific crimes did he seek? Did he ever meet with President Biden? Is he aware that President Biden is aware of the specific crimes that were intended to be pardoned? But there are also questions about, can you have a pardon to a non-specific crime? Can you have a vague pardon for anything over a period of time? But he also will be under oath. So he will have to tell the truth once again, or he'll be committing new crimes. So we'll see. I think it's going to be a challenge to get him. I think we will have to fight him in court. But the one thing about the January 6th committee that was a good precedent is the courts have upheld congressional subpoenas. So I think there's a very good chance the court will command him to come. He can't be made to testify. He could come and plead the Fifth Amendment. But I think he'll go down in history then as the one person who ever was head of public health who ended up pleading the Fifth Amendment, which is in itself damning.
All coming out. Anyway, you've been on this, and it must have been hard for you initially. I can only imagine mainstream media and everything else. And they're still sort of complicit, I think. But appreciate your time today, Senator, bringing to light these things.
Thank you.
Okay.
Still to come this morning, IBM Vice Chair Gary Cohn on the Fed, the economy, and much more. He joins us next. And later, the future of the FDA with former Commissioner Dr. Scott Gottlieb. Squawk Box will be right back. from Kevin Warsh's first Fed meeting as the chairman to the Iran deal impact on energy prices. We've got a lot to talk about. Joining us right now is IBM's vice chairman, Gary Cohn. He served as director of the National Economic Council in the first Trump administration. He also happens to be the vice chairman at IBM as well, and that's one of the things I want to talk to you about today, Gary. Watching what's happening with markets this morning, I think these are questions about AI and where we go from here. Why don't we start with that this morning?
Yeah, look, Becky, first, thanks for having me. But I think it's an interesting question, one of which we've talked about on this set before. We have this really unique phenomena going on where we're taking companies that historically have been IP heavy and asset light, meaning that they own something that generates enormous amount of cash flow, and they've used that cash flow to acquire other assets that generate cash flow, and they've used it to grow and create dividends for their shareholders. We now have those exact same companies that have worked for decades to become asset light, and they have chosen to become asset heavy.
Spending a lot
Asset
of
heavy
CapEx.
to the point where they're issuing new stock,
Yep.
they're issuing new debt, and they're no longer cash flowing companies.
Yep.
You know, we have to sit back and look at this and say, look, does this make sense to take companies that generate huge amounts of cash flow now that do not generate cash flow? And then we also have to evaluate how are we valuing those companies. We knew how to value them as growth cash flow generating companies. How do we value them as asset heavy companies that are now taking on debt, that have a higher debt service charge, that never had a debt service charge before, that will grow potentially in the future, but they're investing today for growth in the future? I think that may be a different valuation metric.
So they've gone from super high growth companies to not utilities, but something that maybe requires a different overall measure.
Well, we don't know if they become utilities. You know, the question is, does this whole AI infrastructure and the LLMs themselves become more of a utility infrastructure play? We don't know because it's evolving out over time here. We also don't know what the pricing is going to look like. What are LLMs going to be worth? What are you going to pay for an LLM? Is it a commodity? Is someone going to come in with a newer LLM and undercut pricing? Are you going to buy the software separate from the compute? Are people going to compete for compute? We see that now. We see the Chinese coming in and undercutting the price of compute pretty dramatically. So all of these questions have to be asked, and what's really important behind the scenes is if you strip out AI and energy from the stock market this year, we have a down market. Really the two impetuses that are driving market and market value is AI and energy, and they're both intertwined with each other.
Okay, there's a lot to dig through on that. Let's start with just where the huge declines are today. Most of them are chip stocks, not necessarily the Alphabets and the Metas, although we did see
Although
the stocks under pressure
may have been yesterday. That might have been
yesterday
yesterday's
we did
move.
see them moving with some of those things. Not 9% declines like we're seeing with some of these stocks today, but you did see, what was it, a 3.5%, 4% move lower for Alphabet and some of the others. Guys, if you can call up the Mag 7, let's take a look at Meta, let's take a look at Alphabet, let's take a look at some of these stocks that are, yeah, here we go, Apple, Microsoft, Meta, Tesla. So yesterday we saw some pullbacks from these, but not the same magnitude of some of these issues. What I did not realize is if we stripped out AI and stripped out energy, that the market would be down for the year.
Torsten Slok put out a piece on that last week, you know, very interesting to really break down what's driving the market. And look, we're always like this. You know, last year, every guest sat here and talked about the Mag 7, what the market would look like without the Mag 7.
Yeah.
You know, maybe the Mag 7's going away. We had FANG before that. We've had BRICS before that. We've had lots of different clarifications of what drives the market. Right now, it is AI energy trade. Without the AI energy trade, the market is sort of floundering.
What you do find, we had Philippe Belafont here earlier today, and what you do find is that people are trying to chase the money that those big spenders are putting out into the infrastructure, right? You got to go down to the next level or maybe 2 tiers down to figure out where that money is eventually going to flow. Those could be the plays for what comes next. But are you questioning the idea of AI spend overall? Because I think that would be the issue that could really be a major, you know, I don't know if you want to call it a hiccup or something much larger than that, if those companies decide that they're not going to continue to spend like they've been doing.
Look, I think those companies are going to continue to spend. Okay. I think they're in. They're committed. They want to be there. They want to be a dominant player. They want to have huge market share. The question is, and the big question to me is, are we building out more infrastructure than we could ever use? And so just because you want to be a dominant player, that doesn't mean that all dominant players make money. You know, we went back to the fiber optic days. All of the big three companies that laid all the fiber optic cable never got to monetize that cable. WorldCom, Enron, Global Crossing, they never got to monetize that infrastructure. The infrastructure was valuable. It was valuable to the next buyer that bought it at a deep discount. So I think we have to ask ourselves, in this period of time, everyone's trying to capture market share, everyone's trying to drive value, everyone's trying to be there, but what is there going to be? And on top of that, you know, while we were all looking at those stocks going down yesterday, the White House signed an executive order on quantum computing.
Yeah.
So the reality that quantum computing is around the corner and coming, we can't dismiss that. And that's going to need a whole different set of infrastructure. It will, yes, it will leverage upon the AI infrastructure, but the quantum infrastructure and quantum data centers are going to be different than the traditional data centers being built today.
I'm trying to put the comparison of WorldCom with one of the Mag 7 from today. It's
I didn't
kinda
mean to
hard
throw. I didn't mean to throw you there.
No, I mean that's hard to do. I understand, and if you look at like what happened with Cisco and how the valuations never came back to those levels, I get that. But is that kind of your suggestion of what we might be seeing?
My view on WorldCom and Enron and Global Crossing
Yeah.
is these were really important companies at the time.
Yeah.
They talked about fiber optic cable and connectivity and video over internet, voice over internet, how it was going to dramatically change the world we lived in. Guess what? They were completely right.
Yeah.
What they were doing was going to dramatically change the world we lived in. But the way investors were valuing those companies is they're saying, okay, you can go out and borrow as much money as you want today. You can go lay as much fiber optic cable as you can, and we're going to take the forward value of your contracts and discount them back and put a multiple on them. Unfortunately, the forward value of those contracts wasn't what they had put into their models or what they had projected. So you're building a data center today. You had someone on yesterday talking about a data center with a 20-year takeoff agreement for power. Right. What is the value of compute 20 years from now? Do we need as much as compute is being built? I happen to believe we will have overbuilt compute by that point in time, and compute will become a commodity, and companies will buy compute from the lowest cost provider, like every other commodity.
All right, that makes a lot of sense. It's interesting, and it's definitely, you know, some days the market thinks that, some days it thinks the opposite, and that's where you see the swings in the ebb and flow of the market.
But that makes sense to me that we're seeing the flows, because we're all trying to figure out where this goes, how we get there, who's going to play, who's going to get there first, how's it going to price. This is a natural evolution of a market developing before our eyes.
I won't ask you what you think of, you know, whether certain stocks are cheap, because that's not your job.
Yeah.
But let's look at sectors on some of these things, because that's the question. People will say a lot of these stocks are really cheap because the valuations are only 13 times forward earnings, 14 times, 20 times forward earnings.
Yeah, I heard Philippe this morning talking about NVIDIA and it being a cheap stock. But on the other hand, NVIDIA has more competition today than it had for some period of time. And then you've got this little bit of this circular discussion going on where NVIDIA's customers are also companies that they've invested in. And so they're putting a multi-billion-dollar investment in the company, and then they're turning around and buying chips back from these companies. I think the market is exactly trying to figure out what this all means and unwind that. Like, what would this company be buying without the NVIDIA investment? What are the chips worth? What are the substitute chips? Are they equally as valuable? Is the substitution equal, or is there a discount? And that's why the market is going through this sort of wild gyrations of trying to price these sectors.
You know, Gary, you talked about maybe we haven't broadened out enough in the market, but the economy and corporate earnings are solid. I've seen you credited with being one of the main architects of the big beautiful bill and the expensing and everything else. I think things if there wasn't a war, there wasn't a couple of other things, I think things are going pretty well in corporate America. I'm wondering whether you think that too. Do you take credit for some of this? Do you miss? Could you do more? You gonna go back?
Let me answer.
Answer them once.
Okay, Joe. I'm going to answer the first
You're
question.
proud of the big beautiful bill.
Well, I was not part of the big beautiful bill. I was part of the Tax Cuts and Jobs Act.
Okay, that's what
I was there for the original bill, which look was the premise for a lot of
previous
things in the big
administration.
beautiful bill.
When you were in the administration.
It was lowering the rates. It was broadening the base.
I misspoke.
It was changing the corporate tax rate. It was allowing for accelerated depreciation, amortization. It's all of the same principles that are in the new bill.
Right.
We created that basis. We created that
extended the tax
foundation.
cuts.
We also put in there, remember, the very important clause about deemed repatriation of foreign offshore earnings, where companies were holding all their money offshore and investing it offshore. We deemed it to be repatriated to the United States, so we were going to tax it anyways. So we watched companies bring back trillions of dollars of earnings to invest in the United States, which I do think is part of this whole data center boom. If companies still had trapped cash offshore, they wouldn't be able to do this.
Do people thank you anymore when they see you? They
So
don't. I'm doing it right now.
I appreciate you bringing it up.
But you remember that you might have something to do with all
Yeah, no, I think it was a seminal moment in my life, working that year to get tax reform done in the United States, changing some of the really inefficient things that we were doing, that were chasing business offshore.
Did the president ask you to come back?
If the president wants to have a conversation with me about coming back, he knows my phone number. I guarantee you he knows my phone number. But let's go to the company side. Companies are doing well. Companies are flourishing right now. You know, contrary to what everyone wants to talk about, well, I'll throw back to AI again, this massive job loss in AI, it hasn't shown up yet.
Yeah.
In fact, if you look at the JOLTS data, which is the jobs opening, jobs lost, quits data, we created another 700,000 jobs last month. Now, they may not be the same jobs we've been creating for the last decade, but we're creating jobs. In fact, the construction jobs today are abundant. We cannot get people in the construction industry.
Data centers.
Yeah, construction data center, all these. But by the way, Becky, those jobs are paying multiple hundreds of thousands of dollars for people who did not have to go get a 4-year degree and spend that money. If you did a present value calculation on someone going to a 4-year college versus someone going to a trade school, it's a pretty interesting calculation
if you
today.
think the jobs, I mean, if you think that this is going to end with us having built too much in the data center, those jobs go away.
Well, the job to build the data center is a finite period of job, that construction job. The amount of money that's been laid out today or has been budgeted for data centers is going to keep us busy for the next 3 to 5 years easily on data centers. Once we get the data centers built, I do believe there will be changes in the economy, but overall, the history would tell you that we will create productivity, and productivity is the mainstay of growing an economy. So the economy will get bigger, we will need more people, we will need people in different areas and different sectors. That's the history of this country, and evolving itself through technology and creating a bigger economy and more demand for jobs.
So when people think, was it worth it that I'm thanking, or have you lost family members and friends from being in the bad orange man's administration?
You know, Joe, I made a very conscientious decision when the president called me to ask me to serve. That I was going to serve my country.
From New York. And
I'm actually from Cleveland, but now I live on the Atlantic coast.
You do.
I live in the Atlantic seaboard.
There was some downside to being in that.
Of course there was downside to being in there, but there's also upside to doing the right thing for your country. And going in and being a major catalyst or a major driver of the tax reform to me
You're preaching the choir.
was really important.
I have the same issues.
I could take you through when I was at Goldman Sachs, going to companies and pitching them inversions to lower their tax rate, to leave the United States, re-domicile in Ireland.
No.
I did not want to be in the business of pitching inversions. I wanted to be in the business of pitching the United States as the best place to have your company.
Thank you.
Thank you.
You're welcome. Oh, yeah, you're welcome.
Thank you.
Yeah, that's what I said.
I appreciate it.
Okay, because I feel the same way sometimes, and I'm not sure it's worth it.
It's worth it. It's definitely worth it. If we don't get the right people to serve, it's shame on us.
Right.
You know, part of me almost feels like every CEO should be forced to take a 1 or 2 year sabbatical and go serve in the federal government.
Okay. Once again, thank you. Gary Cook.
My pleasure. Thanks for having me.
You're welcome. Up next, the FDA announced a program to improve clinical trial efficiency. Former FDA Commissioner Dr. Scott Gottlieb is going to join us to talk about the program and the search for a new FDA commissioner. We'll be right back.
All right, some news yesterday. The FDA has announced a pilot program to accelerate the early stages of clinical trials. And joining us right now to talk about the bigger importance of all of this is former FDA Commissioner Dr. Scott Gottlieb. He is a CNBC contributor. He also serves on the boards of Illumina, Pfizer, and United Health. And Dr. Gottlieb, let's just talk about why this is important, particularly with the relationship with China and how we're competing there.
Yeah, so what they did with these policies yesterday, so it's an aggregation of a number of different policies and different initiatives that they announced yesterday, and the goal is to try to make it easier to get clinical trials started here in the United States. So one of the big bottlenecks has been going into phase 1 trials, getting an investigational new drug application opened with FDA to get permission to start a phase 1 trial here in the United States to get proof of concept, to figure out whether or not a drug is hitting its intended target and suggests that it could have activity that could portend a therapeutic benefit. Because it's so hard to get those trials open here in the United States, a lot of biotech companies and pharmaceutical companies for that matter, but it's more the biotech industry, is moving their trials, their proof of concept trials overseas, particularly to China and Australia, because it's much easier to get these trials open there. So you can go there, get 10 or 15 patients enrolled in a clinical trial, figure out if a drug's working. If you get an indication of activity, then you raise more capital and go back to the United States to do the phase 2 and the phase 3 studies. So we're losing the phase 1 studies, particularly to China and Australia. What this policy does, and it's really an accumulation and aggregation of different policies, small reforms, but I think in totality are going to have a meaningful benefit if they get enacted. What it does is try to level the playing field to make it more efficient to get those trials open here in the United States. And so I think it's a very thoughtful policy. I think it was well constructed, and kudos to the FDA leadership team, the new FDA leadership team, for getting this out.
I think the bigger issue is what's happening at the FDA overall. You mentioned the new leadership team. That is an interim leadership at this point. But you've got an article that was just out last week that says, make the FDA great again. What needs to happen for that, and how are they doing along those lines?
Well, the thrust of that article in the Journal of the American Medical Association was about having strong career leadership running the different medical product centers, the Center for Drugs, the Center for Biologics, the Center for Devices. That's certainly the configuration that the FDA has been run under for going back 30 years, and certainly the 25 years that I've been involved in the agency, and also under my leadership. I inherited a very strong leadership team from Rob Califf, the previous commissioner, and left them in place. They were a very good leadership team running those different centers. I think it's important to have political leadership over the organization, but it's important to have strong career leadership running those centers. That was not how the agency was being operated under the previous commissioner, Marty McCary. He put in political hires into those positions, people who, in my view, didn't really understand those jobs, and I think we saw the consequences of that. The current commissioner, Kyle Diamantis, has gone back to the old configuration, letting strong scientists run those different centers, and I think you're seeing the impact of that. Things have been much more efficient. They've been able to get out sound policy. You haven't heard a lot of controversies around individual drug reviews. They're going back and reevaluating some of the decisions that were made under the old leadership team to make sure a good process was followed. And we've seen some recent headlines where some of those decisions are getting not just reversed, but re-examined. I think what they're doing is going back and looking as to whether or not good process was followed in cases where they weren't. And there was one case in particular where the new head of the drug center put out a very long memo detailing how good process wasn't followed in the evaluation of a diabetes drug by Sanofi. They're going back and re-adjudicating those decisions. And so you're seeing the agency, I think, get back to the footing that it's been on for the last really 30 years, which has operated pretty efficiently. And, you know, Kyle also has been able to move out a lot of these policies that have been in the works for a while, particularly the policy we're talking about here today. And so I just think it shows that the agency works better when you have scientists leading these things and good, thoughtful, strong political leadership trying to push them forward.
Scott, I think part of the JAMA article, you mentioned that both Democratic administrations and Republican administrations in the past have tried to make this move of putting political appointees in, and it always backfires. Even if they think they're going to be able to be more effective and efficient, the industry watches this very closely, as do investors, to try and figure out how to best prepare for what is coming from the FDA. What's been the experience that you've seen?
Well, look, I think we haven't seen an effort to try to get so many political leaders into these scientific positions as we did in the last, year. I think that's been corrected now. But over the past year, when Marty was there, he put in place people who didn't really know these jobs. They were people that, had a certain policy orientation. They had cut their teeth being contrarians during the COVID pandemic. and they were recruited into the agency, into senior advisor roles, and then elevated to run these different centers. And I think we saw the consequences of that. These are very difficult jobs inside the agency. There's a very steep learning curve. People who are put in the center leadership positions typically are people who are recruited from within the agency, because the work there is so particular. It takes a very long time to learn, the throes of how to operate inside the FDA. To give you an example, if we recruit a new medical reviewer who's very junior, who's never reviewed a drug application before, it'll be 3 to 5 years before they're handling a new drug application on their own. When they initially get there, they'll be handling IND applications and early stage files, and they'll be assisting on larger files, because there's a very steep learning curve inside the agency. At least a couple of years, often several years, sometimes as much as 5 years before you're handling complicated reviews. So it's very hard to go outside the agency and recruit people and put them in senior leadership positions over the scientific centers. And I will say, as someone who ran that agency, having very strong career leadership who are experienced, who are respected inside those centers, actually helps you get more policy done, not less. I think that there is a sort of knee-jerk view that what you want to have is political people that you can exert some control over and are like-minded, and that's going to allow you to get more policy out of the agency, and it's going to allow you to control decision-making within the science centers. Not that that's something that commissioners should be doing anyway, but I think there's a view that it would facilitate that, and that's the exact opposite. What you really want is strong, experienced scientists in those centers that you have a good rapport with, that you can work with, that can get things done.
Okay. Dr. Gottlieb, thank you.
Thanks a lot.
Up next, retail investors buying SpaceX in record numbers. Robinhood's chief brokerage officer joins us to talk about the IPO window and what clients are saying. Squawk Box will be right back.
Well, it's been over a week now since SpaceX's IPO. Joining us, Steve Quirk, Chief Brokerage Officer at Robinhood. And how many clients customers did you have that wanted SpaceX, and how many got some SpaceX at this point, Steve?
Good morning, Becky. Good morning, Joe. Yeah, we had over 850,000 people that expressed an interest in getting shares of SpaceX. Now that's both through our individual retail customers, and we also have an RIA network. which was able to request shares as well. So every single person who requested it got at least a share, and for those who requested more, some got many more than that. So it was just a record-breaking event. Both from an IPO standpoint, we've done about 50 IPOs. We have a product called IPO Access where we provide access to IPOs, but we've never seen one with this kind of interest and this kind of excitement around it. And it was just, it was amazing. It really went off pretty well, and I realized we're seeing, that stock sell off a bit, but I think everybody who participated was quite happy.
Yeah, I've never seen it where retail actually gets filled. Not complete. What was about 20%? If you try to get 1,000 shares, would you get 200 shares? Is that how it worked?
It depends. It all depends on what you requested. We had such a large number of people. We do it very democratically. We want to make sure everybody gets something. And then, we have a algorithm that sort of figures out exactly what that allocation looks like in addition to that.
The lockup, there's a staggered expiration of the lockup period. What do you expect to see there? How will that affect Robinhood at all and your customers?
Here's the thing with our retail customers. They're quite young, and they're pretty passionate about what they invest in and what they hold in their portfolio. We tend to we look at people that participate in the IPOs, and they're holders. They're believers in these companies, and that's a reason that they're wanting to participate and even purchase in the aftermarket. And so, generally speaking, they tend to hold these names, and they're believers in the companies and very passionate about it. And I think that's one of the reasons why you're seeing more and more companies want to reward more of their allocation in an IPO to retail, because I think that's something that that they want to encourage. To have stable shareholders who are very passionate about the company and users or believers in their products.
Do you think that the pressure's on now to these other really exciting companies that are coming public, like Anthropic or OpenAI or even Kalshi, or is it going to be similar? Will there be retail participation? Are you counting on it?
I think we'll see continued. Look, the participation or the interest in IPOs has been very strong. There's been a lot talked about and discussed about the gains that a lot of these companies are seeing pre-IPO. So we're trying to deliver as much as we can in the way of capabilities to give them access to these companies as early as possible. And there's been strong appetite. So I anticipate that we'll continue to see that appetite for these next round of IPOs, and they're going to be exciting as well.
And you've seen some record trading volumes, right? And I guess that makes sense given what we've seen overall.
Yeah, we have. In the first half of the month of June, we've seen the strongest months we've ever seen in equities and option trading. Across the board, things are very, very strong. Our customers, and I watched your earlier segment where you kind of talked about customers sort of looking through some of the geopolitical events and saying, where's the world going to be, in 10 years, in 20 years, which is, the duration of many of our customers. And I think they just have a confidence, that that a lot of the things that are happening, both for technology and just the markets in general, bode quite well for the future.
Steve, thanks. We appreciate it. You're Steve Quirk. Becky Quirk.
Yes,
Thank
Quirk,
you.
not quick.
What's this? JP Morgan's new price target for IBM. That's coming out. Spark Box, we'll be right back.
Breaking on Squawk Box this morning, successful tech investor Philippe Lafont, who admits to making a mistake in selling NVIDIA, says that the stock is cheap even at $200 a share. He's also a holder of SpaceX and says that he has no plans to sell, although he did say he was going to evaluate that pretty closely to try and figure out whether he wanted to hold all of the shares that he got with this latest AI deal that the company cut. JP Morgan upgrading IBM to overweight. The firm's new price target is $291. The shares are up 4% in the pre-market, but 25% from the high that was hit just 3 weeks ago. And AMC Entertainment announcing that it will offer an additional $200 million of common stock. That stock is down about 24% in early trading.
The operative term is they're able to sell equity, though, which is Adam Aaron. It's alive and well, that company. There was a lot of questions for a while about the whole business model.
From COVID on through.
Yeah.
What would happen to that?
Be able to sell equity, that's a good thing, even though it's not great for.
Unless you're an existing shareholder and you're getting diluted.
But it was 90 cents, and it's now up in $2.
$2 and change, yeah. All right, take a look very quickly. NASDAQ down by 850 points right now. We will be back here tomorrow. Make sure you follow all of this with Squawk of the Street, which begins right now.
Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen at Post 9 at the New York Stock Exchange. Kramer's off today. Global markets on the lookout for signs of AI exhaustion as the Kospi falls 10% overnight in South Korea, biggest drop in 3 months. SpaceX dips below its opening price from IPO day. Oil below 74. The president says 19 million barrels crossed the strait yesterday. Goldman does cut its Q4 Brent forecast to 80. Our roadmap begins with this intensifying tech rout. Chip stocks joining the pullback. Memory names tumbling as the global sell-off rages on.
Plus, always keeping an eye on private credit. This morning or late yesterday, Apollo curbed withdrawals in its main retail-focused private credit fund. That after exit requests hit about 17% of the assets.
And SpaceX set for its 4th down session in a row, wiping out more than $900 billion now in market value and trading around its IPO opening price of $150 a share.
Let's begin with this global sell-off. Talk about what happened in South Korea overnight, one of their biggest drops in several months. Names like SK Hynix and Samsung down about 12%. We've been talking about how torrid their gains have been so far this year, of course.
Right, when it goes the other way, it's very painful. And this at a time where I think it's important to mention that margin debt, basically borrowing to buy stocks, this month in South Korea hit a record high, 38.5 trillion won, which is about $25 billion. So you hit things like forced liquidations when stocks go the other way. It also comes just a day after SK Hynix overtook Samsung, its competitor in South Korea, as the most highly valued stock in the country. That is a title that Samsung has held basically since 2000. So it was this super crowded. There was also, a local report that people were reading into that SK Hynix, David, is adjusting the pace of production for its high bandwidth memory for chips, stepping up efforts in the DRAM instead, which is sort of maybe a profitability issue, but anything where investors can sort of glom onto a narrative that, maybe things are petering out or plateauing in demand. Maybe that's...
But it's not clear that we're seeing anything that truly is reflective of that, of undermining the overall growth of the AI ecosystem in the sense of spending being cut back. That is not... I don't know, Carl, you win? I haven't seen anything. Is there any real evidence you can cite?
I'm just thinking of Google yesterday, which was a big story as the AI race starts to, the narrative gets written. No, I think my point was yesterday we talked to Dan Niles, a good example, who said the current picture does look good, but if memory prices are rolling over, if the share of language models is beginning to shift, what does hyperscaler guidance look like? And we get earnings in a few weeks. That's what I think people are looking forward to.
Yeah, I mean, I think we will sit here, as we have already for years, and continue to question whether or not there will ever be a return on all the invested capital. And I think that's kind of what you're sort of getting to. And I understand the the losses we've seen in Alphabet shares over the last couple of days have been noticeable. Obviously, they've lost a couple of key executives. They have not come at the same pace with new models as their competitors at Anthropic or OpenAI. I think that's something investors are worried about. But I have yet to see, if there was truly somebody, one of the hyperscalers saying, you know what, we're cutting back on our CapEx next year, which is obviously not the case. In fact, you see Oracle's annual report. All they're talking about cutting back on is potentially the workforce to try to continue to create efficiencies that allow them to spend even more on a CapEx budget that is going to far exceed the $55 billion they spent last year.
Yeah.
And so we have seen days like this in the past, I guess is my point, where there does seem to be concern. You see the weakness in a key market or a key area. We are coming up on Micron earnings, which, by the way, the last time they reported, the stock went down, 6-7 days in a row.
Yeah.
But it's not clear to me that there's something that's truly undermining the overall thesis.
Yeah, I think part of this might be skittishness ahead of Micron and what they might say about CapEx. Morgan Stanley yesterday said, you might get some jitters if they do, say, up their CapEx again to 50 or whatever it might be.
Yeah.
But there are also new concerns, David. Yes, the demand is there and the CapEx is still growing strong, but there's a little bit more scrutiny, I think, on especially around the Mag 7, which has lagged now several days in a row. It isn't just kind of a one-off thing. Around the free cash flow, something we've talked about, right? The hyperscaler free cash flow and Mag 7 free cash flow.
Or the lack thereof.
Right, correct. Concerns there. CTO pushback around rising token prices. That's been a bit of a narrative story.
And the cheaper Chinese models,
and shift toward lower
which
models.
we continue to hear more about, and I think we'll continue to hear more about. Yeah, all of that.
And there's the political sort of Washington overhang. We have this primary in New York today.
All of it, but if you can tell me why suddenly today that is coming into play as opposed to last week when I could have discussed, I've been talking about negative free cash flow at these companies now for weeks, certainly since the Alphabet, the shocking Alphabet announcement of its decision to issue what ended up being $85 billion in both stock and converts. That's what's always interesting is why it's one day versus another. SpaceX also, certainly from a psychological standpoint, may have an impact. To the point you made, nobody who bought after the first trade is up, and that can't help, especially with a large retail audience there.
We're right up at that opening print of about 150. Elon yesterday lost to Warren Buffett in net worth.
Oh, he lost to Warren Buffett of net worth.
Yes.
Yeah.
And you're talking maybe $1 trillion off of market cap from the highs at this point. Yeah.
I mean, look how much was gained leading into it, right? And so much. Yes, David, there wasn't a clean driver, I don't think, for Google, unless you want to point to that executive departure, which, by the way, he was a Nobel Prize winner.
Yeah, no, it wasn't insignificant.
So
we talked about it yesterday. There was one last week as well. It's important. There's a huge talent war in AI. We know that.
But it's not a systemic thing.
It wouldn't seem to be. Again, I would come back to the fact that there are people who point to Alphabet, which at one point with Gemini seemed to be ahead, and now, again, the number of new models that come, although Anthropic right now still not able to actually release its Fable model, but the number of new models that come from its competitors seem to be at a faster pace.
What'd you make of Masa kind of throwing some cold water on the notion of orbital compute?
I did think that was interesting. That in his remarks, I guess at their annual meeting, Masa obviously, who runs SoftBank, saying, I'm not so sure about this whole idea of orbital data centers. And the point he's making is one we've heard is electricity costs are only 15-20% overall of data center costs, is what you'll typically hear. And so yes, you save on that, but how much is it going to cost to actually, still outfit these things with chips, get them into space, replace chips that go bad? Now, Elon has an answer for that. At least I've heard him in some podcasts sort of answer it, but it's still an outstanding question.
I think what we have to make of it is that Masa is spending billions and billions of dollars to build data centers on Earth, right, with Stargate, and I think that's important context there. He's also spending $65 billion to invest in OpenAI, and he has this all-in bet on, compute AI within, the land-based. He's not playing. I mean, he definitely gave a...
It's a nice young picture of him.
He gave props to Elon Musk for being an innovator, but that hasn't been where he's placed his bets.
No, without a doubt. And you'll get the same answer from Sam Altman, by the way, who demurred to a certain extent a few weeks back when I spoke to him and asked him that question, but has, I think, made it somewhat clear that he thinks it's many years. It's not, I don't know what Musk is saying, 2030s, early 2031, when this thing starts.
And
Many
then
believe
Bezos
it'll
has a few years after that.
be further out. Bezos obviously is a complete believer, but yeah, the timeline's a bit later.
What's interesting about today is bonds aren't really going crazy. We're going to get some PMIs. Weakness in the UK. I think they're a couple months now into contraction. Their PMIs at a 14-month low. But we'll watch certainly dollar yen, right? Where we get to 161.
Yeah, there's on alert for intervention when we get to these levels. We started to get some jawboning from the Japanese officials. They spoke to Bessent, the Treasury Secretary. So there's some speculation there. That's why I don't think you're seeing a lot of movement right now. But that Japan would step in basically to defend its currency from getting too weak. You never want to see these moves get so one-sided. It kind of distorts everything. But as far as the data has been in the U.S., I mean, the story has been rising yields, rising increases of Fed rate hikes as early as possibly September. At one point yesterday, it was priced in 40% for July. I'm not sure that, I know that we're not getting forward guidance, but not sure that Kevin Warsh set us up necessarily for a rate increase at the next meeting, but who knows?
Yeah.
We're in this new period of much more volatility.
Yeah, B of A today suggesting that maybe Powell and maybe some others on the committee, as a courtesy to Warsh in his first meeting, sort of held on to the hold notion, whereas otherwise in another meeting they might have went ahead with a full dissent or chose to hike.
Maybe. I mean, look, the data has come in okay. Certainly on the jobs front, there hasn't been any evidence, and it's come in hot on the inflation side, and that's the story. We'll get the PCE a little bit later this week. I'll be looking forward to hearing from and speaking with Kevin Warsh, the new Fed chairman, next week in Sintra at the big ECB meeting. He's going to be sitting alongside for the first time the heads of the European Central Bank and the Bank of England and the Bank of Canada on this really important policy panel. And people are, these guys are going in different directions on rates. The ECB just raised interest rates. Is the Fed next? We're gonna do our best to press the new Fed chairman who doesn't want to give forward guidance to give us some sort of clue about what he's going to do. That's going to be the challenge for me.
Was BOJ on the panel last year?
No, he wasn't. He has had schedule conflicts the last 2 years, but I know what you're thinking of.
Yes.
A few years ago, where he was hilarious.
He was hilarious.
Amazing. But I think he's actually been hospitalized lately, so hopefully he's okay. Wait on.
Okay, let's get back to sort of what we led the program with, of course, that sell-off in South Korea, the Kospi down as much as 10%. Let's get to Christina Partsenevelis for more on that.
Well, David, you guys talked about getting hammered, chips leading the way down. Specifically, the SOX and SMH ETFs are off about 6%. And if you're holding the levered SOX L, you're nursing roughly a 19% loss today alone. The trigger came overnight out of South Korea. The Kospi fell nearly 10%, its worst session in years, and volatility on this index is at its worst level in history. SK Hynix and Samsung memory makers, which make up roughly half the index, both dropped more than 12%. And part of this, Sarah mentioned it, profit-taking. SK Hynix had just overtaken Samsung as Korea's most valuable company just yesterday. And part of it also is a report that SK Hynix is slowing its next-generation high-bandwidth memory 4 chips to make more commoditized DRAM, that's dynamic memory, where shortages have actually pushed prices up. And so that's raising questions about whether AI memory demand is as bulletproof as the stock moves suggest. And there's also 2 more pressure points. MSCI, which is an index firm, is expected to keep South Korea in emerging markets. And that's a big deal because it's been there since 1992. So it's another letdown for a market that wanted developed status. And then Korea's top regulator admitted just 2 days ago they moved too fast approving levered ETFs tied to chip stocks, which helped push margin debt to a record, roughly, give or take with the exchange rate, $39 billion by the end of May. And that's what Wall Street is definitely watching today. Barclays, in a note, calls levered ETF rebalancing one of the biggest tail risks in equities right now, with daily flows routinely topping $20 billion. So of course that could sway the market. Those flows juiced the rally up, and now they're making the sell-off worse. And then if you step back, and some of this is just simple gravity. Semis, chips are up more than 100% over the past year. Fundamentals haven't necessarily changed, but a run-up that steep invites a pullback. And one more thing on traders' minds. Micron reports tomorrow. In March, keep in mind when they were last reported, the stock fell 7 straight days and lost roughly about 23% post-earnings before turning into one of the best buying opportunities of the year. So nobody's necessarily calling that a repeat, but it could be why some are de-risking this particular name right now, which is down about 10%, guys.
I wonder too, Christina, what you'll be looking for from Cerebras, the other big chip name that we'll get, I think tomorrow, right?
Yes. Oh, no, it's tonight. So, and then you have the executive at 11 a.m. tomorrow on your show. But with Cerebras, so this is a company, a chip company that just IPO'd in May. Their chips are much larger, the size of a Frisbee. And the issue with Cerebras is that they're very reliant on one customer. That would be OpenAI, that contributes a huge portion of their backlog. So what they have to do is they have to actually execute on delivering said chips. And that relies on TSMC to actually provide the making of the chips. So we would want to hear any type of outcome from TSMC, if supplies on track, if there's any delays, and maybe is the pay and take agreement with OpenAI, so they're actually paying for it in advance, is that improving? Is OpenAI going to buy even more chips? Do we have any more details about a potential Amazon deal, because they announced something just within the last month, but they didn't provide any financial numbers? So I would say those are the two things: OpenAI and AWS, as well as TSMC supply.
Christina, thanks. A busy 48 hours ahead. That's Christina Partsenevelos. Take a look at the pre-market. We'll get more on tech after the break. We'll talk about some things ex-tech as well, with some downgrades today of Nike, Ross Stores, and Home Depot in a minute.
Welcome back. Oil prices extending their losses one day after falling to levels that we haven't seen since early March. Crude flows through the Strait of Hormuz remain in focus as investors pay attention to the state of progress in the U.S.-Iran talks. The president, with his post this morning, saying that the talks are going well, guys. And if you look at Wall Street take, for instance, I'm reading the Citigroup note, for instance. Oh, here's Trump. I'll just read this. 19 million barrels of oil flowing out of Hormuz Strait yesterday, an all-time record. Oil prices are tumbling down, and the world is a much safer place, President Donald J. Trump. Citigroup, along with others, have said basically oil prices should now resume their weaker underlying fundamentals, which they, go back to, which is this glut of oil, especially now that Iranian oil is coming back online, at least temporarily. So they say oil markets now are moving into surplus and prices should trend lower. That's kind of been a popular view right now.
There are a lot of reasons to embrace the bear case on crude right now. You got obviously traffic, both dark and seen through the strait. You got SPR inventories continuing to drain. China's not buying, as we talked about the other day, David. Their tanks are full. And then you got sort of bypass, things that are able to get through pipelines ex-strait. So no surprise, Goldman today cuts their Q4 forecast for Brent. They were at 90, they go to 80. And then for next year, they're at 75 for 27 on Brent.
Right. Where are we when it comes to natural gas, particularly in Europe? I think the administration making a case that methane rules need to be suspended to a certain extent in terms of in Europe if they're not going to find themselves in a real shortage as well. I do know, there's a belief the U.S. is going to benefit from that. Obviously, we'll continue to. Some of the midstream companies as well. Yeah. Perhaps here in this country, beneficiaries of increased demand from Europe.
But there are upside risks too. We talked to Jeff Curry about some of them earlier this week. Which is, yes, it feels like there's progress on the deal, but much of what the U.S. is touting, certainly with regard to the nuclear inspections, has not been confirmed by Iran, and in fact, they're saying the opposite, that they haven't even talked about nuclear inspections. So it's, they played this game for a while now. They seem to not confirm what the president says, and then ultimately move forward toward a deal. But look, there's still risk, and they still are in control of the Strait of Hormuz, and they can close it if they feel that Israel's retaliating too hard in Lebanon against Hezbollah. So there are definitely still risks that the market's paying attention to out there. But as long as the president says there's progress and things are moving, feels like the market's giving him the benefit of the doubt, and oil prices are moving lower.
Right. A little confusing, the notion of an all-time high. We were doing 80 crossings a day back in February, and that's gotten
for the strait.
Yeah, right. So not sure what he means by that, but clearly there is net improvement. Although to your point, Iran and Oman today said that they are going to sort of jointly co-manage the strait. Which is one reason the president also said that we're probably going to leave U.S. assets in the region for a while.
Have we ever gotten any clarity on fees versus non-fees, or what that really means?
No, except for the president wants it open with no fees.
I know what he wants, but the Iranians have continued to talk about fees.
Part of their deal, supposedly, is that they're just supposed to let the traffic flow through. If the U.S. gives sanctions relief, lets them...
Which has begun, right?
Which has begun.
Yeah, 12 billion.
And lets them sell oil now for the next 60 days. The question is, what happened to the rhetoric about why we got into this war, which was to prevent them from getting nukes, get rid of their nuclear material, their missile systems, their Navy. We've done some damage there.
We have.
But we're hearing a lot more about opening the
conceivably, all that
strait.
money will allow them to rebuild, too, and potentially arm their proxies in the region.
The president says they're going to be buying U.S. soy and wheat with that money. And so that's another question. Do they agree to that?
Just like the Chinese.
Yeah.
Take a look at the pre-market. We'll see if there's any nibbling at the open, with the NASDAQ looking to open almost 3% lower. Stay with us. Looks like we're going to get some follow-through to the weakness in Asia overnight. We will definitely watch the chips at the open. That's not all that's going on, though, today. We'll get SCOTUS watch for some decisions at 10 a.m. Eastern. And then, of course, tonight, FedEx, KB Home, and Cerebra's earnings. Opening bell in just a few moments. And don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
I'm here. Okay. Well, we pulled back to support, that's for sure.
Opening bell just a couple minutes away. Let's bring in closing bell.
Oh, already a couple minutes away. Shit.
Mike Santola.
Perhaps a necessary reset to some of these really high valuations.
What's interesting about the Mag 7 is it's becoming a smaller story as the year kind of goes on.
It is not.
For years, market performance is really gauged on what the Mag 7's done. If you look at the Mag 7 right now, it's actually underperformed the S&P 500, where the real strength has been in the semiconductor.
Okay.
That's where we're seeing the biggest weakness.
I like how these people redefine things.
You're still with.
Well, so-and-so's up 1,500% for a year, and they're outperforming in 2026. And like, bullcrap.
About like an Oracle, for example, has also been under the same, seems like, pressure. But I mean, are we finally starting to see, say, more durable rotation under the surface, or is it a little bit too soon to say?
I think it's too soon to say, just because we've seen this in fits and starts, right? You know, every time everybody's ready to call the equal weight index the outperformer, and it's something that I'm going to talk about when we do our market outlook on Thursday. Great chart of looking at the equal weight versus the market cap weighted. And they could basically kind of be back.
I'm going to start off right with a call.
In terms of outperformance this year. But every time it seems that we get that rotation, you get a market pullback, you get that stronger correlation, and then people kind of rotate back into the tech trade. So time will tell whether or not it's just a blip or whether or not it's a trend.
And I mean, it is also interesting to see the VIX actually fairly elevated today, because the VIX has been relatively stable despite the overall market being pretty choppy.
Yeah, no, it's been stable. You're absolutely right. And I think even kind of given the fact that we saw the 10% move overnight in the Kospi, it's kind of well contained right now.
23rd,
yes, 15% trading, but it
the
is
737s.
sub 20. So I think it's something that throughout the course of the day, we'll see if the dip buyers step in and whether or not it's a beginning of a flush. But I don't see the beginning of the
737 at 107.
The rotation trade.
Yeah, and I think that this rotation, we continue to hope for this broadening out. We've yet to see really evidence, but now we do approach, of course, the opening bell here. Okay, let's now take a look at, of course, how markets just opened, as we are still substantially lower. Everything's picking up some of that pressure into the NASDAQ here. We're down about 1.5%.
Go, baby.
S&P 500, the NASDAQ down 3.2%. The Dow, the least hit of the four major averages, down 0.6%, but the Russell 2000, even some of these small caps, seeing a substantial sell-off this morning, down about 1.6%. As we check in on some of these futures products, similar price activity to what we checked in on about 30 minutes ago. Crude still lower by about
128.
We also are seeing gold pulling back almost 1.75%. Well, the dollar is really our standout green name of the group, up about 0.25%. Bitcoin pulling back almost 4% on the session. But so for some of these first moves right out of the gate here, we are joined by Sam Vadas, of course, host for the Schwab Network, to look at some of these individual stock moves. And so
137.
to see pressure throughout the equity market here, Sam, but we're looking at Carnival, which got its earnings, I mean,
143, yay!
just within the hour. So
out.
We are down about 9% right out of the gate, though.
Yeah, we were. Look, it's a tough day, obviously, to report given the...
I'm done for the day. My name's Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy, where I got into the SPY at 106, the 737 strikes, and sold them at 141. Snake, breakout, pullback, double bottom, lower low. Got to break to 63. We got an expansion pattern. I'm not scared. I'll be right back. Woo! Right out of the gate, Randy. I'll be right back.
A good sign here. Onboard revenue is also something that a lot of the analysts were looking out for, because it's not just about booking your cruise, it's about how much you're spending when you're doing it, when you're on board. So this seemingly outperformed ticket growth. So that was up 7.5%
Never too late
year-over-year.
for your kisses.
Pretty optimistic on the outlook and future booking trends into 2027 as well. So we'll continue to track this one. But as I said, I'm going to be waiting for the call, because on the Q1 call, they did say they had 85% of inventory booked this year and are seeing passenger volume actually increasing. We want to obviously see if there was some sustainability, if that very much continued, and saw some momentum in the second quarter as well. They're doing well, it seems, with the exception of higher oil prices. Remembering this stock has come well off because a lot of the travel and leisure companies, those are consumer facing, have obviously been hard hit on oil's way higher, but we have certainly seen somewhat of a recovery just in the last couple of weeks or so, as oil has kind of come off the boil. But as I mentioned, key focus areas, I think very much on that call, is going to be the booking yield, whether that's holding up perhaps along with the per head spending, but it looks like the numbers have already reflected some strength there. And just obviously also how the Middle East conflict is impacting some of the regional travel as well, particularly places like Europe, for instance, Jenny, because obviously while the Middle East conflict is ongoing, there might be a hesitancy or wariness to maybe jump on a plane and go to that part of the world. Maybe it might be a case where people want to book travel and cruises closer here to the United States. So we're going to be obviously keeping an eye on that. But yes, obviously getting hit hard in the session right now off the back of what seemingly was an earnings beat here. This could be something to do with a slight miss here on some of the revenues right now.
Okay, and a bright spot actually in this market is following several of these calls from the sell side on retail this morning, that being in Target, which is up almost 2% here, as Wolf did say this is a top pick of theirs into year end. So walk us through this positive piece of news here, a nice green candle for Target today.
Yeah, up 2% right now at the get-go, and obviously Wolf Research, as you mentioned, making a number of analyst calls here around the retail space this morning, and Target getting some love with this outperform here. This was from Peer Perform and a 162 price target. So they basically said this is a top pick into year end. They're seeing improved execution as the new management team shakes up the status quo, they say. So obviously we've been watching this turnaround strategy. The analyst seemingly is seeing some confidence in what they're trying to do here as far as some of the changes, because we know that the turnaround strategy has come from an extended sales slump over at Target, and the struggles were really a combination of what has been hitting the broader industry with some of the macro pressures, but basically a lot of its own problems as well. Things to do with inventories, not just getting it right in the stores. So things are seemingly looking up. We have certainly seen that in some of the earnings. Wolf also sees a 3-to-1 skew in the shares right now, with the upside to 160 and downside risk to 120, currently trading at 131 and change as we stand here, Jenny. They also say Target's summer store resets are accelerating and it's becoming a destination once again. So that's obviously behind what we've seen here with this upgrade, and it believes the company's future is increasingly compelling now, with mid to $9 earnings per share possible next year. So obviously that is getting some love from the street today, and we're seeing a nice response to this upgrade here from Wolf, up almost 2%.
Okay, on the other hand, Home Depot is lower. Now we've pulled back, we're continuing to pull back here actually in real time, down about 1.3%, but it does seem like Wolf really downgraded this name solely because they see the stock is a bit more stuck in this limbo right now.
Yeah, that's right. So a downgrade from Wolf for actually Home Depot, but also Five as well. So let's talk about Home Depot. It's gone to Peer Perform from Outperform. No price target here. It believes it's stuck in limbo, as you say, as the lock-in effect and a strategy shift towards a large pro segment raises questions about earnings power right now. They say while a bull case is emerging around the midterm elections focusing on more housing affordability, the real legislative action that could unlock the market could be a mid-2027 type of event and story at the earliest, they say. So there's questions where interest rates will settle right now and how much over-earning there was at Home Depot following the years of the lower rates environment serving as a tailwind. It continues to prefer shares of Lowe's, they say. So obviously what they're getting at is it's a bit of a wait-and-see type of story right now. And actually, if you take a look at across the analyst consensus here, you do have a major cohort, in fact 15 of them in a hold cap right now. So waiting to see where interest rates settle. Obviously, we're looking at potentially staring down the barrel of a higher interest rate environment. What that's going to mean for the housing segment, particularly at a time when we've just started to see somewhat of a spring sort of home buying rebound here, is that going to affect things as far as some of that sentiment? I think this seems to be a wait-and-see story as far as Wolf is concerned, and looking obviously at Lowe's as a preference here.
Yeah, and unfortunately seeing some of that pressure just pick up here, but so appreciate it. Sam Vadas helping us run through some of the top movers to keep on our radar right out of the gate this morning. But coming up next, we will talk the markets and, of course, the Fed. Opening bell, we'll be right back.
Opening bell.
News, I help you read between the lines from what's moving markets to what's next with sharp takes and
Okay, get ready for the breakout.
Follow me on all social media platforms.
Randy, we're at the 200 right here, buddy. 734.41. 200 EMA and SMA. 3 white soldiers. Tweezer bottom, snake, breakout, pullback, double bottom, lower low, So we're at the squeeze. It's now or never. God darn, Marley. Hope you're wearing that red dress today. Shit. Might found a new dress here. This one's bad enough. But this new one, damn. Girl, we got to pull back on the video. And the guy gets out here and bad mouths tech. They do it every frickin' time. They get any kind of hope. And then tech gets bought back up again. At least this idiot had enough sense to admit it. This economy is not like it was. It's not the same. You can't trade it like you're back in 1920. Trading on a ticker tape. There's a big disconnect between the private sector and in the private sector and Wall Street. PLTR had a big sell-off yesterday, and it down to 117.30. I'd keep that one definitely on high watch. It's still up a lot. I mean, I was afraid to buy this thing at $5. Because I didn't like the guy back then, but now I like him. So I don't know. It's weird. Blaze is up nice today. Back Blaze lands 335 billion data storage deal with CoreWeave. Gosh, now this one should have been on my watch list. This one should have been on my watch list. This one should have been. Blaze. Yeah, I should have been watching this.
Flush with cash and buying back debt at a premium. In today's market, those are the opportunities. It's not a large beta trade. So what we've been saying for the past year plus is that beta is expensive, meaning that generic credit spreads are very rich. You're really not going to get a lot of total return from spread compression by owning the market. Yes, you can clip an attractive yield, and that's what's been supporting credit spreads is, on one hand, really attractive higher income. And on the other hand, generally corporate balance sheets being in really strong shape with growth.
Okay, so on bond-specific alpha, you didn't mention things like debt levels, but how meaningful are things, say, like debt buybacks and driving total returns versus just clipping the coupon?
You're probably more clipping the coupon than you are the former, meaning that most companies are not buying back debt. We see a lot of companies, particularly in the tech sector, for example, with the hyperscalers, issuing a lot of debt. Why? Because the market is wide open. It's thirsty for yield, for opportunities, again, in the long end of the curve. But in terms of where your total return comes from, yeah, it's going to be predominantly driven by that yield. And then if you're a good credit selector, you can find some opportunities beneath the surface to find those, whether they're debt buybacks by the company at a premium, maybe there's some other catalyst, an event like a rising star, for example. There are some of those still out there from, the higher quality part of the high yield market that are rising up to investment grade. That's a way where you can really get spread compression or prices.
God, Meta, I knew it.
Move higher.
Okay, well, so appreciate your time today and really great conversation breaking down
Meta
some
and
of
Apple.
the overall risk right now with ongoing rate concerns. But so appreciate it, Jason Greenblatt, Senior Portfolio Manager at the American Century Investments. Let's though now head back out to the New York Stock Exchange as Twilio is celebrating the 10th anniversary since its IPO. But joining me now, just after ringing the opening bell this morning, is the company's CEO, Khozema Shipchandler.
Nice.
Khozema, thank you so much for joining the show today. 10 years after the IPO, Twilio has evolved beyond messaging into a broader engagement platform. So where really do you see then the next phase of this evolution?
Jenny's handling it on her own today.
What we're trying to become now is really as the infrastructure for agentic AI. And I think what the market really needs is a company that can act as sort of the Switzerland almost of the AI era, where you don't have to rip and replace your tech stack. You can plug and play based on what it is that you've already got. And of course, you need the essential infrastructure that Twilio provides, using both context through data as well as communications to be able to reach your customers.
Twilio.
Okay, so with tools like conversation memory and orchestrator, how are you going about balancing then personalization with, say, governance and control?
Yeah, great question.
Oh, good question.
We've really tried to improve upon is our voice business, just given the fact that voice AI in particular is taking off so much. And so one of the things that we spend a lot of time working on is...
Yeah, I got these chicks calling me all the time, wanting to embezzle money out of me. We got VWAP here on the /ES. Randy, Jimmy said consolidate, breakout.
Okay, you mentioned voice, which is now delivered.
He did say that. I heard him.
So what is the specific catalyst behind some of that momentum, and how sustainable do you see this?
I think it's pretty sustainable. If you think about the way that AI is starting to be, a lot of what's happening is starting to take off in the voice AI space.
Uh-oh.
Right in the same way that you and I are talking right now.
Something's happening. We just broke a major resistance.
Context in the terms of the way that
Ladies and gentlemen,
people can express the things that they want when they're upset about
/ES, VWAP has been broke.
picking it up in a voice context. And so I think you are seeing a lot of activity.
And the SPY calls are at 198.
Over time, it certainly will turn over to other conversational channels. In particular,
Now they're at 206.
and I think our goal is to be positioned.
Let's go.
Channel is making sure that customers can be reached in the way that they want to versus companies.
Scaled out some at 141.
Okay, and some investors do still think of Twilio as
Jimmy called a megaphone.
but what convinces you this is now a higher value platform?
We're at a megaphone resistance.
Chance to grow in a more AI-centric world.
They're now at 218.
Conceived of as a utility. I think in this environment, being essential infrastructure is really important. If you think about the company and where we're positioned today, we're one of those very few companies.
I don't know how he does it, but his name's Washboardjim. And I sat here and I listened to him. He said megaphone. What the hell's a megaphone?
Okay, you do have some of these long tenure.
A megaphone.
And so how have their use cases perhaps changing? And again, this very evolving, but
Could I have my company here, please? Megaphone. Well, megaphone never leaves you alone. If you're looking at charts, wait and see. Well, the falling wedge and the rising wedge compares to a megaphone. Most traders, they don't even know what a megaphone is. Ask them, and I'd say that's a sin for sure. It's an expansion pattern with higher high and lower lows. I got in this trade at the lower low. Mentioned that megaphone. That baby will never leave you alone when the market is very volatile. So the first thing I noticed was the new lower low. First thing that popped in my mind was Jim, go in the bathroom and smoke a bowl. So I bought the dip on the megaphone, and the thing just went ahead and broke out. So I told the room, scale out and hold a few. I'm pretty confident that we're going to hit this triple top on this megaphone. Thank you very much. Nobody's ever explained that as well as you have, James. That's because I'm the singing day trader. Well, I was asked this morning, what do you think about the market? I took a sip of my coffee and I thought it all out. I think we're going to consolidate because I remember what happened yesterday. I wouldn't be surprised if we broke out. Trading a sneaky, snaky trading strategy. I was a witness to something that I've always seen. These damn calls, they're at 229. Less than 25 minutes. I made over $1,000. Now I think I'm going to take off my shoes, put my feet in the sand. Hey baby, bring me a Bob Marley double shot. I've been waiting for this drink for a long, long, long time. Okay. So they stuck AMC traders with a frickin' offering. Woo! That's what they did. AMD, I gotta go get paper towels and soap. Fuck, I forgot the soap. I gotta go back and do the soap. I can't figure out the elevator light. I talked to the grass people this morning. I showed him in the back that needed to be weed eated. Well, lawn guy, don't forget to weed the back. One of my girls got bit by a spider this morning. Lawn guy, don't forget to weed eat the back. If I come back here today and the grass is not mowed away, you're not coming back. Whoa. Okay, I got that out of the way. I gotta get my coffee. You know what? Yeah, I gotta get paper towels. God, 213. Imagine that. So let's talk about this here pattern. So I got this on the 1 minute. What's this? So you got the breakout, pullback, tweezer bottom with 3 white soldiers. So what's 3 white soldiers mean? What is it suggesting? Not what's it trying to tell you? What is it trying to tell you? Three white soldiers is trying to tell you that we could have a continuation. That we could have a continuation. get soap. So I think I'm going to get that done pretty soon. Very good.
Now being sworn in as an MP, it looks like he is uncontested as far as this race to potentially replace Keir Starmer. So we'll talk about that and some of the action in that neck of the woods later on in the show as to what that could mean for the pound and also for the gilt market. Let's take a look at some of these futures products because we do see oil coming off, but this has been a story of a decoupling between oil prices and that 10-year yield, which is remaining elevated and sticky at 448, although it's come off a bit this morning. Look at the US dollar index, 101 on the Dixie. Greenback firming up on the session. We are watching dollar yen this morning as well. Japanese and US officials speaking overnight. I'll talk about what that's going to mean for the currency and some of that weakness later on in the show. That is putting pressure on precious metals right now. 1.2% lower on gold, 41.54, and Bitcoin down across, of course, the cryptocurrency space as well, because, of course, this broad sell-off we're seeing in technology as well. So down 3% on Bitcoin, 62,000 and change. So that's how we're looking as we get up and running for this Tuesday session. Obviously, half an hour into trade where we are seeing the brunt of it being dragged down by technology, particularly chip stocks. Let's bring in Joe Mazzola, who joins us from the Chicago studio this morning. It's actually interesting because we're seeing some relief in some of the Mag 7 members today, all but Google, which continues to decline, Nvidia. But it really is the chips that are losing steam this morning in the session, Joe. A lot of it triggered by what we saw in South Korea last night, as I mentioned, with that brutal sell-off in the Kospi. There are so many threads with this. Obviously, we've had SK Hynix overtaking Samsung. You've had some data suggesting just how much debt these retail investors have been taking on to buy into these stocks. The one weakness, you've had some of the concerns around the single stock leveraged ETFs catching the attention of the regulators as well. Just walk us through your thoughts and why we're seeing so much follow through in the US session right now.
I'm going to go with D, all of the above, Sam. And here's the reason why. I mean, you look at the pullback that we saw this morning, and in all honesty, we're seeing a little bit of a relief from that as I look at the futures board right now. But the Philly Semiconductor Index fell by the most, around 7% in the morning, and that's the most that we've really seen since the pandemic in terms of a one-day move. So there was a lot of, you want to call it pent-up demand, if you will, on the upside that's pushed these names higher and to a kind of parabolic levels. But then it really started overnight, as you were mentioning, with the Kospi. That 10% pullback in the Kospi triggered some circuit breakers. It triggered some weakness overseas, and then it spilled its way into our futures market. But like I said, we're starting to see some improvement now. And if you look over the entire kind of spectrum, If you take out technology, which is down about 2.2%, you've actually got about an even split between advancers and decliners, especially at the sector level. So it really is more of a bit of a rotation story. I think it's probably a little bit of a trimming of the fat, maybe from some of these upside gains that we've seen, and maybe a little bit more rotation towards some of the defensive gains today.
So, you're a derivatives guy. I'm just wondering, with some of the concerns coming from the regulators, with some of the scrutiny on the single stock leverage ETFs right now, I was having a fascinating conversation yesterday about the level of retail demand we're seeing in single stock leverage ETFs here in the US right now, particularly off the back of SpaceX. I'm just wondering if what we're seeing out in places like Korea poses a risk as far as what we're seeing here in the US or as well, or is it somewhat different as far as that high risk, high reward, wanting to shake speculators out of the tree with, obviously such a liquid market like the US, maybe it's not as big of a concern?
It's a much bigger trade in Korea. Even if you look at maybe some of the levered plays on SpaceX, what they are able to do with SK Hynix and some of those other companies out in Korea, there's a much more highly levered play in the options market, and then just in terms of those single stack ETFs. So, and that tends to be the case. We see that quite a bit in the Asian markets. There's a lot more of that, kind of chasing the rally with a lot of those investors. And look, in all fairness, Sam, they've been right for a while. But even if we bring it back to the U.S. markets here and just kind of look at some of the call activity that I've been calling out for, the last couple of weeks, it really shows a demand for a lot of that upside with the
281. You got to be kidding me.
In general, just the whole semi. We are looking at outside of today.
Okay.
Looking at single-digit percent.
This was a beautiful call this morning.
Something like that. Here's kind of what that means. Calls relative.
The 737s now are at 271. They were at 281. And we're at the 63. Now, I see the 50. I see the 9. I see the 21. I see consolidated for the last 7 minutes. So we need to build resistance above this. Take that body right there. If we gain respect of 74, 08, 08, 08, 08, 08, 08, 08, 08, 08, 08, we'll start to move up. I'm making a cup of coffee and then I got to go get some towels. I'm busy working too. See, now we just broke it. We hit the 63, which was called. Now what do? You do not jump in here. You wait for it to break the 63, or you exit, scale out of the trade. I'm at 302 on my calls. 321. Almost to my resistance. So we hit the two. We hit. SPY hit the 200. So, I think it'd be a wise move to take some profit. Unbelievable. So I just made 100% more off what I held. Usually I'm whining and crying. Well, it bounced. So we hit the 200. What do? James, I've been following you for about 3 years now, and my portfolio is up almost 7,000%. I've been trading off the 200 SMA from day one. Now, once you mentioned that 200 SMA on the 5-minute, the SPY, I realized that I should go ahead and take profit. And that's exactly what I did. So do you mind, James, if I shine your shoes tonight?
I think for the most part, when you're looking at volatility in the bond market, that's abated quite a bit, and I think that's led to investors feeling more comfortable kind of looking for that broadening trade. But once again, that broadening trade has been something that
that's what you are.
Been a couple days of fits and starts, and then kind of moving back to tech. So we'll see what happens there.
Great stuff, Joe. I really appreciate it. Thanks so much for letting me pick your brains about all of that this morning and jumping on for us. We'll leave it there. Really appreciate your time. Coming up, we'll keep discussing the rotation out of tech as well as the path ahead for Kevin Walsh and the Fed. Morning Trade Live is back after this.
Did it again. Consolidate. 3 white soldiers, yay. Break out. Do it for me. I 100%er. Break it. Do it for me. We hit the 200 SMA. Ooh, baby.
New York Stock Exchange.
You ruined my song.
Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Cleavage. Since you got married, you put on some weight, baby.
You could bet on this and win. You could bet on this and lose. This and lose. This and win. This and lose. This and lose. This, lose, lose, win. Lose and lose, win. Even this, lose. Betting isn't investing. Investing is owning. It often rewards patience and discipline over shots in the dark. The long run belongs to those who invest in it. Own your future. Don't bet on it.
Oh, hogwash.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
We're back on Morning Trade Live. Wolf Research upgrading Target to outperform from peer perform with a $162 price target, while also naming the stock as a top pick into year-end. The firm says Target is seeing improved execution as the new management team shakes up the status quo, while their summer store resets are accelerating as the company's future is increasingly compelling, it says. Target's up 35% year over year amid this turnaround strategy. Things seem to be working out. It's up 2.5% right now. Let's take a look at some of these other leaders. We've got Axon Enterprise up at 5.5%, Moderna's up at 6.5%, CDW Corp is up at 4.5%, and IBM is up almost 4% right now. So, as I mentioned, a big rotation day out of hardwares into other parts of the market, like healthcare, like consumer staples, more cyclical value parts of this market. So we're obviously seeing IBM up. We'll talk about why later in the show today, but let's just talk about what is dragging right now, because obviously a lot of it's coming from technology. There you go. It's all the memory names. SanDisk down 11% off the back of a Samsung and SK Hynix decline of around 12% overnight as well. So similar percentage points we're seeing there. Micron is down 8.5% right now. Western Digital down 8.5% as well.
Micron.
In fact, I actually saw a stat yesterday. SanDisk is the most overbought in history. That's according to Oppenheimer. So obviously we're seeing perhaps a little bit of profit taking as well in some of these memory names. KLA Corp's down 8. Obviously, we spoke about that one yesterday with respect to getting a little bit of some love from the analysts at the moment, particularly as we're seeing that rotation of capital out of the big spenders into some of the AI infrastructure and bottleneck parts of this market. So the equipment makers have very much been benefiting from some of that. So let's talk about some of this tech sell-off with Jake Dollarhide, CEO of Longbow Asset Management, who joins me around the desk at the New York Stock Exchange this morning. Thank you so much, Jake, for your time.
Absolutely. It's great to be here. Thank you.
Yeah, it's great to have you, particularly on a day like this. What is going on in technology? Obviously triggered by what we saw in the Kospi last night. What did you make of that? I mean, what is that telling you? There is so many stories going on in South Korea right now as to, you know, obviously the catalyst with respect to the leverage ETFs, etc. But is it telling us, as far as this follow through, anything about questioning the sustainability of this AI trade, or do you think that remains intact?
I think there's AI fatigue. The question is, will the buy the dip mentality come to the rescue? Will this be a short-lived phenomenon? I hear the Kospi's been on a
short-lived
rise. It's been amazing. And I hear there's all-time use of margin in South Korea. So this decline could be exacerbated by margin calls and by forced liquidations, and unless the buy the dip savior comes in to save the day.
Yeah, I mean, obviously we're seeing retail investors out in that part of the world, I mean, taking on record amounts of debt in order to buy some of these stocks. Obviously, we've seen the South Korean currency weakening as well. So, I mean, that all feeds into it. But what does it mean for the US tech trade when you talk about buy the dip? Because, you know, when you look across technology today, software's higher.
Sure.
Max 7's higher. These have been the ones that we've seen the rotation of capital out of into the bottlenecks, like your memory, like your AI infrastructure, and they're down on the day. So we're seeing this bifurcation where it's kind of like a ping pong match between the two right now.
Right, it really is. I heard if you take AI, tech, and energy out of the market, we're down the year.
Yeah.
And think about last year, 377 companies of the 500 companies, SP 500, were lower last year. So in some ways, outside of tech and now energy this year, the general market's been down 2 years in a row. We're just coming out of this alternative post-COVID universe where bad news is good news.
Yeah.
But 2 weeks ago, that strong jobs report
Bad news is good
turned
news.
that totally around. Where now good news is bad news, and the
Exactly.
Fed has,
That's what I said.
Way to hike as much as they want, and the question is,
He's saying the exact same thing I said at the beginning of the week. Are we at the point now to where good news becomes bad news? Think about it. I mean, we've had nothing but bad news thrown at us every single frickin' day to do anything they can to bring this market down, and nothing has worked. Nothing. So now finally peace in the world. It used to be back in the day that Wall Street loved wars. Wall Street made a ton of money on wars. We had 10 wars under Biden. 5 genocides. Obama, there was a bomb dropping every 28 minutes. Let that sink in a little bit. Damn, 356 for these calls. We just now hit my resistance. 365. What? No. I don't want to look no more. Okay. Well. Are we due for the pullback? Are we now? Do. Well, it definitely consolidated, hit that resistance. So supports the 21 on the 1 minute. So I'm going to go get the soap. going to take a picture of that light and get my coffee and have a sip of it. Perfect. It took me 5 pounds of coffee to get this thing down, or I can get them chocolate nodes out of it. That's delicious. I really like coffee, especially good coffee. Okay, I'm gonna go get the soap and go get my errand done.
Too bearish here is if we look at some of the on-chain data, such as option skew or perp future funding rates, these kind of remain at washed out levels, and we think that that's supportive here. If you look at the skew, it's more or less since May of last year to February this year, there's consistently was more demand for puts relative to calls, and since February, that has kind of balanced out. Now, positioning is still more bearish. There is more demand for puts than calls, but we aren't seeing that trend extend further down. And so we think that's positive and potentially puts a floor because you have more advanced, more experienced investors who are hedging. Again, they're less bearish here. And then in funding rates, these tend to be good contrarian indicators. When they're very negative, it's usually confirmation a bottom of a local sell-off is in. And right now they're positive, which in general they usually are. So funding rates are not stretched by any means. So you pair that with some of the other on-chain indicators we watch, such as the production costs for producing a Bitcoin, and some long-term technical indicators like the 200-week moving average. And again, we think that there's a good level of support here, and that's what kind of keeps us from getting more bearish at these levels.
Okay, and Colin, just obviously getting back to what we're seeing as far as oil and yield somewhat decoupling. I mean, the way that was put to me yesterday by one of our guests was that they see different futures. I'm just wondering if those two futures, those two stories where we have lower oil but, you know, a higher rates environment, maybe some of that coming from some of the factors that you and I have discussed at length about, you know, the strength of the economy, maybe some of the concerns around the budget and other things going on. Can they coexist?
I think they can. I don't think we'll necessarily see yields fall with the decline in oil. You know, the story we were talking about multiple times on this program over the past few months was that the rise in oil pulled that 10-year Treasury yield up. It has not then, you know...
No, I did not see this head and shoulders on the daily.
The oil prices at, you know, multiple month low, 10-year Treasury yield still hugging, you know, 4.5%. We think that the factors you mentioned should keep it elevated. The resilient economy, you know, a positively sloped yield curve.
Inverse head and shoulders, yes.
When the economy is growing, the labor market has shown strength. Fiscal concerns aren't going away. Maybe the inflationary concerns, you know, maybe that removes part of the pressure of upward yields, but there's no shortage of factors we think
could drop
keep
more.
long-term yields kind of in this 4.5% range for the time being.
All right, good stuff. And just getting back to you,
/ES.
obviously you run through a lot of reasons why we're seeing this performance in Bitcoin right now and across our digital asset space. So what are you keeping an eye on the most at the moment? I know you talked about some of the...
I wouldn't mind seeing a good week pullback.
Obviously, we continue to keep an eye on the passage of the Clarity Act as well, but is there anything that really stands out to you about what we should be keeping some tabs on right now?
There's no specific indicators that I track to say, hey, we're in the all clear. This is a bear market. It's going to finally end when investors have finally capitulated. It takes time to recover from these things. And so I'm looking at on-chain data. I'm looking to see where our flows coming from.
This is what gets me.
Seeing a consistent selling in spot markets, whether that's through ETFs or actual on-chain.
It didn't give them no time at all. They said it's going to take time for the correction to come from the prices. And it didn't take them no time at all to start calling out big pops. I mean, it didn't take them no time at all to call out higher prices on tariffs. It didn't take them no time at all to call oil out to $200 a barrel. It didn't take them no time at all. I mean, they were on it that day. So they were talking about that this morning. I said they did the same shit during Biden when oil jumped up so high and then it dropped. But the prices didn't drop for almost 5 or 6 months because they wanted to take that profit. It's hard as a business owner. I know because I've been one for 15 years, 35 years. That once you raise the prices, it's hard to bring them down because you're in a I mean, it's hard to bring them down because it wasn't for me because they were so high to begin with. I figured, let me do a favor to these people and lower these rates. Some people charge $60 to $70 an hour just to even work on a picture frame or to even go in and do an hour's work in janitorial service. Some of these people charge $60, $70 an hour. I said, I ain't gonna fucking do that. So I stole all their business during the Clinton irrational exuberance. It's the same shit was happening back then. Then once he implemented Wall Street reform, not Wall Street, but welfare reform, we had a real good run in the market. But for the last 25 some years, we've had a different kind of economy. It's called share the wealth. We're going to print as much money as we can, and we're going to distribute it out as fast as we can. And it ain't working. It just made the rich richer and the poor poorer, more dependent. So it's definitely a different kind of thing going on. I'd like to be around another 20 years and see how this all turns out. PLTR pulled back again. IWM still holding a 9 on the 5-minute. Okay, well, I gotta get the soap. I'll get towels after the market closes. And I'll go get something to eat and I'll come back. I've already had a good day. I think the best trade of the day is the first trade of the day, almost anymore. Now we got an inverse head and shoulders here on the /ES. This is my VWAP chart. That's on the daily. So it could easily come back down. It'd be a strong buy right in here and go long. So I wouldn't be too ambitious.
Expansion.
They were talking about, look how fast it took them. It didn't take them a week, not even a week before the war started, before they started raising gas prices on flights. I was watching them, and I watched them surge from like 300 surcharge through to the same destinations that I was looking at. I mean, they were wanting 1,200 to go to Mexico. I'm like, what the fuck? That's almost a 100% increase in 8 years. Or less than that. A lot of this price increase happened under Biden's watch. It was like overnight. I'll never forget 2021. Walking into my warehouse to buy supplies and going, what the? $20 more a case for toilet paper? Are you kidding me? We had a toilet paper crisis. People couldn't even wipe their asses. First time in 20-some years that I had to be put on a well check to get toilet paper. We'll call you when it comes in. So I need it now.
Yes, Tommy, yesterday we continue to follow up on the developments around that as that has opened the door for Andy Burnham, who is the...
familiar with, but I kind of twisted the words a little bit. Hello, I want to practice a little bit of my social distancing today, and I'm going to record a song that everybody's familiar with, but I kind of twisted the words a little bit. It kind of goes a little bit like this. 99 rows of teepee on the road, 99 rows of teepee. take one down, pass it around, 98 rolls of TP on the roll. A TP on the wall, 50 rows of TP. Take one down, pass it around, 49 rows of TP on the wall. Rows of TP on the wall, 30 rows of TP. Take one down, pass it around, 29 rows of TP on the wall. 20 rows of TP on the wall, 20 rows of TP. Take one down, pass it around, 19 rows of TP on the wall, 19 rows of TP on the roll, 19 rows of TP. Take one down, pass it around, 18 rows of TP on the wall. Thank you very much. Y'all have a great day and make the best that you can out of it. Looks like we're coming down to the 63 on the SPY. We're at the 100 right now. And we got the VWAP. I'd almost feel like buying some right here, but I gotta go get this soap deal done. And I haven't had a taco in a long time. I might grab a taco. But I'd say somewhere around here, 735. I don't know. Could dip more than that. If it doesn't hold this support right here. That'd be the double bottom right there. Triple bottom. 736.41. Did you get that bug? 736.41. If that doesn't hold, then 235.62. This could be it. So I wrote that song 21 because I was at the grocery store here, walking up the toilet paper aisle, and I noticed there was just like a few left. These two ladies were looking at each other. Who's going to get the more expensive toilet paper or the cheap toilet paper? Next aisle, and then hardly any noodles on the aisle. Then you go over to the egg aisle and you're paying $13 for 18 eggs. And I always have eggs in my fridge. Used to always have milk in there, but the older I get, the less I want to drink it. So, we'll see what happens here. I think we're getting ready to squeeze. SPY's rearing down on the 200 EMA. Well, what should I do first? We got a couple of errands I got to do. Tesla has like a fallen wedge on the 1 minute. See how it bounced up off the... I didn't take it though. I should have took it. Sat here and called it out. Be a scalp to the 63. Tweezer bottom on the SPX and SPY. All right. Well, shall I wear my cowboy hat? I think when they bury me, I want to be wearing my cowboy hat. Oh yeah. Who is this Dennis McCain? Did McCain's son die? Okay, well, I'm gonna go do my thing. This way I get my blood circulated too. So we got Prime Day today on Amazon. Blaze is pulled back. $8 billion in sales. Anybody gonna buy anything on Amazon today? I gotta buy me a new phone case for my belt, so I might get one. See if I got a fancy one in there. This one didn't last but half a year. Nah, might have lasted longer than that. Not much. I just don't like paying. You know, if I want to buy something, I want it to last. I'd rather spend an extra 30, 40 bucks. Meta. Kind of disrespected myself on that one. I wish I'd have bought that yesterday. Netflix, really cheap right now. AMD down 30 bucks. Mister, I think, is getting very cheap. Intel down almost 5. You got to go over some of these stocks that have run. I mean, this was a triple bottom. I'd have took that this morning. A $10 bounce on Intel. And IBM, is it its turn? They said something about IBM this morning. Quantum computing with new executive orders. Trump fast tracks quantum computing. IBM and other quantum stocks defy the tech sell-off. Pay attention to SPY. If we want to stay bullish, we got to hold this support. Okay, well, I'll be right back. I got support for the SPY above the 200 EMA, 736.41. And we got the orb right around 735.47, so about $1 dip. It's kind of a little wall right there. I'll be right back.
Three to one skew in the shares, maybe a little bit less than that now, given the rally we're seeing here intraday. But calling it a stock with upside to 160 and downside only to 120.
Target.
Also talked about their summer store reset being an accelerator, and it's becoming a destination once again, believing that the company's future is increasingly compelling, with mid $9 earnings per share possible in 2027. Analysts largely are warming up, I would say, to target. It's improved in the last 6 months or so, going from about 30% buys to about 35% buys. But given the stock has rallied about 35% over the last 6 months, the consensus price target, well, it got caught today, basically, with the stock trading in the low to mid 130s. That is where the consensus analyst price target is.
Yeah, it will be interesting to see, too, if we start to see any catch-up plays here, as we're starting to see us right around the consensus now with Wolf at 162. I mean, it is interesting looking at Target, and they're saying their turnaround has a rhythm we haven't seen in years. I feel like we spent so much time talking about what Target wasn't doing right and all of the headwinds that it was facing.
Yeah, it's a good point. I mean, earlier today with Tom White on Morning Movers, we covered this stock and we covered Nike. And if you're a Nike investor, perhaps what you've seen in Target over the last 3 years would give you hope that these names can recover from poor execution decisions, tariffs, and all the things that have weighed on some of these big box retailers and just retail companies in general. But Target's just now getting back to flat for the last 3 years. So we want to praise the last 6 months, but we should also recall a lot of damage done over the last 3 years.
Yeah, will be interesting to see what they say in their next earnings as well. Alex, really appreciate you breaking that down for us, that new call from Wolf Research, sending shares higher, up more than 3% for Target this morning. Do you want to welcome in our next guest, though? Take a broader look at the markets. Joining us, Joe Schmitz, the CEO of Peak Retirement Planning. Joe, we've had a lot to digest in the markets of late. A new Fed head with seemingly new Fed policy, interest rates, geopolitical developments, the SpaceX IPO. I could probably go on and on and on and on. But how would you characterize the market environment that we have right now?
Yeah, it's interesting. The word I would use is volatile, right? And so as investors, we always have to remember that we need to remove emotions from our financial decisions and especially from our investing decisions. So a phrase that we use often is when in doubt, zoom out. And I would say right now we may not necessarily be in doubt. Also, there's obviously a lot of positives right now. We've seen that, employment's numbers have been good. We've seen a lot of good things, but we want to be considerate that, for example, SpaceX. Is that the best investment or is that more of an emotional investment, right? It's a great company, but is it a great investment? And so I just think that we need to utilize more data and more understanding when making these decisions, not just looking at headlines on the news to decide what we want to do with our life savings.
So then let's talk about SpaceX for a second here. Is SpaceX a good investment? I mean, we're looking at SpaceX pretty close to where we opened trading. We've seen a significant pullback here after quite a bit of excitement with its IPO here. As you look at SpaceX, it's certainly captured attention. I think you could argue it's captured imagination and this fascination with the cosmos. But how much of the current valuation is actually based on future possibilities rather than the business that it actually has today?
Yeah, I mean, it's definitely an overpriced stock right now. And now I don't want to say that is a bad investment. Over time, it certainly could be a good investment. I mean, we all know and believe in what this company is doing. We know the values it has. We know that it can be successful. We know it has been successful. It's more about we feel like right now, from an investment standpoint, that it's overpriced. We feel like that the market is overpriced in a lot of the future expectations that we're going to see here. And so it may not necessarily be the best place for a large amount of money. And I do want to remind people out there too, especially those index investors, those that are going to be owning certain indexes and owning the market in large. Well, we know that SpaceX is likely going to be a part of many of the indexes out there. And so this could be something that people are indirectly invested in through those indexes, that they may not have to have the urge of going to buy the stock on their own, or having to worry about getting their shares and seeing everyone out there is going to this fad right now. It may be something they can be more patient with and just let the time of the market work itself out, worry about the data, worry about less about the emotions, as we've been talking about there. But we do know when it comes to IPOs, when IPOs first happen, if we just look back, a lot of times they're not overly successful, especially in that first year. We see on average they can be down about 26%. Depending on which ones you look at historically over time. And then we also see that over a 3-year period, about 2/3 of those don't even meet the benchmark of being successful in itself too. So certainly it creates a lot of buzz, a lot of excitement, but we do always want to look at IPOs and SpaceX specifically to see if now's the right time to be going all into this, and obviously following more that the diversified approach is more of our recommendation right now.
And Joe, you bring up another really good point in the notes that you sent over about historical IPO performance. I mean, you just mentioned there that 2/3 of them lagged the benchmark over a 3-year period, but you brought up another really interesting point, that the 10 largest IPOs that we've seen since 1999 all delivered negative returns in their first year after going public. So what lessons should investors take from that history? Because it's not just SpaceX we're talking about, and we've got Anthropic and OpenAI coming, and who knows what else beyond that. I mean, we've seen such an uptick in the IPO market.
Yeah, absolutely. Just patience. Patience is a virtue, is something we always say. And as investors, we always want to not miss out. The fear of missing out is so real from an investor's perspective. And so when you see on the news and you see SpaceX and you see all the positives that come with this company, the natural tendency, the behavioral finance of that is, I want to invest into that. I want to invest more. I don't want to miss out. All my peers are doing it. Herd mentality. All of the behavioral finance concerns that we have appear in this type of setting. And so I am here to say that SpaceX could be a great investment. I want to make that very clear. It could have good, a future trajectory. It could even have good, even further long-term trajectory. It's just based on the numbers that we're seeing. It's not something that myself personally am looking to dive all into outside of the index investing I personally do, is my perspective. Just because when I personally do investing, I don't make emotional decisions. I want to use a lot of data when I make decisions. I want to see what is the profit margins, what's the PE ratios, what are all the numbers behind this company before I invest my hard-earned money and hardworking money into this type of endeavor. So I always encourage people just to be more specific. I mean, make sure they're working with a team that's looking at professional investment management. Vanguard has studies out there that show if you work with a professional investment manager, you do 1% to 3% better. And it's mostly just from fundamental professional investing advice. Rebalancing at the right time, staying diversified, following market trends, just making sure you're staying on top of the key things that really move the needle long term.
And Joe, you say patience is a virtue here, and beware the FOMO trade, which we know is very difficult, especially with how popular that trade is right now. How do you go about doing that? I mean, we have this volatile setup. It's expected to remain volatile. And sometimes it can feel like you're being left out or you're missing opportunities when you're sitting on the sideline. So how are you approaching the volatility? I mean, is there a way to play the volatility right now?
Yeah, I mean, just that zoom out, when in doubt, zoom out, right? We always want to think long term when it comes to the markets. And if you look historically, 10% average over time is a pretty good rate of return to have. And you just have to have that diversification. All different market segments are going to do well at different times. And so that's why we don't want all of our eggs in one basket. People have heard it over time, many, many times, but this is just such an important trait to capture. And a lot of it's going to come down to your goals-based investing, right? What are your goals here? If you do want to be more speculative and you want to take more of a chance, then a SpaceX type investment, that's where it can start to make more sense. But if you're that retiree who is counting on your $1 million to get you through retirement, maybe you don't even have a pension at this point and you're counting on that. Well, we're going to be really concerned about sequence of returns risk, which is when the market goes down and you need to withdraw money from that retirement at that point. Now you're facing a double loss, and that's where concerns can happen. So maybe someone in that seat, they may not want $1 million in SpaceX. They may want $1 million spread out, diversified in different vehicles, some protected, some not protected, so they can still get the growth over time to keep up with inflation, which we saw come in at a little above historical average here recently. But we just want to be more aware of what is that situation. I can take more risk in that retiree, and so just looking at that based on how we're going to look to actually invest within that portfolio.
Joe, really appreciate you taking the time to talk to us this morning. Joe Schmidt, CEO of Peak Retirement Planning. We've got a lot more for you today on Trading 360 as well, so don't go anywhere. We've got the big three coming your way. 3 stocks and 3 charts for you this morning. Rick Ducat will be taking us through the technicals. Jessica Inskip is joining us to take us through the trades for GE Vernova, IBM, and Microsoft. That's next on Trading 360 on Schwab Network.
Trying to hold. I have a profile visit.
Moving fast. Are you ready for what's next? Join Schwab's panel of experts on Thursday, June 25th for our 2026 mid-year market outlook. From global energy spikes to volatility to inflation and the 2026 IPO landscape, get the insights that investors need for the second half of the year. Join us on Thursday, June 25th at 7 p.m. Eastern here on Schwab Network. Have you ever watched an interview and thought, I wish they had 5 more minutes, or I want to know how they discovered that hidden gem? That's exactly where Market Matters comes in. I'm Marley Caden, and our podcast is slowing things down. We're going beyond the earnings to get to the heart of the people and companies driving the global economy. If you want the full story, not just the headlines, Market Matters is for you. Subscribe wherever you get your podcasts.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks and 3 charts for you. Rick Ducat will take us through the charts. Taking us through the picks today, Jessica Inskip, Director of Investor Research over at stockbrokers.com. Jessica, great to have you back on the show. Would love to get your thoughts on this market setup that we have. We've got some earnings coming our way after the close today. We've got PCE later this week. We've had our new Fed chair have his first meeting since last we spoke. And what are some of your takeaways?
Yeah.
That is certainly a lot to discuss. I think
We're at
what's
the orb.
happened with the Iran conflict, first of all, has given us the 60-day period of increased headline risk.
Yummy.
It seems like markets are really looking through the conflict because oil is down and it remains down, and that's boding very well. We've talked about this really strong earnings picture. That's going to be tested with the AI narrative tomorrow with Micron. But more importantly, with Kevin Warsh, since we last discussed the interest rate environment, if you will.
I'll be back.
I believe he introduced a little more uncertainty. He told us about his task forces. He alluded to more of the price stability part of the dual mandate, less away from the employment picture. So as we're digesting data and understanding how that's going to impact markets, that's really the big unknown for me. But what I'm flagging is the 2-year yield continues to hit new 52-week highs. The 2-year yield always tries to front run the Fed funds rate. So that tells me short-term inflation expectations are elevated, but it's peculiar when that happens and the stock market is rallying. So we've seen the 2-year spike while the stock market's rallying, and then today, as the stock market is falling, but today it just looks like a rotation out of those very large moved tech names, if you will, really tied to storage and analog. So I still think we're in a healthy environment, but it's that uncertainty that, of course, we want clarity on. But when we have uncertainty, it creates volatility, it creates term premium, moves across the market, if you will, Marley.
It sure does. I mean, and let's move on to your first pick then, because we're looking at GE Vernova down considerably more than the broader market today, pretty much giving up all of its gains that it saw in the last month. But I mean, it is still maintaining a 60+% move to the upside year to date. So walk me through your thesis on GE Vernova.
Sure, and I believe this is part of that rotation of those that just held that run up, are rotating out, especially from what happened overnight in South Korea. GE Vernova, I believe, is the leader in the infrastructure and the AI data center build out, and the demand for that is astronomical. There are some wonderful, wonderful numbers there, but the thesis, what makes them stand out to me, is they have above average earnings in comparison to their peers, and then they have a higher margin trajectory. So I absolutely love that. If we think about the infrastructure about the U.S., it really hasn't been updated in some time, and that's why a lot of stocks tied to that are having this upwards momentum, if you will. Because of this AI-driven electricity demand, they benefit from those longer-term trends, but more importantly, yesterday that big headline was between Microsoft and Chevron and Project Kirby, the 2.7 gigawatts that highlights growing hyperscaler demand. They're supplying a majority of that generational equipment, or that generation equipment, if you will. So that is more of a longer-term trend with electronification. This is just another headline or news story that's going to back that investment thesis. And then again, from a fundamental level, they continue to beat earnings comparable to their peers and have a wonderful margin trajectory. So as we build out data centers and have those larger electricity needs, because compute is really the bottleneck, I think GE Vernova is one of my top picks for that.
All right, Rick, and as we look at GE Vernova and the moves that we're seeing here, and I mentioned it's given up some of its gains, it's lost some of the momentum we saw. What are you seeing in the technical setup?
Well, kind of a situation that matches the broader markets that we have also experienced recently, which is that we hit some notable highs, but our second rally failed to eclipse those initial highs. In this case, we had our high point come in 1181.95. Now we've had a bit of a drop off here, so our gap level to watch out for would be around 1109. If we were to fill that gap, that would be a notable point to be considering here. We also had a couple of highs, a few highs rather, that took place right around 1088 as well. To the downside, we had another smaller gap, in this case 944, a bit of a decline to the downside it would take to get to that point, but that's another gap area that stands out potentially. Extreme lows during our downturn here near 855, as well as this double bottom down here near 805. So these would be some longer term, more expanding price ranges to consider here, but just trying to talk about the notable areas that we see here in our current setup. So we've fallen below our 5-day weekly EMA in dark blue here. That comes in at 1055.94 at this point here. So the next potential area of support based on our moving averages would be our 21-day EMA in teal right here near 1007 roughly. Our RSI, our measure of momentum, even though we did take out our longer term downward sloping red trend line, our shorter term green upward trend line has been broken. We still remain above that 50 midline though, so still more of a bullish tilt. Finally, our volume profile study in this case shows that we have a node that we are on the verge of dipping below 1040 to 1100 is where the heavier trading activity range comes in. Meanwhile, the next concentrated area is around 980 to 1010 or so. A smaller node kind of doesn't stand out quite as clearly, but that's kind of the notable areas from this perspective for the current time.
Yeah, GE Vernova right now trading at 1,048.74, down about 7% so far on the session today. Your next pick having a really nice move to the upside. I'm not sure if you picked it before or after seeing the 2 price target upgrades that it got this morning. We got Morgan Stanley coming out saying investors should be scooping this up right now. JP Morgan upgrading it, also giving it a price target hike, and we're seeing a really nice 4.5% move to the upside. So take me through your thoughts on IBM.
Yeah, I've liked IBM for some time. We've actually talked about it maybe for a couple of years on this network, to be honest. But it's part of the enterprise theme with artificial intelligence. We want to know who is going to be the winner from an enterprise perspective, who's going to be the winner from a consumer perspective. But IBM is more than that. They have this consulting arm, which was some of the flags that caused the sell-off earlier this year. But because of that consulting arm, it means when you have enterprises with these existing relationships, you're already in the room when they're making that decision with artificial intelligence, which gives them a leg up. Now, they also have exposure to tokenization, which is a broader theme, as even today, my takeaway from South Korea is how globalized the markets have become, and now other markets are impacting us. So normally we're the ones leading that charge, and tokenization, I believe, is a piece of that because it's broader access to the markets. And then, of course, quantum computing. But what I think a lot of the upgrades came from today is they joined OpenAI's Daybreak Cyber Partner Program. So they're AI-driven cybersecurity partner programs. There's a lot of those happening with Mythos now, one with OpenAI, and that's going to bode very well when we're thinking about enterprise adoption. And the risk that I see with this, which actually leads me to my next pick, which we can talk about in a moment, is there was a study that suggests 91% of enterprise executives struggle to understand AI dependencies, and that's been a risk causing to the backlogs or putting those deals through with IBM because of the executives not understanding exactly what those are, which I think is an interesting new narrative on this entire AI story because it's ultimately adoption and where those revenue dollars are going to go. But again, IBM is in the room. They are one of my top picks for enterprise, and it's because they partner with all of the AI models. You're not choosing one very specifically, and again, it's exposure to tokenization, quantum computing as well, and now cybersecurity.
All right, Rick, so as we look at IBM here, we are year-to-date down, but having a nice day today on a down day in the markets. We moved I think we moved entirely into the red. The Dow also now in the red as well. What are you seeing in terms of the technical setup here?
Kind of up and down at the same time is a funny thing for a quantum computer, kind of, encapsulates the whole idea behind it in some ways here. But we can see 258 would be a notable high point here. That's around where we had a breakout as well. And we've managed to hold on above that level here too for now. Today's push to the upside did fill this smaller gap that we established here. If we were to look more toward the downside, this more recent gap would then be filled near 253. These gaps are something that traders often keep track of. They can come back into prominence sometimes far later down the road, and they act as notable potential support or resistance areas. Another low point here near 245 that was tested a couple times and held firm at a relative low. To the upside, we have these relative highs just shy of 280. Then not really a ton of clear areas to consider to the upside. We had this very sharp decline here after our highs near 332. So kind of an interesting setup here because we are breaking above this very steep downward trend line here. So the next potential resistance area would be around that 280 level based on our horizontal price activity. Our moving averages are largely clustered together between about 258 to 266. So these clustering moving averages oftentimes are indicative of sideways price activity, but not really so much in this case. In this case, we've had the other way that can happen where we've had such extreme volatility that the moving averages are kind of confused is maybe the best word I could say, where they're not really finding a direction very well at this point. So they're kind of finding themselves, congregating toward each other. So for now, our long-term 251-day EMA in orange, that represents 1 year near 261, is the most important one to keep track of, and we do remain above that one as well right now. RSI invalidating the downward sloping red trend line and on the verge of crossing back above that 50 midline, so that would again be more of a bullish development if it were to happen. In this case, our volume profile kind of has two distinct areas. The first is down here. It contains our point of control, our thick red line that shows the area of heaviest trading, 240 to about 260 with the point of control coming at 258. We remain above that level. We have a bit of a gulf then until 280 to 310 is the heavy trading area. More specifically, you could say that there's nodes here around 285, 290, and 305 roughly, but just kind of a big heavier block of trading activity in general is in that range.
All right, and IBM right now at 263.73, again about 4.5% higher this morning on those two price target adjustments to the upside this morning. That's from Morgan Stanley and JP Morgan. Your last pick here, Microsoft. We had a big deal come out of Microsoft yesterday. Seeing a nice continued move to the upside. We're up about 1.5% right now. So walk me through your thoughts on Microsoft.
Well, with Microsoft, I feel like on the street, we've been waiting for them to innovate and compete with what we're seeing with Claude Cowork or Codex on the OpenAI side, and certainly haven't seen that from Microsoft. But what I've realized is we need to be a little more open-minded, and of course these deals are a testament to that. It brings me back to what I was saying with IBM. The study that 91% of executives aren't understanding the AI dependencies, but if we look at where the enterprise contracts are, they are with Microsoft and Microsoft 365 and Copilot. You can see Copilot surpassed over 20 million paid seats. Their enterprise or commercial backlog was up a record 627 billion. So that tells me that's where the enterprise adoption is. And I think as a society, so a little abstract on you here, Marley, we could become such power artificial intelligence users. And my parents are just now using ChatGPT as a search engine. Whereas in my AI usage personally, I've got AI agents that are gathering information for me automatically that I can do from my phone that connects elsewhere into a Slack channel with other people I work with. That is an extreme use case. And if we think about adoption of the internet or any type of productivity gain or new technology, it takes time, and it takes time with the masses, and that's what we're looking for with these big capex spends, is where is revenue going to translate over. So if we're seeing this is where enterprise adoption actually is, even though it may not have the coolest bells and whistles of those power users, that doesn't matter. It's where the revenue is and where the commercial backlog is. So therefore, I think the sell-off was overblown. We are certainly seeing more with Microsoft now that we are with these deals, and they have a really broad enterprise distribution channel that certainly could help with the free cash flow story. So I think Microsoft is a buy here. I've been away from it for quite some time, but I'm happy to get back into the position. You can do that via a cash secured put or however you'd like to add that to your portfolio.
All right, Rick, and as we look at Microsoft and some of the pullback that we've seen in this name, I was just confirming it is still the worst performer in the Mag 7 year to date. It's down more than 20%. What are you seeing in terms of the technical setup here? Because Jessica just highlighted some of the fundamentals are very strong.
A notable decline to be sure, but from a technical view, we did not take out our old lows here. We had these lows near 356.28. We also had this area where we kind of had repeated highs, a bit of a short-term ceiling before our breakout. So that gives us a zone to consider between about 356 to 374. For now, it seems like we've held on. We had a dip below that level yesterday, but for now, we kind of are just on the verge of that level, but we're also potentially about to break out from this trend line as well. So a push above the trend line and also a bounce from the supportive area would be noteworthy. Some short-term relative highs near about 381, then some lows that match up roughly with a subsequent high point near about 401. Those stand out as well. 466 would ultimately be a longer-term point to consider, as well as 478 because it was a significant gap after an earnings event that we had previously in January. So again, some longer term price activity areas to consider. But we also, when we see our moving averages, see that our 5-day weekly EMA in dark blue does line up with the trend line here. So a break above 378 or so would be noteworthy from two different perspectives then for that particular reason. We can also see our 21-day EMA representing 1 month in teal there comes in just shy of 400. So another area to watch out for to the upside. RSI is kind of jumping the gun a bit ahead of price here. We did not cross into the oversold area, which is more of a bullish sign, and we are starting to break above our downward sloping trend line. So, typically you want to wait for the price activity to act first here. The price is always more important than these ancillary indicators. But something I did want to point out, though, just that we're seeing momentum start to improve a little bit here with a potential breakout. Now, when we see volume profile, the area that we held firm at recently, lining up with this short range, shows that there's some pretty heavy trading activity here between about 368 to 376. So again, even more emphasis on this as an area of important support. We can see then our next node comes in between about 395 to 425. Point of control, heaviest trading area of all, 401.90. So again, that 400 level really stands out to the upside.
All right, right now we are trading with Microsoft at 200. Oh, it just went away on me. Sorry about that. It's 370 right now for Microsoft today, under some pressure. Moving a little higher, actually. We're up about 1%. Jessica, really appreciate you joining us today for the Big Three and for bringing those picks for us. Jessica Inskip from stockbrokers.com, and of course, Rick Ducat. Thanks as always for breaking down the technicals. Coming up next, we are going to spotlight chip stocks. The Philly Semiconductor Index is pulling back today, but the global memory shortage impacting the space isn't going anywhere. We'll dive into what to watch for with chips when Trading 360 returns.
Moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Schwab coaching is concepts brought to life in the real world.
It's absolutely world class. We have coaches who have been in the industry and around the industry for a long time.
We have different formats because people learn differently at different times.
We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight the recent momentum behind chip stocks, the sector dragging the overall market lower during today's trading session. But the global memory shortage and continued AI build-out has seen this space continue to reach record highs. Joining us now to take a closer look, Tiernan Ray, CEO and publisher of the Technology Letter. Tiernan, great to have you back on the show. Before we kick this off, I do want to give credit where credit is due. Last we spoke, it was in advance of some of the big software names, and you highlighted a couple companies that you said, depending on their earnings, if they were positive and the reaction was positive, we'd have a lot less of these SaaSpocalypse conversations, and it played out exactly how you said it would. So I just wanted to give credit where credit was due there. But today, of course, today let's focus on the semis, because we're having an interesting day, seeing a pullback, really pulling down the broader market today in some of these semi names, thanks to that overnight action in Korea sort of continuing on today into our trading day. We're seeing pretty pressure across a lot of these AI-linked names today. Do you think this is healthy profit-taking, Tiernan, or are we looking at people really starting to question some of the assumptions behind the AI trade itself?
I think it's the former. I think you're exactly right, Marley. Before today, a group of stocks, a basket of mostly AI-linked names that I follow at my newsletter called the TL20, was up over 80%. And if you noticed yesterday, when there were some sell-offs in some of the mega cap names, actually Micron, SanDisk, for example, two large memory names were up for the day. So we took until today for people to dump these names. But yeah, these stocks that are AI linked, especially Micron, SanDisk, Seagate, Vertiv, Bloom Energy, had gone parabolic, as they say, in the past 30, 60 days, just gone straight up. And so I think people are taking profits now.
And as we start to look at the AI trade overall and we start to see some of this profit taking, do you think that people are finally starting to become more selective in the names that they're holding here? Are we starting to actually separate the companies that are returning AI profits right now versus those that are still promising big returns in the future?
I think that people are continuing to try and find what is the next derivative. So, for example, Qualcomm hosts an analyst day tomorrow in New York, and a lot of people are hoping that that stock, which has sat out a lot of the AI rally, will be the next thing to come along, sort of the way Intel at the beginning of this year suddenly became a hot AI trade, right? So people keep looking for the next thing. I think it's more looking for a name that's undiscovered, and they're not always scrutinizing as carefully what is the actual cash flow, because it's a bet on something will happen to profits way down the road.
And let's talk about Qualcomm, too, in their investor day that they've got tomorrow. Tomorrow's a big day. We've got a lot to cover happening tomorrow. But for Qualcomm specifically, what does the company need to say to prove that it actually could be a serious player in this AI ecosystem? Because, I think people think Qualcomm and they think smartphones. So what does management need to say to convince investors that they can expand into AI data centers and enterprise successfully?
You're right, Marley. The majority of revenue is still from smartphones, which is an area that's under pressure because the cost of memory hitting the potential for smartphone sales this year. And so what they need to do is what every other chip company has done. So NVIDIA, Broadcom, AMD, Intel, they're all talking about a number that is linked to what they will make at some point in the future from AI data center chip usage. If Qualcomm can come out with a number tomorrow, a line item, and say some point in the future, maybe it's 2029, maybe it's 2030, we will have such and such billions of annual revenue linked to AI chip data center related sales, then I think a lot of people will take that as a good sign. They'll say, okay, so now we have something that we can sort of believe in, is that if we wait 2 to 3 years, we'll get this kind of payoff. And it'll be itemized, and every quarter we'll get an update the way we've been getting from Broadcom and NVIDIA and AMD and Intel.
All right, let's take through the other things happening tomorrow, because NVIDIA has a shareholder meeting, which generally I don't know would be top of the radar for any of us. But this one coming at a particularly interesting time with NVIDIA's recent performance. It's lost a lot of momentum. It's trading down over the last month here. And there are some governance and regulation things that are up for vote at the shareholder meeting that could draw some public attention. So how are you looking at this meeting?
It's interesting, Marley, because every single one of the propositions in the proxy statement starts out with the statement that this is the richest company in the world. It's the biggest company, right? It's a $5 trillion company. And so everyone is putting pressure on NVIDIA to represent a whole bunch of different values and perspectives. On the list are, they want a technical vote on reduce the requirement for a supermajority vote on propositions to a simple majority vote. But more specifically, they want statements from the company about looking into the protection of employees' freedom of faith. These are risks to people's religious beliefs in the employee base. They also similarly want an investigation of, is DEI, diversity, equity, and inclusion, holding back opportunity for employees? And third, they want some kind of disclosure, further disclosure from the company about its greenhouse gas emissions. So there you have 3 very big kinds of cultural values and perspectives that these proxy arguments are saying should be addressed by the largest company in the world.
We don't have have earnings coming out from NVIDIA until the end of August. They'll be on the tail end, and we may hear from Jensen Huang in the meantime there because he speaks when he wants to speak. But do you think that any of these have the potential to become a meaningful distraction for management or become a focus to the public?
I think Jensen Huang is so beloved and trusted by the shareholder base as a founder CEO. That's not true of every company, right? That's not true of AMD and Intel at the present. This is one of those legendary CEOs that the momentum is to go with the board recommendation, which is to vote against all 4 of these proposals. And it's kind of in Jensen we trust, since this is a company that keeps delivering, for which estimates keep rising. Even if the stock has been, sort of lagging the broader AI trade, it's in Jensen we trust.
I mean, certainly, and the numbers speak for themselves, whatever the reaction is or not. They've been growing at a rapid acceleration. Before we have to say goodbye, I want to talk about the third event, Micron. We're getting our earnings from Micron. I mean, they've had good, arguably great numbers in the last several quarters, but they've been met mostly with moves to the downside in the 24 hours post-earnings report. What are you looking for from Micron tomorrow? What does Micron have to do differently this quarter to get a positive reaction from the street? Because we've already seen that good numbers weren't good enough.
Right. Every quarter, for about 3 quarters in a row now, Marley, there's been a tease, which is that CEO Sanjay Mehrotra says, this is a cyclical industry, and everyone worries about the fall off in prices at some point. But I have inked these special deals called long-term agreements, LTAs, with customers to lock in prices and demand for years into the future, but I can't tell you about them. I can't tell you what's in those agreements. And every quarter, the analysts sort of dutifully write up their LTAs, but we don't know what's in them. And it's building and there's a lot of expectation now attached. And it might be the case that Sanjay Mehrotra, the CEO, needs to finally sort of open the kimono and talk about what is actually in these agreements, what's the extent of the agreements, and can you peg it to something definite as far as maintaining prices in future and ensuring demand?
Yeah, visibility could make a big difference here. We'll see how closely those cards are played to the vest tomorrow. Tiernan, always such a pleasure to talk to you. Love having your insight on the show. And next time we check in, we'll see how it stacks up against your software calls, because those were spot on. Tiernan Ray, CEO and publisher over at the Technology Letter. Coming up next, we've got the Disruptors. George Tillis will join us to take a closer look at Synopsys after an upgrade at Piper Sandler. We'll have a full breakdown on that call and an example trade for you coming up next.
Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
How's it going?
First day, so sometimes,
Next.
try it again. You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for the Disruptors. George Tillis, Senior Markets Correspondent here with today's company. We're taking a closer look at Synopsys after Piper Sandler upgraded the stock to overweight this morning. George, seeing a nice move to the upside. We're up about 1.25% right now in Synopsys. What do you make of this call?
Well, I think the call is actually interesting. I've been watching Synopsys, trade. It's actually not traded very well, to be honest with you. In the last year, it's relatively flat, even year to date. Some of the competitors include Cadence Designs, and if you look at that stock, that one's up about 30 or so %. So I think this is the situation where we have some single stock issues, and this may be overcome considering their business as well as what Piper Sandler elaborates on in their call. But essentially, if you don't know, Synopsys is one of these larger electronic design automation companies. They design integrated circuits, verify chip group systems, and unify systems together. But their mainstay customer is actually Intel, and you would think based on the performance of Intel this year that Synopsys would be moving in sympathy with them, but it's not been the case. And the reason being is and this is what Piper elaborates on with their upgrade to overweight from neutral, and their price target increased to $550 from $450. They do see an actual turnaround for Synopsys, considering the concentration customer risk for Intel, because there are a lot of delays. There have been a lot of delays in Intel's 18A node systems, but they also see that some of the bottlenecks that Taiwan Semiconductor has in their manufacturing here domestically in the United States will open up an opportunity to accelerate the 18A node program for Intel. And of course, Synopsys is the primary designer of those circuit node technologies. So they actually see the constraints of Taiwan Semiconductor as well as the catalyst from Intel actually manifesting going forward. So they do see some opportunity now in the stock, which I mentioned just a moment ago. If you look at the last 6 months or so, really hasn't done very much considering what's happening in the AI build-out.
I mean, it's very interesting, too, as I was reading this note, how much of it is tied to Intel and the success of Intel's foundry operations and this new 18A-P chip that we were talking about going into risk production. I think we talked about that last week. But an interesting narrative here. As you're looking at Synopsys and the year-to-date, I mean, it's pretty much flat. How would you go about structuring an example trade here, George?
Yeah, so, I mean, first off, I mean, the stock may be considered underpriced relative to value right now, but right now also the momentum is relatively stagnant. Like I said, in the last 6 months, it really hasn't done much. It's really kind of pinned between its 200 and 100-day moving average. So absent a catalyst or, at the very least, some positive price action, what I'm going to do in this case is I'm going to look at reflecting the last pivot low in the stock, which is right around the $445 area, just going back a couple of months ago. So I'm going to use that as a proxy or a level of support or a shelf of support, if you will. And I'm basically going to sell, because volatility premium right now with the VIX above 18 is high, I'm going to sell a put spread. So I'm going to sell the July expiration 24 days, 445 put, and then below that I'm going to buy the 435 put to offset the risk. And you can earn about $3 a share or $3 in contract credit. So the whole premise behind this trade is that if it does settle once again closer to that pivot low of 445, that's fine, because that's essentially our max profit level. In case it falls below that, with the overall market, 442 is your break even, and your risk in the trade is $7 in lieu of $3 of profit, and that only occurs if the stock hits 435 or lower by expiration in 24 days.
All right, we are at 470.66 right now with this move to the upside following this call from Piper Sandler, up about 1.33% right now. George, really appreciate you taking us through that. And for the example trade, I'll talk to you a little bit later today on Market on Close. I want to pivot now to the travel industry. We're looking at Carnival today, under pressure this morning as higher energy prices have weighed on the company's profits for the first half of the year. Carnival did lift its full year earnings guidance this morning by just a penny, but that wasn't enough for the streets. So let's bring in our panel to take a closer look here. Joining us now, Asya Georgieva, the CEO and founder of Infinity Research, and Chris Wong, Director of Research over at Runnymede Capital Management. Asya, I'd love to get your thoughts here. I mean, as I'm looking at Carnival, we're down about 5.5%. So we have recovered a little bit from the initial reaction to these numbers. But I mean, as we're looking at them, Carnival had record revenue, record profitability, record customer deposits, but we are seeing the stock move lower today. What do you think the street is focused on that's driving this downward move?
Oh, that is correct, Marley, and thank you for having us. But of course, we are a forward-looking crowd, and the issue that led to the stock being down was concern about the reduction to the second half of the fiscal year guidance. And it was pretty extreme, basically from an expectation of about 3% yield for the back half of the year. They're now guiding us to sort of 1%, just over 1% yield. So that's a pretty significant revision. And I believe that some of the revisions to the stock action may be due to the fact that the investor community realizes how conservative Carnival management has been under CEO Josh Weinstein. They also quoted in the press release 93% book position for the balance of the year, so very little inventory left at risk. They did mention that probably they'll have to sacrifice some of the nice occupancy that they had built in order to protect price integrity to us. This is a critical strategic move. Do not get yourself into this, continuous discounting mode, because they are very difficult to reverse once you condition the consumer to expect lower pricing closer to the voyage. Again, it takes a long time, and we've seen Norwegian, one of the competitors, really struggle with that, and now saying it'll take them until 2028. And so I think that was probably the reason for the initial stock reaction. What I find very interesting, and I've mentioned this before, we track about 40,000 voyages at each of our bi-weekly measurements. So what we had seen since the start of the war was the initial 3 weeks through March 20th of everyone just kind of being frozen. So nothing was happening with pricing really. And today Josh mentioned that sort of cardiac arrest mode. And since then, the destinations that this year are seeing the largest capacity increases, the Caribbean and Alaska. We're seeing these price increases across the board at Carnival, at Royal, at Norwegian. So it was very encouraging to see that demand was there, but it wasn't going to go to Europe, especially North American demand. So we saw this rotation for the time being for this fiscal year into the destinations that really need that demand because of the capacity increases for the industry. And what I found very encouraging that we heard from the call is that demand for 2027, including for Europe, is extremely strong. So in addition to rotation at present, we're also seeing a time shift into 2027. So again, I think both of these are very positive trends, and management tends to guide very conservatively. So we're not quite as concerned, despite seeing a little bit of a slowdown the last two measurements that we took. So that's kind of our view.
All right, and Chris, I want to get your thoughts too, both positive and negative takeaways from what we learned from Carnival this morning.
Sure. I mean, on the headline, they definitely beat. They beat on the EPS line, outpacing Wall Street estimates. They put in 41 cents per share versus the street at 34 cents. And on the EBITDA line, they also came in well ahead of street. On the top line, they did fall a little bit short, but it clearly showing that they're having internal cost controls that are coming in very strong, and the team is doing the best they can managing inflating costs, especially on the fuel side. Obviously, the concern is on net yields. They really pulled back guidance, dropping from 2 3/4 down to 1 3/4. So a pretty big cut in guidance there. Management tried to walk that back a little bit during today's conference call. They noted if you stripped out the Arabian Gulf redeployments and also one-time accounting alterations related to their loyalty program, the actual number is around 2 1/4. So it's not quite as drastic. I think maybe Wall Street takes that with a grain of salt. It's still a cut in guidance. So there is worries about the future here in terms of net yields.
Yeah, Yeah, and Chris, I want to stay with you here for a second. Cost control certainly was a bright spot here if we exclude fuel, but historically, unlike competitors, Carnival doesn't hedge its fuel costs. So, as we look at the second half here, we don't have a full-blown peace narrative in the Middle East. We don't have any guarantee that we're going to maintain these lower prices here. How are you looking at this with Carnival's outlook, the uncertainty tied to these fuel costs?
Yeah, it's always a concern when the deal's on, the deal's off, and I think it's still really not a signed deal here. With their unhedged fuel costs, you do have this more volatile. You're going to have some volatility in the cost trends going forward. I think one thing that the street is worried about is Carnival admitted that their booking trends only recently started seeing a turnaround. And if you look back to Royal Caribbean, they actually saw a bounce back in April. So why is Carnival lagging there? I think that is a question. And then going forward, hey, if we can come to a Middle East deal, Carnival will have that big trigger because they don't hedge their fuel costs, and you could see a big fuel savings there.
Yeah, but even with this move to the downside for Carnival, we're down about 5.75% right now. They are still up almost 10% on the month. They've had quite a bit of momentum alongside a lot of these other travel names. Really appreciate you both joining us to take a closer look at these earnings that we got from Carnival and the market reaction to them as well. Asya Georgieva, the CEO and founder of Infinity Research, and Chris Wong, they're the director of research over at Runnymede Capital Management. Also want to thank all of you for being with us today on Trading 360. I'm Marley Caden. You can download our free Schwab Network app in the Apple App Store, and you can tune in 24/7 on schwabnetwork.com. I hope you'll join me on Market on Close today at 3 Eastern, 2 Central, but don't go anywhere. Fast Market is coming up next.
Schwab, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Schwab coaching is concepts brought to life in the real world.
Schwab coaching is learning constantly.
It's relatable, it's practical,
Clear, understandable,
and hopefully entertaining. Take it for what it's worth, but I think it's absolutely world class.
Schwab coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab coaching is that clients get access to 9 different sets of expertise.
We want to engage with you in chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We going 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome to Fast Market here on the Schwab Network. I'm Tom White. Diane King Hall has the day off today. Tech is under heavy pressure, but overall stocks are off of their session lows. Let's take a quick look at those major indices. We're about halfway through the trading day. The S&P 500 down 1.1%. Dow Jones Industrial Average actually popped back into the green on some strength in some of the banking stocks and some others in that 30 stock index there. Price weighted, keep that in mind. NASDAQ 100 down 2.8% off of session lows, and the Russell 2000 small caps down nearly 0.7%. Here's the roadmap that we got for today's show. We'll take a look at example option strategies for Alphabet as shares dropped to 2-month lows just yesterday. A little bit of weakness here today. Cash tags today is FedEx ahead of their earnings after the close. And for the breakdown, George Sillis, he's going to join us to take a look at Cerebras ahead of their first earnings report as a publicly traded company here. Now that we've got the roadmap for today's trading action, it's time to bring in my co-host, and that's Kevin Hinks. And he's joining us live from the SIBO. And then also joining us is Joe Mazzola, Director of Trading Services at Charles Schwab & Co. Let's get a quick look at markets here. Kevin, I'm going to go to you first here. We're weak across the board, right? The Dow is actually positive, but at the same time, we're off of lows. But this is all based on tech, right? Not all the S&P 500 sectors are in the red at this point, but it just feels more painful when tech's leading the way to the downside.
Yeah, it's not what down. It's not that, if you look at the overall S&P, it's actually 6 up, 5 down. But what's down, Tom, is very important. Tech just getting hammered, especially memory, which has been so strong, leading this market up. We've been reporting on all morning. South Korea, the Kospi was down 10% overnight, down 20% off its highs, from its highs. Samsung and SK Hynix were down 12% overnight. Ironically, that didn't really bleed into the European markets and the Japanese markets. They were down, but not nearby by the percentages that South Korea was down. But that still hurt our stocks pre-open. We made a nice comeback after a down opening, but now we're heavy again. Down about 1% on the S&P, down about 2.6 on the NASDAQ, Tom. So we're off our lows, but certainly this is a red day. That said, Tom, and looking at this, I still have 6 sectors in the S&P 500 or higher and 5 lower. So in my opinion, this still looks like a rotation out of those high profile names that we've been talking about and into some of the others like consumer staples, like healthcare, like financials, all positive on the day. And so all things considered, Tom, I think this is, now the numbers are getting big here, Tom, because of how far these memory stocks and chip stocks have run. But this still looks to me like a rotation.
Yeah, you're not getting that broad-based selling because there are quite a few stocks that are actually green today. As we mentioned, the Dow still positive on the session. But Joe, when you take a look at this, and I think a lot of the weakness that we've seen in the mega cap tech names, remember they've got that big weighting in the S&P 500 and the NASDAQ 100. They're the reason. But is it CapEx spend? I heard a figure today, over $750 billion by the hyperscalers, the big tech companies are going to be spending this year on CapEx. And that's been a concern for this segment, over the last month or so since June started, basically.
I'm going to go back to an old fundamental term that fundamental analysts use. It's called return on invested capital, Tom. Sometimes we forget about that. Sometimes we just look to see, hey, what is the growth rate? What are expectations? And we forget that investors demand some point you show them where that return is on the capital that they're allocating towards the companies. And something we talked about a little bit earlier, it's just when you start looking at the hyperscalers and the reason that they've been so attractive to investors over the last few years is because of their sterling balance sheets, because of the fact that they have growth, but they've not only had that growth, but they got a tremendous amount of free cash flow. When that free cash flow starts to be used for a couple things like expansion in terms of their AI spend. What does that take away? It takes away from one thing that investors have counted on the last few years, and that is stock buybacks.
Yeah.
And we're starting to see those maybe start to dwindle a little bit. And when you have that in a combination with investors now asking in terms of what are we paying for this growth and is it worth it, you're going to have some bumps in the road like this. But one of the things that you and Kevin were talking about a little bit earlier was that this is not a across the board sell-off. This is a rotation. If you look at something like advanced decline lines today, they're positive. Right, there's more advancers than decliners, not only in the S&P 500, but if you want to broaden it out and look at, say, something like the NYSE, there's still more advancers than decliners. So it's, when you're looking at heavy market-weighted caps like we are right now in terms of the indexes, you're going to see weakness on a day like that.
Yeah, and you can look at just the S&P 500 equal weight index. That's barely in the red by less than 0.1%. So not that full-fledged sell-off that we are seeing. But Kevin, Joe made a good point here, because we've all been used to seeing these hyperscalers, these big major tech companies have rock-solid balance sheets, but now they're starting to take on debt to finances. Is the AI infrastructure build-out that these companies are basically saying we have to be at the forefront of this? We're ramping up CapEx spend through this year into next year. Is it going to be monetizable? Is AI, Kevin, maybe seen as that segment within technology moving forward that you can't be late on because it's going to be a game changer, even more maybe than the dot-com era from 25 years ago?
Tom, Joe, what I just think is it brings in more uncertainty to the future, right? When NVIDIA is raising cash and making cash and booking a bunch of cash, you feel pretty good about the company. But now, that being said, these companies are not really having a problem raising cash. We're going to talk about Google Alphabet. They raised cash pretty easily when they went to the debt market. So I would start to be concerned. Make no mistake, using your free cash flow, having to go to the debt markets is a change. It's a tone change for some of these companies. But it's not in big red, bright red flag alarm unless they have trouble raising those funds. And the fact that Google Alphabet was so oversubscribed and NVIDIA is raising cash and they seem to have no trouble doing it, that's a little bit of a vote of confidence. Like I said, it is a tone change from massive cash generation to actually using so much of your cash. But we have to trust these CEOs that they're using the capital that they have and the capital that they're borrowing the best way. If you don't trust them, that's another issue. And obviously some are going to do it better than others, but I don't see this as a problem, though it is a tone change, guys.
And you start looking at the valuation, some of them getting pretty low. NVIDIA now 23 times forward earnings. That's cheap compared to its competitors, AMD, Intel. Joe, you look at that, Microsoft had been on a downturn, turning around a little bit, up 1.5% today. Amazon's had been weak. So it's been almost a reset where now you better show us what all this investment's going to do to those companies. Are you going to be able to monetize it? Are you going to be able to continue that growth rate that you've got that you've had over the past couple of years?
Yeah, and if you look at rotation, it's not just into staples and healthcare. There's rotation within tech today, right? There's some bid in the software stocks that have gotten hammered, and this is just, Tom, this has been a trade that's played out multiple times in the last couple months, where when you see the semi weakness, when you see the chip weakness, that money has tended to flow into software and vice versa. I think it'll be interesting tomorrow with Micron earnings to really kind of see if the market can get a boost from that. I mean, because remember, Micron's down big today. I think it was down 100 points last time I checked. But at the same time, it was up $95 a day before, right? So these are big swings, and the expected move going into earnings is somewhere around $150, $160. So it's not unheard of to see that type of volatility from a stock that was trading around $350, $400 just what, 3 months ago. So we've seen incredible moves. I think traders, investors are probably getting, I don't want to say immune, but maybe numb a little bit to some of these moves. And we'll see if as the day goes along, if you start to see some dip buyers coming. It looked like they were starting to do in the middle of the morning, but then they kind of faded.
Yep, looks like they're trying to re-accelerate that. The S&P now down just under 1% right now. So dip buyers out there a little bit. Let's switch to some individual corporate news here. On the analyst call front here, Kevin, IBM with an upgrade out of JP Morgan, $291 price target. You know, the old big blue that we used to complain about a few years ago, Kevin, has seen a re-acceleration. I mean, this stock was 170 bucks 2 years ago. Now trading about 20% off the recent all-time highs that we saw just a couple of weeks ago, but an upgrade here in IBM. What was your take?
Yeah, kudos to IBM that over a long period of time has transformed their business. And their software business now is roughly 45% of revenue, but generates about 2/3 of the profits in software growth. Growth is expected to be fueled by AI-driven container adoption. So this is a company that has hung around, changed itself, and now seems to be a player again, and getting really bullish notes from JP Morgan, raising the price target to 291 from 270, overweight from neutral. Yeah, really good news JP Morgan putting out on IBM, a name that, Tom, for years and years, we barely talked about this name, and now it's moving itself right back into the forefront of AI. Pretty incredible.
And on the other side, we got retail here, Joe. I want to get into a discussion about a couple of moves from Wolf research analyst. Target, upgraded Target to an outperform from peer perform $162 price target. But on the flip side, that same analyst downgraded Home Depot. So it's almost like the consumers held up pretty well in this inflationary period, but at the same time, there's probably going to be winners and losers within the retail space.
I think you need to keep an eye on housing. Housing has firmed up a little bit in the last couple of reports, but overall, I think that housing's disappointed a lot of investors in terms of their turnaround. There was expectations that rates would be lower than where they were. There was expectations that you would see lower mortgage rates, and then that would kind of trickle into the housing sector. What we've seen recently is there's been almost this kind of dynamic where buyers now have just come to the realization that they might not be down in the fives anytime soon, right? So, you know, there's some built-up demand. It's the first time we've started to see that, you know, kind of trickle back into the market in the last few months. Could that benefit a stock like Home Depot? Absolutely, especially on the commercial side. But we still are dealing with something you and I talked about a little bit earlier today, and that's the difference in terms of what the economy is doing versus whether or not those wages are making their way back down into the consumer. And we just haven't seen that yet. We haven't seen the wage growth. And for consumers who are in the markets, right, they've actually seen their wealth value accelerate. But if they're a first-time home buyer who doesn't have a lot of money in the markets, that has hurt them by not having that uptick in wages.
Yep, and you know, I always think back to like when I bought my first house here in Chicago, and I think I paid 6.5% interest rate on that. Now, but you got to remember, housing prices have gone exponentially a lot higher, so there's that affordability issue. But Kevin, on the flip side, you look at Target. This stock got the the upgrade. Stock's up 37% this year. It seems like they've fixed the problems that they had for the last few years. Over the last 9 months, has had a pretty good run. I mean, this stock was 83 bucks in November of last year. Now trading about 134 bucks.
Yeah, you're exactly right. You know, it looks like Wolf Research is talking about the Target Home Depot pairs trade, right? One upgrade, one downgrade. Now, I wouldn't recommend that, but Target, certainly a much better outlook, and they base it all on the new management team shaking up the status quo and doing new things. They noted Target's turnaround has a rhythm they haven't seen in years, Tom. Now, remember, we've talked many times between you and I with like Folio about Target and where they fall in big box retail. And it sounds like there's still fans out there of Target and people that even are fans of clothing at Target. And I think that this company with a new management team and a new idea, You know, this stock has been in the doldrums, Tom, for a long time, as you know. So nice to see a bit of a recovery here in Target, and a pretty good story coming out from a new management team.
Yeah, you know what? Maybe it's back to its Target brand, but at the same time, a lot of the problems that Target had were self-inflicted.
Absolutely.
So definitely needed a little bit of shake-up maybe there in the C-suite, but seems to be working out well in their comparables versus Walmart last quarter. Were actually above Walmart, so making some inroads in that competitive space in retail. All right, guys, let's take a quick break. When we come back, we're going to get into a discussion about Alphabet. The stock was down over 5% yesterday. Weakness as we've seen some of their executives and key people within AI leave their company recently. We're talking Alphabet when we come back.
Is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. I think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
The market is moving fast. Are you ready for what's next? Join Schwab's panel of experts on Thursday, June 25th for our 2026 mid-year market outlook. From global energy spikes to volatility to inflation and the 2026 IPO landscape, get the insight that investors need for the second half of the year. Join us on Thursday, June 25th at 7 p.m. Eastern here on Schwab Network.
Welcome back to Fast Market here on the Schwab Network. It's time for our bull versus bear debate. Let's bring back in Kevin Hinks and Joe Mazzola. We're talking Alphabet. Kevin, I'm going to start with you. Stock's down about, 5% yesterday, down another percent today. We've been under pressure. They've had some key executives leave. A couple of them went to Anthropic. I don't know if the narrative's changed. I think maybe the CapEx story comes into play here, but give me your take here why we're seeing this weakness in Alphabet after hitting highs, all-time highs just last month.
I'll be honest with you, Tom and Joe. I spent yesterday morning trying to figure out why Google Alphabet was so weak. And it took me a while, frankly, to find out this story about Noam Shazer, who left. He's the former Gemini co-lead. He's going to OpenAI. And John Jumper, he was the DeepMind vice president and 2024 Nobel Prize winner. He left for Anthropic. And so the talent-seeking ability of all these companies and hiring away, we saw it from Meta several months ago, trying to hire people away. There's a perception that Google Alphabet may be losing some of the war for talent in AI. I don't know if that's true. I can't tell from two people, but they certainly seem like they were important people. I think, remember, Tom and I, we talk about Google Alphabet a lot in this show, as we should, and I compare them always to the tortoise and the hare, and the things that they're doing with almost getting ready to start really competing with NVIDIA, the things they're doing in cloud, the things they're doing in all different assets of AI, the fact that they own the entire stack and AI, this is a company that is set up pretty well for the future. And like I said, when they did go to the debt markets, it went pretty well. It was oversubscribed. Berkshire, who doesn't part with their money very, very easily, took a $10 billion part of that $85 billion. So I think that's a vote of confidence from the debt markets that they're doing things right. So, it's tricky, right? This stock can languish for a long time. We saw it a year ago, Tom, and then that was about regulation and investigations. When those clouds clear, the stock did extremely well. It's back down to these levels again, so it's an interesting trade idea here.
Off 15% from those all-time highs that we saw in mid-May. But Joe, you think about it, the growth that they've seen in their cloud business is outpacing their competitors, AWS and Microsoft's Azure, by a lot. Their growth, they were third place, so maybe that's part of it. But then, you look at advertising on search. That was up double digits, I think 15% last quarter, year over year. Advertising on YouTube continues to expand. So all the segments and silos within their company continue to increase and grow pretty rapidly. And that's why the stock probably went to all-time highs. But then you throw in, they guided for $175 to $185 billion in CapEx spend this year. That was up a little bit from the previous quarter that they had announced. But free cash flow fell 47% year over year to $10.2 billion last quarter. So taking on debt, taking on, sticking a lot of money out there in this investment cycle, that's probably why there's some concern here from investors.
I think so, and I'll go back to the point I made before with the free cash flow. What does that pull away from? That pulls away from buybacks. Now, we haven't heard that yet. We haven't heard these companies say that they're not going to go out and continue to purchase their shares. But I think maybe until you do hear that, investors showing a little bit of wariness towards that. It's funny, we were looking earlier at the IBM PE versus, as you mentioned, NVIDIA. I mean, Google's down to about 26, 27 right now, too, in terms of its forward PE. So, some of these stocks are, with this pullback, they've come in a little bit. I don't know the rhyme or reason to it. What I do know is that once the announcement was made on Friday and then Monday the stock reacted adversely, it's going to show, or at least maybe in the short term in investors' minds, it's gone to show that there might be losing some of the AI arms race, as you guys were mentioning. Other than that, it's not a valuation thing. It doesn't seem like it's an issue necessarily with the growth. I think that there's this, once again, looking to kind of figure out how are our investments being paid back in terms of what we're doing with this investment capital.
Yeah, remember, just about a year and a half ago, we talked about this on air quite a bit, that Google Alphabet was the cheapest on valuation of the Mag 7s by far, but now it's not, as it has recovered. Remember, this stock is still, even with this 15% pullback from highs, still up nearly 110% over the last 12 months. So it's had a good run. So maybe a little bit of a reset here, maybe a dip buying opportunity, who knows. But Kevin, you got an example trade for us on the bullish side. Go ahead and walk us through it.
Yeah, this stock, Google Alphabet, has earnings. The Thinkorswim platform says it has earnings on July 23rd. So what's that, a month away from now? So we're certainly cognizant of that date on the horizon, as all options traders should be. Besides that, I went to something that gave myself a little bit of duration time. I went to the July 17th expiration, and I did something in the unbalanced butterfly family, which means I looked at the expected move out to July 17th, right around $24 and change. Let's round that up to $25. I bought the 350 call. I sold 2 of the 375 calls. This is all in July 17th expiration. So buy 1 350, sell 2 375s, and then buy 1 of the 380 calls, Tom, to complete my unbalanced call butterfly. The debit I paid was about $6.90, trading about $6.65 now, so trading a little lower than $6.90. But Tom, this is a chance. If Google Alphabet were to move those $25 up towards $3.75, remember that movement is up or down. If it moves higher, you have a chance to turn this $6.90 into about an $1,800 profit. So, and if it goes further than that, you don't lose all your profits in a butterfly because it's unbalanced. It's a long $25 vertical, short a $5 vertical. So it keeps a lot of those profits on the upside, Tom. But this is defined to the debit paid is the risk on this trade. And Tom, this one, like I said, it gives you some duration for this move to happen.
Yeah, and offsetting some of the costs on this bullish, unbalanced, or broken wing call butterfly to the upside. Let's walk through it. July 17th, monthly options that expire in 24 days. Buy that 350 call. It's out of the money by about $4. Buy one of the 350 calls, sell two of the 375 calls, buy one of the 380 calls. So in essence, buying bullish $25 wide call vertical, offsetting some of the cost by selling a $5 wide one. Paying roughly, you got $690 debit up here on the risk profile. The debit you pay is going to be your risk. So pay $690 per spread. But it's got a good risk reward setup. Now, it does take your break even up to 356.90 to the upside. So you're going to need a move to the upside, but not a percentage basis over the next 3.5 weeks. Not out of the realm of possibility. It avoids earnings, which takes place about a week after the expiration date on this. And as Kevin mentioned, even if this thing does explode and go back above the 380 level, the top end of this unbalanced call butterfly, it's still more than a double in profitability. So looking for a move to the upside on this one, a grind higher with the apex of profitability being at that short strike on the 375 line. So bullish look at here in Google Alphabet. Joe, you've got a bearish take here in Alphabet. Walk us through your example trade.
Yeah, it's put calendar. We're basically looking at the July 2nd expiration, selling the 310 strike to buy the July 17 expiration. You can do that for about $1.10 to $1.12, somewhere within that range. I actually looked at this one yesterday, and I don't think the thesis has really changed. We broke below the 200-day moving average. We're sitting well below the 21-day exponential moving average, which actually kind of broke below the 50 days. So there's a few things from a technical standpoint that aren't looking as strong for the stock going forward. Could you make the case it's getting a little oversold? Yeah, you could, especially kind of given the pullback it's had from the 52-week high of 408. You know, it's had about a $60 pullback to where we're trading right now. But that being said, this trade, or this stock, has been a momentum trade for a while, Tom. And when it kind of runs out of momentum, which it looks like it has for a little bit, it's going to need something fundamental, in my mind, to get it back up to where it was before. Now, what does that mean? That means that if we're looking at these trades, Kevin's trade and my trade, both of them expire before the earnings period. Right. So if the expectation is that you know, we're not going to see some potential market moving and stock moving news prior to that, then my assumption is, at least with this trade, the assumption is that you're going to continue to see that grind down, that drive down towards something around that 200-day moving average, which is right around 15.
200-day moving average. You talked about that. I did.
310 foot butterfly. You still got a ways to go, right? We're still $35 away from that. So that's really about a 9 to 10% move from where we're at right now. So it's not unheard of that you could continue to see a little more weakness grind down into that. The other thing I think is interesting about the trade is you don't need it to go to 310. You need a little bit of that drift down. You got two rolls that you can build within that trade, and if you get those rolls, by the time you have that expiration on the 17th, then you can make your decision as to whether or not you want to close it out or keep long those puts.
Yeah, it's an inexpensive way to get some downside exposure here in Joe's trade. He goes out to that same July 17th monthly options that expire in 24 days, buys the 310 put out of the money to the downside, then against it sells the near-term July 2nd weekly options that expire in about 9 days, that same 310 put. So basically a 2-week wide bearish put calendar as Joe.
So here's the IWM. Bounced off the 200. Boom. Called that one out. We just broke the 200 on the SPX. And we got all the moving averages crossing on the SPY. Double top. They got 2 tacos. 2 for Tuesday. At Taco Bell. Haven't ate at Taco Bell in 5 or 6 years. If I can do it, you can do it too. I don't want to do it.
That's when I kind of realized, like, all right, I have a money problem. This is about how my finances got wrecked and how I fixed it. And if I could do that, you can do it too.
I don't want to do it. I'm not
No
stupid.
politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
When you invest, you are not wagering on an outcome and walking away with either a windfall or nothing. You are a participant in wealth creation. Our purpose is to help investors build and protect wealth over time, not to make financial security feel like Las Vegas. Owning beats hoping. Discipline beats speculation. And the long run belongs to those who invest in it.
Well, they're really pushing that investor today.
Welcome back to Fast Market here on the Schwab Network. It's time for our hashtag segment. For that, let's bring in our next guest. That's going to be Andy Swan. He's a co-founder of Likefolio. Welcome back to the show. Andy, we're getting into a discussion about FedEx. I think the bar's pretty high on this one going into this report, as I mentioned before we went to break, up 75% over the last year, just off all-time highs. The spin-off of FedEx Freight is done, Andy. What kind of data do you guys have out of Likefolio? I'm guessing it's probably got to be positive if your data equates to the moves that we've seen in the stock.
It's had a hell of a move this year.
Yeah, it is. It's positive and it's getting stronger. I think when we look at FedEx, we just see a lot of winning here. When we look at it versus UPS or even Amazon on a year-over-year basis, you've got a very strong plus 30% change in web visits, which have been historically really well correlated with demand growth for FedEx services. It's people checking on their packages, looking at pricing, etc. So it's a really positive sign. And of course, when you look at the demand curve over time and the Likefolio demand in blue on the chart versus stock price, really highly correlated, a really nice push at the beginning of this year to all-time highs in terms of our data. And the company is reaffirming this. Their guidance is strong. They've spun off kind of the dead weight in the group or the company, the portion of the company that was more of a distraction to their core business. And so we think that's very positive going into this. And so, our big conclusion here is that the market has this pretty much right at this.
I'm surprised FedEx didn't do a tranny commercial. Yeah, I said it. So I got that out of the way, my sandwich. Now, it's had a heck of a run. This thing ain't been doing very well, but now it has. We consolidated for 6 years. Seven years. 1, 2, 3, 4, 5, 6, 7, 8. 7 years for sure. So that's up too much. Andy.
On its own, it's got earnings a bit later in the week. Was freight a weight around their neck? This stock has really done well since then. And let's face it, Amazon is expanding their logistics business. They're not going away anywhere.
Oh.
And UPS is struggling to find their role. It's mostly domestic. What is it, do you think, that brought FedEx's stock back, other than they're claiming another $1 billion in savings through AI that they're going to do? Are they becoming more efficient? Are they getting rid of the dead weight? What are they doing that has made the stock so strong, in your opinion?
Yeah, I think it's tough to call it dead weight. It's an effective, good company that they spun off. But I do think it was a distraction from their core business, especially with Amazon coming in as
filters.
Much more of a competitor as they launch third-party shipping, etc. So I think it was a smart move for FedEx to just say, we're going to focus on this one part of our business that's now 95% of our revenue. We're going to get extremely efficient using AI, and we're going to wow our customers with our ability to service them, to make the deliveries we need to make on time, every time. And I think that's what's showing through in our data, is that the consumer is responding to FedEx's focus, and they just simply are beating UPS and Amazon at this point. Now, we don't count Amazon out ever in any industry that they jump into, but the impact on FedEx looks to be minimal right now, and there's a tailwind of consumer behavior in terms of e-commerce, getting things shipped directly to your door that hasn't slowed down at all. In fact, it's sped up. It's become more mainstream. It's become the default way that people shop, and that section of the economy continues to grow. So they have a nice tailwind from the macro consumer behavior perspective. Plus, they're more efficient, more focused, and executing at a very high level. So looks to me like a really good play to spin that off, to focus on what they're best at, and to do it really efficiently. So we like the moves that FedEx is making quite a bit.
Andy, their DRIVE program, multi-billion-dollar cost-cutting initiatives that they took into account, really helping this company because they're executing on that, and they talk about it on every earnings. Amazon competitive, opening up to third-party sellers as far as delivery goes. That initially hit the stock, but it's kind of recovered from there. When you look at this, the inflationary pressures, the price of fuel is going to go higher. The stock up so high this year and over the past 12 months. Are you guys skeptical a little bit just due to the price action of the stock? And what earnings score do you have on this one?
Yeah, we're actually pretty neutral going into this print. I think, the stock is priced pretty well. It's reflective of the optimism that we have, that we see in our data. The other thing I will say, though, I think that just when you look at the market as a whole, I think that there's starting to become a little bit of a tired feeling when it comes to CapEx projects. All of these AI-enabled companies, et cetera, they are ballooning their capital expenditures. They're telling Wall Street to brace for extraordinary levels of increased spending. Well, when Wall Street gets tired of that, and I think that's starting to happen, they start to look for companies that are executing while also driving costs lower. And that's where FedEx comes into play. So I think you could see a little bit, if FedEx can come out on this call and say, look, here's the savings that we've been able to establish. Here's where we think those savings
Andy.
are going to get to. That's a refreshing message for Wall Street at this point.
You don't sound too good,
create,
Andy.
A rotational type of bid.
We're definitely at support.
The FedEx stock. So I don't want to discount that either. I think there's that factor in just market mechanics that could put a nice floor underneath FedEx here.
Yep.
I think Andy has a drinking issue. He still works, but he definitely has a drinking issue. That's definitely at solid support. I don't know if I'd buy it, but Jim, you ain't took your shoes off yet. Had to eat them tacos.
The stock. Andy said they're somewhat neutral. Well, the paper money trade I looked at a little bit on the complex side is just that. It's bearish to neutral. And I'll show you why I mean.
Liar.
First thing I did, I looked at the expected move, looked at where the stock is now. I sold the 345, 355 call vertical, Tom. So right in line with that $20 move, where we are a little more now, but right in line with that move higher. Then I used that credit to purchase the 300 put calendar, the 1 week, July 2nd, June 26th put calendar, and that strike is $300, Tom. And so I've got a call vertical, $20, $22 above the market. I've got a put calendar, $20 below the market. This package together, I collected about 85-cent credit. I think it's trading about 75-cent credit now, but it's still, this package is trading for a credit, Tom. The risk is on the upside, right? You've got a $10 call vertical that if it were to go to $355, that's where the risk is. On the downside, because you did this put calendar for a credit, there's really no risk on the downside other than the assignment and exercise risk that's always in a calendar spread. So
SPXC,
the downside
SPCX.
not very much because of the credit that you took in, but this is a spread that's targeting around $300, Tom. However, the kicker is if it stays right here because you did it for a credit, you're profitable if it stays right in this area, Tom.
Yep, let's break this one down. Complex four-legged spread.
Put an ice cube in my...
Let's start with the June 26th weekly options that expire in just 3 days.
I don't remember if I put an ice cube
Kevin's selling a call vertical. He's selling the 345 call. That's out of the money to the upside, more than that one standard deviation. And then buying the 355 call. So a short $10 wide, neutral to bearish call vertical. That collects a credit, right? That's used to help finance the purchase of the 1 week wide put calendar. In there, July 2nd weekly options expire 9 days. Buy the 300 put, sell that same 300 put in the June 26th weekly options expire in just 3 days. That 1 week wide put calendar as a package, collecting roughly about an 85-cent credit. So what does that mean, right? Well, it takes your break even on this trade to 345.85. So that's where you want the stock to remain below, right? And that's why Kevin says this is bearish, right? Because you can see here from the risk profile, you want it to go at or near the 300 strike where you do the calendar. But at the same time, because you're collecting that credit, your break even goes up to 345.85. So it's still a neutral trade. As Kevin said, stock could stay right here and this will be profitable, or it actually can move higher. As long as it remains below that break even, 345.85, it's going to be profitability. Now, what don't you want to happen? Well, you don't want the stock to go above 355, right? There's max loss on that, about $915 per spread above the 355 level. So there's your risk, is all the way on the upside, more than that one standard deviation that the option market's pricing in. And because you collected credit on it, If this stock falls 2 or 3 standard deviations, goes down to 260, 250 after earnings, you're still going to be able to keep that credit that you collected on this trade, this four-legged spread, as a package. So keep that in mind. So neutral to bearish four-legged custom spread, but at the same time, it's neutral where the stock, hey, you've got more than a 1 standard deviation up to that break even. So good look at a complex four-legged spread there in FedEx going into those earnings, kind of setting up with that neutral bias that Lightfolio gave us. All right, let's take a quick break here. When we come back, George Tillis, he's going to join us and talk Cerebras ahead of their earnings. This is their first one post-IPO. This will be closely watched because the stock has been falling since going public. Stick around. Fast Markets coming right back.
The Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. The market is moving fast. Are you ready for what's next? Join Schwab's panel of experts on Thursday, June 25th for our 2026 mid-year market outlook. From global energy spikes to volatility to inflation and the 2026 IPO landscape, get the insight that investors need for the second half of the year. Join us on Thursday, June 25th at 7 p.m. Eastern here on Schwab Network.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on the Schwab Network. Let's take a quick look at where markets stand before we get to our next stock. The S&P 500 now down just about 1% on the session. Dow Jones Industrial Average continues to move to the upside, up over 0.2%. The Nasdaq still lagging, down 2.6%. Can't catch a bid here, and the Russell 2000 small caps now down just about 0.3%. So we'll continue to watch that, see if traders come out and buy the dip. They're buying it in some of those down names at this point. All right, let's get to our next stock. Bring in our next guest. That's going to be George Tillis, Senior Markets Correspondent here on the network. George.
Hello. Hello. My name is John. And I'm his mom. I drove all the way over here for this. What a mess. Before our first kiss, I had to meet John's mother. From that day on, I knew it wouldn't work out. 'Cause I ain't dating no mama's boy. Hi, I'm your mother. Hello, I'm Johnny's mother. So they're trying to brush off tech. Now AMD's pulled back to the support again here. If you've been watching AMD, Nvidia's at the 200 also. Had a little bitty bounce for Tesla. Yeah, I'm liking that AMD setup. I mean, on a normal day. What do you do when the elevator light goes out? You're stuck in a dark box. What do you do when the elevator light goes out? Do you hold her tight? We'll hope the door opens. What do you do when the elevator light goes out? You call up Washboardjim and tell him to come check it out. Whoa. Well, it didn't hold support. AMD. You know how many times I've heard tech is selling off, not to invest in it? They'll get right back in it again. I guarantee they'll be following us retail traders saying, "What's Jim buying?" So here's Google. Now, you know, okay, this is what's going through my mind. What do I do when I first approach a stock? Well, first I want to know what kind of run it's had. So I'm going to go to a different chart where I can zoom out, and I'm going to go to the weekly. Now this is Google. So in 3 years, this thing's run up from 115 to 408. Now we've just had a beautiful breakout after 3 white soldiers. So if we can retrace this area right in here and hold, there's your 3 soldiers, and respect those 3 soldiers, we're going to put a little shadow box Has anybody in here ever had anything custom picture framed? Have you actually gone into a custom frame shop and had something done up? So we're definitely hit. This is the 3rd soldier. Wonder what color I should use. Let's go with that. Ugh. That doesn't make it stand out. So, if they're green, we want to use yellow. There we go. Much better. So what was resistance now becomes support. I don't see anything here in the news. It would throw me off. NVIDIA, Micron, AMD lead tech sell-off as AI trade cools. They've been talking about this thing cooling down for a year. I talked about last week about speech class. You can keep repeating something over when you give a speech. You keep repeating the main topic over and 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 over. Eventually, it will happen. I was just thinking something the other day that wasn't healthy. You know, I think I used the scenario of the big gulp last week. People going walking in and out of the big gulp are usually obese. I mean, that's all they've drunk their whole life is a big gulp. You know, they were like a big thing, you know. When we were younger and everybody was thin, go out and buy a big gulp and everybody had these big containers full of pop. Everybody in my family drunk soda pop. Everybody but me. We'll keep drinking that soda pop, and then eventually, what happens? You develop diabetes, or I think I learned not to drink soda back at a very young age when one of my uncles had poured something on a battery cable. I said, God, I ain't drinking this shit. So is that coming scenario? Oh yes, repeating. Same thing as trading stocks. You can sit here and wait. Okay, I'm going to wait until that 200 hits, because it keeps repeating. Now we're at the 63. This is a triple bottom. So we're getting close to the 200. Now we did wick off the, oh, there's the 100. Prepare ye in the name of the Lord. Randy? June 23rd. $74.20s. Okay, the crowd's going wild at the sports arena. The 74.20s. We're now at $2.95 to $3. There's the 200. Okay, $3. 275. We're about now. Okay, you can do it. I know you can. Yes. Okay. The crowd's going wild at the sports arena. This is the SPX calls scalping off. Oops. Minute. Strike is 474.20 at 280. Okay. Now it broke below it, so I gotta see if I'm right or not. I don't know. Might not be right. Might not be right. SPX off the 200 SMA on the 1 minute, and I'm down $30. Should I buy a couple more? Oh, 250. Oh. I like it. 255. There it is. There it is. Oh. No. Right about now. Okay, I feel like I'm chasing now. $240 and $280. Three black crows with a spinning top. $280 and $240 with spinning top. Just like that. We got a great. Oh no. No. Oh. Oh. Well, what to do here? I hold on. I'm not scared. I have one at 280 and two at 240. Serious situation here. Come on, Jimmy. The crowd is going crazy here in the arena today. They heard that Washboardjim will be warming up for Led Zeppelin this week at the Shrine Moss. Don't give up. Now we're under the 200, so we're bearish. I'm watching these candles. I'm in the hole right now, but it don't look too bad. Come home with me. Let's get on the boat and sail the deep blue sea. Can we break the 9 EMA before the day is through? All I do is think about stocks and you. All I think about is stocks and you. Come on. I got 2 hot drinks over here. What the fuck? That man's got a problem. So I'm thinking we got to break the 100. You got a wick, and a body. So I think that's the one we got to break. And then there'll be a shoot up to the... Uh-oh! Uh-oh. 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 If I were you and I was new, I'd take my money and buy Jim a beer. If I was new to trading, I'd tell you I'd love you dear. Oh, $3.10. Ladies and gentlemen, I think I did it again. Now I would advise by you getting at 3:30 and getting out of Dodge, because you might not have too much time left. There's 3:30 right there. You see it? Anybody doesn't see it? I think you need to see it. Woo! Oh my gosh! I'm just getting ready to sell them at 420. Uh-oh. Uh-oh. Randy. Oh, 460. This is the highway robbery. How in the hell does he do it? Well, a little bit of practice and a lot of love, you can accomplish about anything. If you know what I mean, Samuel. You feel what? You thoplops. The new word, thoplops. Thopoof. Either poofed Jim out ot calls. I just came back oof. How many shots have you had? How many shots? How many shots, man? Come on. I don't know how he does it. He says he was sober. How many want to believe that? He said he was sober. Woo! Damn, Jim. Well, it's not always that pretty, but I have to admit, that was pretty. I want an A+ for that trade, please. Magnificent. Magnificent, get your grade pen out, please. What just took place here was amazing. Well, there are them 3 white soldiers standing in a row. I bought these cars on the pullback. If you look back, you can scroll. The spinning top highlighted at the bottom of the chart. Gave me the courage to take this trade straight to my heart. So I bought the dip and I added a few. I wasn't scared. And I saw these other dojis come into the frame and I said, oh my God, get ready for a nice little breakout. Had an inverted doji with a spinning top, natural style. Baby, let's go that country mile. Woo! He's just waiting for his next turn. That was beautiful. This is one of them times where I wish I'd had like 5 or... Okay, that's enough for Washboardjim. Well, I did something today that I haven't done in my life. I double-fisted 2 warm drinks. One was an apple cider for the sake of my life, and a coffee. As I already made the cider up, I realized that I had amnesia. So I went into the kitchen to make a cup of coffee, and I was all out of filters. Then all of a sudden, brown paper napkins showed up. I simply put it in my coffee cup. Thank you, God, for giving me the filters that I need. Whoa. So I used a napkin. Now we're down here at the 200 again. Okay. There you are, you stranger. I got a little bit late there. We're going to go for the... We might move it up a notch. No, we'll leave it right where it is. The 7420s. And we look at the clock. It's now 12:19. So I got to think. Oh, I've seen something here. Oh, Head and Shoulders. I didn't see that earlier. Prepare ye in the name of the Lord. It's either we get bad news. Oh, yeah, that's perfect. We've got the fallen wedge with an inverse Head and Shoulders. This would be your first entry. Going small. Then you got a triple bottom down here for a real strong buy. So I don't know. I'd almost want to wait it out. You could get a bounce here, but I'd almost want to wait it out and see if you get that triple bottom. That's what I'd do. Got a dilemma. Is it going to be the inverse Head and Shoulders or the triple bottom? Could have bought these at $3 and sold them here at 70. That really sucks. But I'm determined I'd give it a little wait time. See if I can pick it up for cheaper than a dime. Triple bottom. Didn't work out for me this time. Well, it's at 410, 430, 450. So within 4 short minutes, that'd been $150 a contract. Now I'm just realizing something that I didn't see earlier, or I would have probably took that trade. That freaking 200 SMA down there on that right shoulder frame. Whoa! Yeah, definitely. If I'd have paid more attention. See, I've been seeing a lot of these today. Just not on the 200, but wonder what's up with that. Shit, $3 to $4.40. I would have sold it by now. Well, the charts are behaving today. Risk could be a little bit more. $4.50. Are you kidding me? Jim, you had about 3 of them at $3. Made $450 in 4 minutes. 5 minutes. Well, that's all right. I ain't caring anymore. That's all right. I don't care anymore. I tried to get back with you and all you wanted to do was fight. But not tonight. I ain't taking it anymore. Oh, they're at 520 now. $600. Ah, $5. Anybody take those by any chance? Yes or no? Yes or no? Randy! Do you see what I see? Or do you have your eyes in other stocks? I'd rather be fishing on the bank of my dry pond. Fish, they're all in strain. Let it rain. Okay, well. I figure one's going to come back in play here in a second. Just don't want to be a rushy. Hello, Bobby. That was a pretty good play right there. I don't know why I didn't take it. I think I was doing a test. See which one of these is stronger than the other one. That could be my answer. And if it was going to break out, I wanted it to pull back in away for the second time. But that wouldn't have worked either. So it had to gone in small and then just run it up. Because I'd have gone in small and bought the dip to that second right shoulder if I'd have bought this one. And I should have bought it. But shoulda, woulda, coulda. Was that nice? $7, 8 minutes, 600 bucks. See what Getty at $1. CRWV Core Weave. And we got SpaceX SPCX. And SNP, ooh, yeah, SNPS. What was that one earlier today? What was it? Rave? No, what was that earlier one today? Randy? What was the earlier one? Okay. Yesterday. Well, I can't remember what it was now. Oh, I know where I can find it. Maybe. Let me see. No. Well, shoot. Can't remember what it was. So, Atlantic International Corporation or something. secures a $52 million 4-year framework agreement with Dutch Vehicle Authority.
That comes from all of these headwinds we're seeing. Competitors like Cadence, which we mentioned earlier, they remain very strong. There's also the acquisition side. They've acquired some companies, and there's certainly some concern around that. But I think what we're seeing here, the choppiness, are investors taking advantage of really strong AI momentum and then selling off and maybe taking some profits when they start to think about the headwinds that could happen with this company.
Okay, so as you do approach then trading this name here for example purposes, leaning into the fact that we have underperformed, but there are still some bulls definitely enthusiastic today, and so perhaps with this profit-taking mindset in mind, why don't you do an example trade?
Yeah, really interesting chart to look at from that perspective, right? So my theory here is that stock remains well below prior highs. Sentiment appears to be improving. We obviously see Piper seeing a faster than expected IP recovery, and of course China and Intel are still execution risk. With that, I set up a bull put spread as my example trade, selling one of the August 21st 430 puts and buying one of the August 21st 410 puts. At the time, the credit was around $5.80. What we would see on this trade, rather than needing a major rally, this trade really benefits just simply from the stock remaining above the key levels. Max gain, of course, is at $580 you would collect. Max loss would be that $1,420, and it would break even around $424.20. Why would you do a trade like this if you're an investor interested in one? The short strike does still sit roughly at $40 above the current price, giving you about 9% cushion. It's positioned below recent support levels and gives room for some of that normal volatility while taking advantage of some of those elevated option premiums.
Yeah, and I think a good way to summarize the way to play into some of hopefully the profit taking we see in the broader tech space, because right now we need some further upside beyond just Synopsys. But hey, we'll take a green candle, we can get it in tech today. So appreciate it, Jeff Pierce, for all of that breakdown on what's driving the at least outperformance today of Synopsys. But coming up next, we will discuss the drivers still supporting this recent strength.
I'm just looking at that.
What
Boom.
catalysts could be dragging on the overall momentum in the back half of this year. For more, when Next Gen Investing returns.
RITM, how are you doing today? 924. Target $13.
Your smile. Oh. Yeah, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab. We have everything we need all in one place.
I can set up her college fund.
I've been learning about trading strategies.
Schwab helps me generate retirement income.
Okay.
Schwab has everything you need is making me crazy.
Does somebody
I'm not having a bad day.
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait.
Vulnerable.
Yes. Now we're in the car together almost daily. I started to realize...
Very vulnerable.
He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
See, it makes a huge Jim. He's always been here for you. It makes a huge difference when you have someone like me who actually cares. May I have a moment of silence, please?
Amazing, I think, to us both, Alex, is like the pockets that have carried the market and what we've criticized as being like a lack of breadth across overall equities. We're starting to see that widening out today, but not really impacting, say, like these small caps.
Yeah, well, I think what we've talked about was the fact that, you know, when you have a concentrated market, that's how you got here. If the
Blaze! Blaze was the word. Exactly.
Index. Like, the NASDAQ has been
Good job, Randy.
huge outperformer for the last, 20 years.
It was
Really
Blaze.
in the last 3, it's been because of a small pocket of names.
It wasn't on my notebook.
Small
I'm
pocket
going,
of
what
names
the
that
heck?
got us here. And then those days that they struggle, because there are a few days every once in a while where they don't do so well.
Ooh.
We shouldn't be surprised that the market is doing a little bit worse on those days. So what you have working, consumer
We
staples,
got target
real
of
estate,
16
healthcare,
bucks.
that just doesn't move the needle from a market cap standpoint. Now, if you look at equal weight's hardly even down. So depending on how you're invested, today's a different day than if you're just...
Here they going on invested again. What is the deal? Is today's theme about shit on the retail trader?
Strategy today.
Yeah, and I mean, look no further than, say, like memory, for example. I mean, Micron now down about 11.2%. We also are seeing weakness in Western Digital down about 8.3%, while NVIDIA, also the notable one because of its size and scale, also down another 3% and lower by 4% now this month.
So as stocks go up, they're all like, they got their jaws dropped. Well, whining and crying. And then when they drop, they're sobbing it now. You know, it's like, thank God I have 20 years behind this desk. Oh, there's the funny guy.
The biggest risks and say further opportunities. So thank you so much for joining us today. You have
I want to do him one day.
climbing because of this
Take-
semiconductor mania, as
I might
well
work
as
on it
space
tonight.
mania and options mania. So what right now is the biggest risk that could interrupt this?
See if he
momentum?
gets his
You're
laugh
seeing
out
very much
today.
Evidence here in real time.
Well, several of them. The biggest one, which was came from nowhere, was after the Fed meeting with Kevin Warsh. You know, President Trump picked Kevin Warsh, and Kevin Warsh is supposed to be dovish. President Trump wants rate cuts. But Kevin Warsh was very hawkish, at least in my book. And, I've gotten questioned, why, Nigam, you say he was so hawkish? Well, the Federal Reserve has dual mandate, full employment and price stability. And, I've been listening to Fed chairs, forever, right? And they always mention both. But what was noteworthy in Kevin's conference is he never, ever mentioned full employment. So he totally ignored that aspect. and he mentioned price stability several times. So that's one. And the second is he kind of called the Fed on the carpet saying, hey, you guys, meaning he's not part of them, have been saying for 5 years your target inflation is 2%, it's running over that, and you haven't done anything. So, if he behaves like Paul Volcker, so to speak, I don't think he will. That's a risk because the long-dated assets, like the tech stocks, are very, very sensitive to interest rates. So that's one. The second one, which I picked up,
But
on
it hasn't mattered.
I picked up, and you guys talked about Micron down so much and so on. There's new memory supply coming out from China. I mean, they're ramping up. Unlike NVIDIA GPUs and so on, manufacturing memory is not that difficult. So more supply is coming online, and the market is not thinking about it. And same thing is going to happen in disk drives. So market is not thinking. And then the other thing is, market keeps on saying, well, hyperscalers are spending all this money and somehow they're going to be able to monetize. But things are shifting, right? Only a month ago or so, in large corporations, we heard token max, meaning guys use AI. They're telling the employee, use AI as much as you can. Then they realize the cost was too much. And now the mantra is token min, meaning, hey, cut in the cost of AI. And then people start looking at it and they're saying, oh,
come
we
on,
don't need
guy.
all these expensive models from Anthropic and OpenAI and Google for everything we do.
Oh, good. You can talk. Blaze. Blaze has been added to my watch list. BLZE.
Tactical? Do you understand that that was the game you signed up for and you just got to have the stomach to handle the days that get a little bit more red, let's say? Or is there, some sort of anti-beta or lower beta component of the portfolio as well?
Well, there's a better way. To start with what you said, we believe in diversifying widely, and, we own a lot of different stocks. We very heavy in tech, very heavy in semiconductors, but then we also own stocks like Walmart. We also own small caps. We own micro caps. So we own a lot of those things. I mean, we own Korea, but we also own India, so we have a widely diversified portfolio. Now, our game plan is fairly straightforward. I do not know why more investors don't follow it. So think of a portfolio as a bucket. So one bucket is strategic, which is very long term. Other bucket is shorter term, where we take advantage of tactical situations. So longer term, we're talking about Micron. So we had long Micron from $21.77, like $1,000 now. So that's the power of being strategic, sticking with things, right? But in between, our Korea, right now around $200, we bought at $48.60, and so on. And I can give you example after example. So, but we do, for the long term, what we do, portfolio, what we do is what we call a dynamic hedging, meaning when we see things changing, we start hedging. And it's not all in, all out. It's a slow process based on systematic quantitative signals, algorithmic signals. So to give you an example, we raise hedges quite a bit. One day before the Iran war, market bottom on March 30th. On April 1st and 2nd, we took profits on those hedges. Now, we're starting at hedges again, and June 17th, we added hedges, right? We're also hedging our semiconductor positions. So that's on how we do dynamic hedging with something what we call it Aurora protection band. That makes it real easy. And then tactical side, we take advantage of what we call as trade around positions. For example, if Micron gets hit a lot, we'll buy it. And what we do is our long-term positions is a core position. We treat it totally separately, and they trade around, and that's multi-year. And the trade around position may be anywhere from few weeks to a month or two with tight stops, closer targets. So that's how we've been managing it, and I've been doing like that for 20 years, and it works beautifully.
Okay, and so you do make an important distinction, though, between, say, like a mania and a bubble, frankly. And so where do you think investors perhaps could be getting too complacent right now and then finding those opportunities? How do you go about, finding some of these perhaps more underdiscovered, underappreciated names by the overall market?
Great point, Jenny. I do make a distinction between mania and bubble because I lived through 90s bubbles, right, late 90s, and everybody talks about it. The thing about the bubble is that the valuations get totally detached from the reality. Right now, valuations are not detached from reality. Earnings are increasing, right? If you look at a PE ratio or Western Digital or Seagate, these stocks are not that expensive. Other than we don't know if we're looking at the peak earnings now, or a year from now, or 2 years from now. So it's not a bubble by any means. We have somewhat overdone it, and the mania is basically psychologically driven. The FOMO, it's a momentum, it's a MOMO, buying all those short-dated options, and that creates, depending on which way it's going, exaggerated moves in either direction. So that's what happens. So it's definitely a mania, and I'm very comfortable saying it's not a bubble because we can look at earnings. So that's kind of how we look at it.
Alrighty, well, we really appreciate it. Any final thoughts in terms of, I guess, what investors can do to kind of stomach these type of days if they're exposed, how to keep their head?
Well, learn to dynamically hedge long-term positions and then separate out short-term technical positions from long-term strategic positions and combine those synergistically, and you'll sleep every night and you will beat S&P 500 every year.
Yeah, I think a good place to leave it. We so appreciate your time today and all of your thoughts. Nikhil Arora, founder of the Aurora Report. Now, coming up next, Inflection is rallying after launching a new quantum space initiative as the White House makes quantum technology a national priority. So we'll break down the move when Next Gen Investing returns.
Marvell's down $27.
Opportunities don't stop.
Starting to look good, things are.
Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
I was asked last weekend about the market. I was asked, and my response was, when everybody was down and out and doom and gloom, I was very, 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 very bullish. Now I'm not as bullish as I was. Do you understand what I'm saying, Magnificent? If you're listening, what do you mean you have no idea? I pulled out the market map. Don't be pulling, that ain't gonna work. Don't be in denial. One thing about trading is you gotta confess to your sins. You were talking about hope, weren't you? Hope? I was talking about greed. Oh yeah, I understand now, Jimmy. You were right again. For that, I have to give you an A+. So for ones that are on YouTube, I like pulling up this map every once in a while. I've caught a lot of these capitulations, but I think we're up in here. But there's a lot of, it's hard to get a good feel about the market because the analysts aren't all on track. But when we were really fear, like it was doom and gloom, and that never really materialized. There's George. I'm optimistic. I was very optimistic down here at capitulation. Now I'm greedy, but still optimistic. Because I've never been more bullish trading this stock market than I have in 22 years.
So alongside the market, but nonetheless, they are companies that haven't developed too much in terms of earnings or sales, but are
SPY
certainly
200
growing in terms of their prospects going forward.
George, we had a guest on yesterday who helped break down quantum computing, make it a little bit more digestible for us, which is quite the
736.41.
task. His name is Peter Anderson, and we kind of asked him, point blank, like, how...
Shut up. I have 736.41 to hold. And we do have a triple top on the SPX. I mean, triple bottom. Ooh. Oh! Look! Oh. Oh. I was right. Didn't I just wrote a song about this? I said, wait. I just pulled a nose hair out of my nose. So if you were live on YouTube, you got a treat. There is a 10-second delay. Oh, it's out. Too late. We missed it. Man, look at it sell off. Brandy, prepare ye in the name of the Lord. No, don't do it yet. You dog. Oh. Could have got him in a buck, but got out at 110. Easily. Pull back.
Sell-off. We are just 2 hours away now from the closing bell, so let's get a closer look at the market moves with Joe Mazzola, Director Trading Services over at Charles Schwab. Good afternoon to you, Joe. Obviously, you and I spoke this morning. We're off the lows. We bounced off the 50-day I saw, but we've dumped below it again. That semi-breakdown is pretty aggressive today. Obviously, we've seen that big rotation into defensives, as we saw on that heat map. With Dow's up, and the SP equal weight has actually been relatively flat throughout the day. So what has this been telling you?
I think your intro summed it up perfectly, Sam, when you talked about there is some grain in the screen, and there really is. If you look at a sector breakdown, it's about 50-50 in terms of sectors that are positive versus negative. But if you dig a little bit deeper and you look at more of a wider distribution, maybe something on in terms of the NYSE advanced decliners, you actually see advancers are topping decliners 1.5 to 1. That helps with the breadth story. It helps shows that you know, when you have such a heavy weighting within the market cap versus the equal weight. On days like today, when tech gets hit, it's just going to have an outsized move overall in terms of what you're seeing in performance. But overall, I don't look at this as a mass selling event. I look at this as a rotation, sort of similar to what we spoke about this evening or earlier this morning, and I don't think that's changed, kind of given what we've seen throughout the day.
Yeah, I mean, obviously the semis are getting torched off the back of the South Korean session. We know that. You and I spoke of it. But as I've been talking to my guests throughout the day, you're starting to get a sense of, why this is happening. Some are putting it down to AI fatigue in this market, given the momentum trade. Some are saying it's the high costs of AI. People have been talking about that tokenization. Some have been talking about the fact that this could actually be price weakness for memory chips moving into the future. I don't know. Some have been putting it actually down to higher rates. I mentioned the 2-year hitting 52-week highs. It's going to be interesting to see what happens when Micron opens its mouth tomorrow afternoon. I know, but we, as I guess financial journalists, love to put a reason on things as to why they're happening. But I'm just wondering if you can put your finger on exactly what it is, or is it just sort of a culmination of everything?
You want me to connect the dots, Sam? I'll do the best that I can. I think that this is really a combination of a few items. I think that we do have a chart for the semiconductor index, so hopefully I'll get a chance to take a look at that. But you're basically looking at a move of about 90% within a matter of a couple months. So when you see those type of parabolic moves, you're going to have bumps in the road along the way. Why? Because this is so predicated on demand and pricing power going forward that if there's any type of change or chatter, you alluded to some of the speak a little bit earlier in the day where there has been this idea that prices might come down, and they already are starting to see a little bit of a discount in their prices for some of the older chips. I know when you talk about the H100, we talk about that being an old chip. Well, it's old by what, a year? But at the same time, it's interesting because when that type of dialogue comes to the surface as it has today, it has investors and traders, at least for now, kind of reconsidering what that forward guidance could look like. And that's why, as you mentioned, Sam, that MU or Micron earnings tomorrow is so pivotal. What I have in the chart here and what you'll see is
more selling.
This something that I had brought up on X a couple days
Look
ago.
what time it is.
I was looking at the breakout through.
This is the hour that I don't do well in. Between 1 and 2 my time, 2 to 3 Eastern. So I kind of lean back a little bit, try not to push myself. We got like a triple bottom here, a quad. Well, that would be nice. Let's magnify this up. It can go higher. Take that body right there. Run it to that body. We're almost there at support right now. Set my alert on the even number. There it is. I'll wait for that. We'll see. 738011, and that's just a rounded up number. It's above where I want to get in at, but I want 80. So we get one more dip. Prepare ye in the name of the Lord. Charge! Did y'all see how I did that? I went from the body to that candle. We got the snake, breakout, pull back, boom. So I noticed this one had a higher low than that. So I set my alert above it. Not saying it's going to hit there. You never know. But it takes a lot of risk off the table. If it does hit it, there's at least a confirmation of some sort of a triple bottom, higher lows. Also, do you see anything else on there that I don't see? That's what I thought. You don't see shit. Take that body, run it to that body. And that could be the 21 to break. Or take that body and run it to that body. You got like a fallen wedge. So you got a fallen wedge. And you got a resistance. So it could come down. You already got a 1, 2, 3. And a 1 2 bits, 3 bits, 4 bits. So it's at the sweet spot right now. Could break out a little bit, then pull back and retest. That would be your second idea off this head and shoulders. That breakout up here. Don't take it yet. So now you got the snake working. We're still bearish because we're under the 9, but we did break the 9, just cracked it just a little bit. Then we give it the time of day, 1:13. Like I see it come down one more time and just didn't shoot out. This is a follow. That's bullish. That's very bullish. Now there's your candle.
Gears now, and let's go deep on Tesla in our tech spotlight. So joining us now is Seth Goldstein, the equity analyst at Resources.Jam, Morningstar Equity Research. Seth, thank you so much for your time. Now that SpaceX has gone public, does that change the story for Tesla anyway?
Tesla.
I don't think it changes this story too much. I think for Tesla, if you're invested in the stock, you're invested for the company's transition from a company that mainly sells autos and
7400s.
It's going to sell real-world AI software, full self-driving, and robotaxi software, and the Optimus humanoid robots. And that really doesn't change with SpaceX going public. If there
7400s at 380.
then I think you'd see certainly the shares react to both companies. But for now, I think Tesla is being traded based on the market's enthusiasm for its long-term transition into a real-world AI.
Now we're at resistance here.
Yeah, it certainly is on a lot of the future enthusiasm around the tech story, but as far as the valuation, I mean, people still see this as fundamentally a car company, and that's why obviously the
It's not a car company.
So important here. Is that what you...
Oh God, Lord help me. Please.
Right on track with what we think is the cadence of the year, where we expect we'll see another quarter of deliveries growth. Q1 had about 6% growth. We think we'll see a somewhat similar mid-single-digit Q2 growth. And then we really think Q3 is where we're going to see a likely decline. Because if you remember last year, there was a big push for everyone in the U.S. to buy an EV before the U.S. EV tax credit expiration at the end of
10 years ago, oh, there's the knife right there. 10 years ago, that was the argument. Is Tesla, that was 10 years ago. Am I wrong to assume that it's not a car company? You know what I'm saying?
here in the U.S.?
We think so, and we think that FSD is also going to drive deliveries to not be as down for Tesla as they will for other automakers in the U.S., as well as the cheaper Model 3 and Model Y prices that have come out starting in Q4 last year. We think that has enticed some buyers who, because it does put Tesla into the below $40,000 range for a starting price in the vehicle. That gets you for a midsize SUV somewhat similar to a Honda CR-V, somewhat similar to a Toyota RAV4, which are the two best-selling midsize SUVs. And so we do think in that price point, many consumers start to consider a Tesla, and some of them end up buying one, which will help to offset the tax credit expiration.
Understood. And you just wonder how many people have also been rethinking how they're seeing EVs, particularly with respect to higher oil prices. I mean, you know, gas $4, $5, $6, $7 a gallon as well. Let's talk about the potential SpaceX and Tesla merger, which is, you know, not a new idea. We've been talking about it for weeks. I mean, a lot of people have sort of thrown their 2 cents worth in. But do you see a solid business case for that? Could you sort of walk us through your thinking?
Yeah, so we see the convergence between a lot of what SpaceX wants to do with its AI platform and what Tesla wants to do with its real-world AI platform. You could have things like the Grok LLM be sort of the consumer interface for much of Tesla's real-world AI, whether it's cars that can drive themselves either for your personal use with FSD or a robotaxi, or we see Grok as the potential interface for an Optimus humanoid robot that can help, you know, let us as consumers or let business use cases sort of tell the robots what they want the robot to do, similar to how we would tell a person, you know, in a manual labor job what we would want them to do with the current labor situation. And so I think there's a lot of intertwining. You could also have Starlink being ensuring connectivity for Tesla vehicles, especially robotaxis, which will need to remain connected at all times. And then from the Tesla side of things, I think Tesla could be one of SpaceX's key suppliers. You're going to look at things like solar panels, you're going to look at batteries. We're also going to look at things like casing that you could use for the larger spaceships that can allow more cargo to be carried. So I do see a convergence of the two companies where they will help each other out and be key suppliers to one another over time, which does make a merger make sense. And in addition, there's the obvious fact that Elon Musk, CEO, largest shareholder of both companies, and it would allow Elon to face less governance issues in moving things like engineers and software developers between each company and on different projects as he sees fit. So I do see a strong business case for a merger to occur.
Understood. And then obviously there are a lot of parts of the business which, as you say, are rather complementary to each other. But are there any other parts of the business which kind of don't make sense? And do you foresee any factors which would work against a potential merger here, which would then act as a prevention in the future?
The biggest thing I see would be a potential governance issue or potential regulatory concern, especially from the U.S. side, because SpaceX is a large U.S. government contractor and Tesla has large auto and battery manufacturing operations in China. That could draw some regulator concerns. You could also have some concerns about one company sort of being the leader and being a huge conglomerate in many different new emerging markets with AI. That might draw some scrutiny as well. But generally, I do think the way Tesla and SpaceX each operate today, you do have fairly siloed businesses that don't necessarily have to interact with each other 100% of the time. And so if the companies came together, you would just have now, more businesses that would be somewhat siloed. It would be a huge conglomerate under Elon Musk. But I think the biggest holdup would be from the regulator side. And if the regulators approve the deal, then the biggest holdup could be a valuation. Tesla shareholders, given the small SpaceX float, might not be thrilled with the idea of being heavily diluted if we just did a merger based on the current market caps of both companies. Certainly at Morningstar, we think SpaceX shares are very overvalued right now. We think it's worth about $62, $63 a share. And so we think that in a Tesla SpaceX merger, it would need to be something closer to 50-50 or even a slightly higher percentage of the new equity for Tesla shareholders versus SpaceX.
Seth, really appreciate speaking to you. Thank you so much for the conversation. We're going to wrap it up there. Seth Goldstein, equity analyst and resources chair, Morningstar Equity Research. Coming up, we'll check out the latest news on Bitcoin, Ethereum, and more in our crypto report. The watch list will be right back. Data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
My man. Sometimes, you could have done better.
Boom.
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab.
Uh-oh, I ain't watching.
Have you ever watched an interview and thought, I wish they had 5 more minutes, or I want to know how they discovered that hidden gem? That's exactly where Market Matters comes in. I'm Marley Caden, and our podcast is slowing things down. We're going beyond the earnings to get to the heart of the people and companies driving the global economy. If you want the full story, not just the headlines, Market Matters is for you. Subscribe wherever you get your podcasts.
Shoot.
Back here on the watch list, Wolf Research upgraded Target to outperform with a $162 price target. The firm named
7,400 at 330.
the year, saying the store is becoming a destination once again. That's helping shares today.
There's the fallen wedge.
On Target at 130.
I knew it just said come back down.
Walmart's higher as well, and Costco is up 1.1%. So it's a good day for some of our retail stocks.
Perfect. Perfect.
From Wolf Research. All right, it's time to take a closer look at Bitcoin, Ethereum, and more in the crypto report. So let's welcome in Tyrone Ross Jr., who's the CEO and principal 401 Financial. Tyrone, it's always nice to see you.
See you
Thanks
again.
for dropping by.
Of course.
All right, so Bitcoin's off today. I mean, let's just talk about the reaction today. I mean, is it anything in specific that really stands out to you? Because obviously we started to see that global tech sell-off start in the Asia trading session. I mean, is that got to do with the tech trade, or is this a liquidity issue? Is this higher rates? What is it?
I think it's everything you mentioned.
Okay.
I think there's a confluence of events now that's just keeping Bitcoin range bound.
Okay.
A lot of uncertainty with the Clarity Act, which I'm sure we'll get to at some point. Rates, right? What is going to happen with rates? The AI trade, a lot of money and liquidity is leaving crypto. AI is hot right now. So I just think there's a lot of pressure on Bitcoin right now. And to me, I think coming down 40% or so off the highs, it's price discovery. People are just really trying to figure out where it fits, what it's doing. But tick-tock next block, right? It just keeps running and it's here.
A lot of uncertainty around the Clarity Act sounds like a paradox. So, I mean, when do we start to
for you?
Now, this is it.
But what happens next?
What do I do?
Would this then put in a bottom for Bitcoin prices, do you think?
7,400s at $2.70.
I think that is the hope. From an advisor standpoint, I am a registered investment advisor. We would love to see some joint guidance from the SEC and CFTC. What is a security? What is a commodity?
Snake, fallen wedge, support, what was resistance.
Stable should have yield or whatever else is a totally different story. I think that's what makes most of the headlines. And obviously we want investor protections and people to be protected there, but there's a lot of lobbying, there's politics involved in a divisive government right now. We want to get it done before they all go on recess. And then this morning it was announced that the House Financial Committee is going to meet on the 14th, which is nice. They're going to try to cover this and get some more ground covered. But I think Polymarket has a 40% chance of it getting done. I don't think it will before then, but so there'll still be this fog over the entire crypto space until the end of the year, in my opinion.
And something everybody's been talking about is this sort of sentiment mismatch and this disconnect between investor sentiment and Wall Street seemingly wrapping its arms around this entire space right now, embracing it, moving towards tokenization. I mean, I can name a whole list. I mean, you've got JP Morgan, you've got BlackRock, you've got Morgan Stanley, Franklin Templeton. What do you make of that disconnect? I mean, when do you start to see it sinking up once again?
Well, I have a strong opinion here. Being a true crypto hippie, the tokenization thing.
Crypto hippie?
I think it's more of a buzzy
What are you doing about nigga?
now than anything tangible, and that folks can really invest in. I think there's infrastructure being built, which is nice. I think there's going to be a lot of people that have to get involved here. The DTCC and others, you know, it's good to see Franklin Templeton and JP Morgan and BlackRock and so on and so forth in, but there's going to be a coordinated effort here that I think is very disparate at the moment. Now, are there some themes that I think make sense? Sure. I mean, we're sitting on the floor of a venue that has clearly seen modernization and tokenization of assets and ETFs and all that. Is fascinating to think about. And here for the true details of what crypto does is faster, quicker, more efficient, self-sovereign. I think those are all key tenets that I think have been lost with all of the tokenization hype. But hopefully when this all filters out, that there will
Could easily come down here.
Key players that have been around in the crypto space that can partner with TradFi, keep some of that true essence, and then make it investable for everyone.
When do you think crypto prices will start to reflect what is really going on with that infrastructure that you speak of? Because that also seems a bit like a mismatch.
Huge mismatch.
Right? I mean, if you had so much tailwind behind a certain sector, you wouldn't see such a pullback in an asset class.
Well, one, retail has been burned. It's a space that was built for retail first. Retail has been cooked over and over and over again in bear markets. They haven't come back. There's only so much institutional news that you can have. It's all institutional driven now. Also, Bitcoin and crypto OGs, those that were in very early, selling into this. So they're selling to get out as the institutions come in. So I really think, I don't think the Clarity Act is going to do it. I don't think the next great financial institution saying they're going to tokenize their balance sheet is going to do it. I think it's going to be, there's going to have to be something that brings more people in safely and easily. Maybe it is stable coins, with folks being able to transfer money with stable coins. Is that fascinating here in the U.S.? I doubt it. But I will say this is 13 years in the space. This is the biggest disconnect between sentiment, which is awful, and all of the good news of infrastructure and pipes and things being built. And I think that will continue to grow, at least until the end of the year.
To widen.
Yeah, until something happens that kind of sparks it and we go higher.
Yeah, it's a fascinating dynamic to watch it play out. But Tyrone, I really appreciate it. We're going to leave it there. Thank you so much.
Absolutely. Appreciate you having me.
Thank you, Tyrone Frost Jr., CEO and Principal at 401 Financial. Coming up, our Watch This panel will dive into the latest with oil and the energy market amid the continuing Iran negotiations. That's coming up when Watch List returns.
Marley Caden, live from Chicago. We're tracking market movers, earnings reactions, and what traders are watching next.
Come on, use.
Live at schwabnetwork.com.
This is it.
Intern, this place is incredible. It's where I get all your office
This
supplies.
is it.
Your golf balls, your fancy coffee, From the giant TV, it's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, Schwab, they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that. Schwab.
Invest your way with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Real-time market moves, earnings breakdowns, and trade-ready
Gil.
insights. Follow me
Bridget.
on X at Sam_Vardas and connect with me on LinkedIn or Instagram for more. Welcome back, everybody. It's now time for the watch list panel. Let's talk all things oil and energy markets. Joining us today, Chris Bisacci, who's the portfolio manager at the Strength Pro Portfolio and Chief Investment Officer, Thematica Research, and Joe Rinaldi, President Chief Investment Officer of Quantum Financial Advisors. Thank you to you both for joining me today. Chris, let's kick things off with you. What have you made of the positive developments this week in the move in oil?
I mean, it's moving lower, continuing the trend that, it began several weeks ago. We're starting to see that really flow through to gas prices as well. And probably the most important thing today was the flash PMI report for June. So the latest snapshot on a variety of aspects of the economy, but it showed that
Triggered.
the likelihood that inflation pressures have likely peaked in May. We started to see them tick a little bit lower in June, and I suspect that as we move into getting, more June data, July data,
Just hit my alert.
we'll see this continued flow through of lower energy prices and potentially starting to see output costs come down as well. So some good news, I think, is on the horizon.
Yeah, those input prices have certainly been key as far as those PMIs acting as a sort of forward-looking indicator. So I think you've raised a really interesting point here. Joe, let's just get to you. I mean, where do you see oil prices going from here? I mean, obviously, the developments we've heard out of Iran has helped take oil off the boil for now. But, I mean, what would need to happen for oil to move in either direction, perhaps over the summer, do you think?
Yeah.
Quite frankly, I think that this political hot potato will continue through the summer, even though we believe that there is a MOU, memorandum of understanding between us and Iran. So the volatility will continue to be here through summer end. I do believe, though, that I echo what this young man had just mentioned, that we are trending lower in prices. I think that oil prices will decline to the 60 to 65 level near term, assuming that this stalemate continues. And I also believe inflation will trend down to that high 2.8, 2.9 level come the end of the summer as well. So I think there is some tailwinds to a better outlook. It's just a matter of living through the volatility that lies ahead of us through the summer.
You're saying we could get to 60, 65, so obviously prices pre-Iran war, even with the stalemate, where you're sort of saying, ceasefire on, ceasefire off, talks happening, talks not happening, straight open, straight not open, all that kind of hot potato as you described, an MOU, which, as one of my guests sort of put it similarly to you yesterday, could potentially drag out even throughout the midterms. You still see oil prices coming down?
Absolutely. Again, the market, institutional investors are tired of the ups and downs, and quite frankly, it will trend continue lower. It will be interesting to see if we're playing chess what Iran does, because quite frankly, if I was them, I would continue to poke the bear, and because the Republicans need not to lose any seats in the midterm. So I think Iran has leverage over us, and interesting enough, I will give the Trump crew in Washington kudos for suggesting or making sure that the monies that Iran receives through oil sales this week flows through buying food for the Iranian people. Huge positive.
And obviously Iran being able to sell its oil, China is a big customer. That's been obviously seen as keeping a lid on oil prices going higher as well, which could be feeding into what we're seeing here. Chris, getting back to you, given everything Joe just said, it's interesting, and you pointed to the data earlier. The strength in the dollar, the 2-year yield being at 52-week highs. What is the rest of the market telling you? Because it certainly seems like a decoupling between what we're seeing with respect to oil prices and yields right now. Does that suggest to you that maybe the inflation problem goes beyond the Middle East conflict here in this energy supply shock?
Yeah, I think that's right. Think of the commentary that we've had from companies over the last 2-3 months about contending with these higher input prices, starting with energy, but then flowing through to transportation prices, and they started to push through their own price increases, right? If only to help protect their margins. But that we're starting to see some of that still come through. That was the key point in that flash PMI report today about output prices continuing to trend higher. So I do think we're going to see it, continue, but I do think that the worst is arguably behind us. Now we can look forward to the rollover in that inflation pressure.
Yeah. Take out energy and tech, the market is down this year. What do you think that tells us, Chris, very quickly about the concentration risk in this market?
No surprise when we take a look at the S&P 500 and the top holdings and the headline risk that we've had year to date with the U.S.-Iran war. So not surprised at all.
All right, guys, we've got to leave it there. Or actually, just quickly, Joe, if I can get your take. A lower oil, better for consumer-facing stocks. Do you look at areas like leisure and travel as a sort of play here with low oil prices?
I'd stay away from that. I'm cautious. I like utility stocks. That's our theme since last year around October, November. I think the increased demand for energy, there's great movement towards higher prices, and I think the net beneficiary are utility companies like Duke, Exelon, Con Ed, Dominion.
More selling.
All right, something to look at, guys. Really appreciate it. We're going to wrap it up there now.
I don't know what to think about this.
The Street Pro Portfolio and Chief Investment Officer, Tematica Research, and Joe Rinaldi, President Chief Investment Officer, Quantum Financial Advisors. Coming up, we'll examine the sectors on the move in today's session, and also check out a strategy aiming to take advantage of fundamental metrics across the market in the ETF watch.
Back down to the falling wedge. Dude. Dude.
sometimes, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim
There we
Desktop
go.
with robust charting and analysis tools, including over 400 technical studies.
We're at the double bottom now.
Unique needs with nearly endless customization.
Definitely.
And track market trends with up-to-the-minute
These 7380s
Welcome back to the watch list.
or
I'm
the
Sam Barnes,
7390s.
the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets into the close today. We're joined by
The 260.
Kevin in Chicago. Good afternoon to you, Kevin. And it's interesting because away from the index level, there's actually a lot of green on the screen here as far as the sectors are concerned. Just walk us through what you're seeing right now.
Yeah, what are you seeing, baby?
Hello, Sam. Yes, 11 sectors in the S&P 500 right now. 6 are actually up, and 5 are down. The equal weight
7390s at $2.60.
down about 0.3% as opposed to the Nasdaq and the regular weighted S&P. But within that is information technology. Even though within information technology, software is actually having a pretty nice day. Some bounce back there in a sector of a sector that's been pretty weak lately. But software doing okay, but information technology is still down, communication services is still down, consumer discretionary is still down. So even though this still resembles, in my opinion, a rotation
And that didn't hold either.
of large cap tech and into the other sectors.
Shit.
I mean, semiconductors
Fudge.
within information technology just heavy as can be.
Well, they're really selling it off hard.
When you look at the overall macro setup, it's different, right? The dollar is starting to rally to pretty significant levels off of that Fed meeting on the 17th. But the 10-year yield is starting to creep again lower,
Yeah,
down
like
below
3 weeks.
4.5%. So trying to make sense of this, the good news, crude oil. Crude oil continues to work its way lower based on headlines and what's going on in one headline versus what President Trump is saying. There's a lot of that going on, Sam, but all things considered, this market that really started off coming off a South Korea sell-off, right? It really started energized today's sell-off. Is still looking like more of a rotation than any type of global sell-off.
Yeah, and I think that heat map really says it all as far as the picture there. Kevin, really appreciate it. Thanks so much for your time. Have a great afternoon. It's time now for our ETF watch list segment. Joining me now is Todd Rosenbluth, who's the head of research, TMX Verify. Todd, thanks so much for joining us and around the desk today.
Great to be here.
It's really nice to see you. So let's just start with your news. You have now signed a deal to buy RAFI indices. What is that? How significant it is? What does it mean for the market?
So TMX Verify, which offers index capabilities, roughly about $90 billion in ETF assets, are offered and tied to Verify indices. When the RAFI deal closes in the coming weeks, that's roughly going to triple our overall index capabilities. So we have index products that are tied to American Century and Victory Capital and ALPS-related ETFs, but the addition of products that are tied to Invesco and PIMCO that are more fundamentally weighted really is exciting to us.
What does it mean for investors, and why did you choose to do it now?
So what we've seen is that this environment that we're in right now, the market has been rotating. We've seen actually more fundamentals play a larger role within index construction, within portfolio construction. And so some of those ETFs, PRF is one of those. It's the Invesco RAFI US 1000 ETF. It's actually outperforming the S&P 500. It takes fundamentals into account, so valuation, quality characteristics that are part of it, as opposed to just market cap weighting. And we've seen that at Verify with some of our pre-existing products. So VFlow, which is the Victory Shares Free Cash Flow ETF, that's been outperforming. It actually owns none of the Mag 7 stocks and has been outperforming the S&P 500 since its inception roughly 3 years ago.
Yeah, well, I mean, they've been lagging, haven't they, as we've seen that rotation of capital into sort of more of the bottlenecks. I do want to discuss single stock leverage ETFs because yesterday we were having a discussion on the ETF panel about those that are attached to SpaceX and the kind of demand we've seen, particularly from retail investors. And then overnight we saw this sell-off in the Kospi, and part of that was to do with some of the regulatory scrutiny about that particular market and leverage ETFs, particularly with respect to index heavyweights, SK Hynix, Samsung, etc. Now, obviously, I'm aware that margin calls in that particular region can amplify those moves, retail investors taking on what record debt to actually buy stocks over there. Do you, as someone who works in the ETF business, see any similar risks in the US, or is it a different story?
I don't think it's the same story. I guess it is a different story. We've had leverage ETFs, single stock leverage ETFs for a number of years here. We've seen products that are tied to Tesla and NVIDIA be extremely popular as investors took risk on. We also have the inverse products that are out there, so that people are also using a counterbalance and are taking a different call on the marketplace. What we've seen with SpaceX in particular is nothing has been like it. It's impacted the overall marketplace. 11 products came to market within a 2-day time period of SpaceX coming to market. Tremendous volume. It's risk-taking. People certainly need to be aware of those risks that they're taking on, but I don't think it's going to impact the broader ETF marketplace.
Okay, good to know. High risk, high reward, as you say. What about these thematic ETFs? Because obviously you've got UFO, you've got Robo, which are both looking to take advantage of those sort of broader themes which have been very popular. I was also looking at, obviously, the Round Hill DRAM ETF, which has been obviously just up and up and up, really taking advantage of what we're seeing in memory and some of those bottlenecks. What are you seeing as far as that investor appetite for more of the thematic ETFs?
So thematic investment demand has been growing this year. We've seen narrower themes that are tied to artificial intelligence be popular, but also strategies that are not directly tied to it. You mentioned space, and the Procure UFO ETF is the oldest ETF within that space. You mentioned ROBO, which is a robotics and automation product. I would even consider energy infrastructure and the MLP space, the Alarian MLP ETF.
Interesting.
Is also a way to get thematic exposure. So not all tied to artificial intelligence specifically, but the broader trend has been growing, something we're excited about in the ETF industry.
Do you still see strong appetite for international ETFs as well, that kind of exposure, given obviously some of the outperformance in places like Asia?
So we've seen growing demand for international products, both in a market cap weighted approach as well as a smarter way of doing it, as well as an active approach. So there's a lot of different ways, but it's important when you're looking internationally to make sure you know what you're getting. So we at Vetify recently wrote an article about whether you'd have exposure to the United Kingdom. There's obviously some political challenges that are going on there. There are ETFs that exclude the UK and are just Euro focused. Wisdom Tree has one of those products, HEDJ. So it's important to just know what's inside your portfolio.
Got to do your homework. Todd, thanks so much for joining us. Really appreciate it.
Thank you so much.
Todd Bruisenbluth there from Vetify. All right, coming up, we'll take a closer look at some of the large options trades to watch in the market. Rick Ducat will join us with a closer look at the big moves for HSBC, Boston Scientific, and Quanta Services. We'll be right back.
The final night. That's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on...
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even and retiring. You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com. Welcome back to
Little
the
bitty
watch list.
move.
It's time now for big moves where we highlight outsized options trades taking place in the market. So joining us to do just that is Rick Ducat. So
Blanket.
afternoon to you, Rick. We've got HSBC that's up over 20% this year and hit a new 52-week high yesterday. So what's really standing out in the options market around that name?
Yeah, Sam, you know, I wouldn't blame you if you thought these were three names that are all kind of under the radar, but that's what's most interesting to me about them is these are rather lightly traded names that saw very large outsized trades specifically today. So HSBC, global financial banking, financial services company headquartered in London, recent partnership with Google Cloud to build and deploy AI across their operations was the main piece of headline news recently. Sounds like they're targeting wealth management advice and financial crime risk management specifically. Recently they hit their all-time highs. One trader though seems to be looking for a pullback here. A bearish trade, long puts, plus 2,500, September 18th, 95 strike puts at a 480 debit here. So 87 days out, $1.2 million debit paid here, equates to the max loss, as would be the case with long puts here. Max profit, potentially $22.55 million here if it were to go all the way to zero. So the break even, 90-20, about 6% to the downside. The expected move, according to the options market during this same time horizon, would be about 13% or so. So well within that range of the possible move projected by the market here. We can also see too, as I always try to find, these are all opening trades today in which the volume exceeded the open interest on the particular options contract here. So the volume in this case, 2,500 versus the total volume of the symbol today, shows that this trade alone was more than 59% of the total options trading in this symbol here. The sizzle, which means the today's volume versus the 5-day average of options volume here, came in at 2.4 times that number. So an elevated day in this particular stock.
Okay, that's HSBC. Let's move on to Boston Scientific, which has actually been trending downward, down more than 50% year over year. What caught your eye about this one, which is trading higher?
Right, so medical device development and manufacturing, they mainly focus on surgical supplies, cardiovascular equipment. Not really too much recent specific news, but I did see some instances of bearish analyst activity throughout the month of June. Price target cuts from Bank of America, Piper Sandler, Truist, some other ones too. So kind of a more downbeat look here. The price target kind of ranged from 61 to 65 for these firms here. 52-week lows yesterday as well, and at least one trader seems to be thinking that the pain could be continuing here. Again, long puts, a bit of a different structure of the trading here though. This is a much larger quantity of cheaper puts here, but kind of the bias and the general structure of the trade is the same. Plus 14,700, August 21st, 40 strike puts,
so bad here.
and 115 debit here. So again, bearish, 59 days out, so also a little bit shorter duration from our last trade here. $1.47 million max loss is our debit paid here, so we can also see that the $1.69 million debit max loss there. So 57.33 million would be our max profit if we were to go all the way to zero there. So break even 13.3% to the downside. Expected move about 15% during that same time frame here. So this one's a little bit more narrow of a profitability window here, but still within that expected range boundary here. So this particular trade was about 22% of the total options market volume today. However, it was also paired with a closing trade from this week's expiration here, a similar put trade here. So if you put those two together, both of them would have been about 44% of all the trading in this particular name today. The sizzle comes in at 3.4%. So another bearish trade here, a pretty heavy outsized trade in this symbol.
All right, squeezing one more in. Let's make it quick, Rick. Qantas Services hit an all-time high last month, but is down 9% since then. What trade stood out in today's session?
So again, this one was another put trade here, infrastructure for electric and natural gas utilities. Not really any specific news here, but this one did seem to be a little bit more optimistic than our other ones. Minus 1,945, August 21st, 540 strike puts at a 787 average credit. So a sweep trade done in several lots here. Recently, this one also hit all-time highs on May 6th here, but this one is thinking that we could see a firmer supportive area here based on the structure. The trade neutral to bullish, 59 days out, $1.53 million credit received here with a $103.4 million max loss potentially. So break even, 532.13, more than 25% to the downside versus the expected move, only about 8%. So a higher probability trade setup here. This one was more than 51% of the day's total volume. The sizzle was 2.1.
Great stuff. A good look at HSBC, Boston Scientific and Qantas Services. Rick, thank you so much. Really appreciate your time today. And that's going to do it for us here on the watch list this afternoon. I'm Sam Barnes, live at the New York Stock Exchange. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. You've got Market on Close coming up next with Marley Caden. I'll catch you bright and early tomorrow on Morning Trade Live at 10 a.m. Eastern. Have a great afternoon, everybody.
Schwab, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted
This
financial
could be
analysts.
it.
Streaming live and on demand.
1 minute
Streaming
to Power Hour.
Any screen, anywhere, free. SchwabNetwork.com.
And the crowd's going wild.
Mom, when my grandparents moved here, did they become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing up houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
The market is moving fast. Are you ready for what's next? Join Schwab's panel of experts on Thursday, June 25th for our 2026 mid-year market outlook. From global energy spikes to volatility to inflation, and the 2026 IPO landscape. Get the insights that investors need for the second half of the year. Join us on Thursday, June 25th at 7 p.m. Eastern here on Schwab Network. Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
This is Marley.
Coming up on today's show, we'll be discussing retirement investment strategies and where target date funds fit in retirement strategy. Then we'll examine the top themes moving the market and the role of diversification in the current environment. Then after the close, we'll have earnings from FedEx in its first report after the spinoff of FedEx Freight. As far as what I'm watching today, IBM on the move higher today after an upgrade to overweight at JP Morgan. The firm sees room for multiple expansion should Big Blue gain incremental traction as a substantial AI infrastructure beneficiary. Carnival, though, falling today despite beating on the top and bottom line for its latest quarter. The cruise line highlighted strong demand for the rest of the year and beyond the back half of 2026, booked at historically high prices. And Ross Store and Five Below are both under pressure after the discount retailers were downgraded to neutral equivalent ratings. Both notes highlight valuation amid recent rallies from the companies, as well as the potential for slowing sales ahead. Lots to get to there, but let's check in with the markets as we near the end of this trading day here. We have an entirely down picture here. We were mixed this morning. We moved entirely into the red in all four of our major averages. The S&P trading down 1.4% right now at 73.67. On the NASDAQ, we are 3 1/3% lower. We're at 29,321. On the Dow, we are marginally lower, but still lower nonetheless at 51,684. And the Russell 2K trading down more than 1% right now at 2969.99. Taking a look at the 10-year here and seeing how that's been faring throughout the session, we're holding at 449. The dollar has gone north of 101. We're at 101.17. Gold is lower, more than 1.5% lower at 41.3570. Crude oil at 73.32, and Bitcoin staying in that range, but down about 3.5% at 62,185. I do want to welcome Jenny Horn into the conversation, though. Take a look at some of these names that we are seeing on the move today. And Jenny, let's talk about IBM. And they got 2 upgrades today, price target adjustments, and seeing a nice move to the upside despite the broader markets being down today.
I know, it's frankly a really interesting call that we're seeing because it highlights a lot of its software business, which frankly has not been to its strength this year. So outperforming today nonetheless, and they have resisted again this pretty broad-based tech sell-off as they gained some upgrades and really growing conviction in what has been a decade-long software makeover that at least JP Morgan says is finally starting to pay off. And so the analysts did move off the sidelines today, upgrading shares to overweight from neutral with a $291 price tag, up from $270. But they did highlight that they've noted previously software is the primary driver of the shares, and this does remain the case as higher value software business mix continues to grow. They also are not the only ones making this argument. Barclays did initiate coverage on the stock earlier this month with a buy, also citing that concentrations in software. But JP Morgan does have this conviction that IBM's software business will pick up speed now into the second half of this year, and did note that the primary really driver of the shares is this software business, which comprises roughly 45% of their revenue, but nearly 2/3 of their consolidated profits. They did predict that software will become more central to the business as AI adoption does grow. But what it does is it brings, when you look at software, it brings this more predictable, high-margin subscription revenue and cash flow to its business, which contributes to not only just a better financial profile, but a more predictable one at that. So the company has been definitely on a buying spree. We've seen, some criticism tied to their heavy spending for growth. They've made roughly 50 acquisitions in the last 5 years, which was headlined by a high-profile purchase of Confluent back in March.
What?
But in this firm's view, they do see multiple expansion that can exist if IBM can gain traction as a substantial AI infrastructure beneficiary. and if it announces a more favorable revision to its timeline of delivering a fault-tolerant quantum computer. Now, a lot of also this does hinge on, of course, commentary from the president. We did see that President Trump signed two directives Monday mandating the creation of this research-grade quantum computer by 2028, and thus accelerating the government's shift to a post-quantum really focus by year 2031. And so IBM has been also a big beneficiary of the Commerce Department pledging about $1 billion to help them build this standalone quantum foundry. And so being tied to the government right now that seemingly is favoring names like Intel, IBM, is definitely been working out in their favor, but still actually lower on the year despite today's outperformance.
Yeah, I mean, a nice move today, up about 4.5%. But as you highlight, it had pulled back on the year, underperforming the broader market. And Morgan Stanley put out a note today as well, raising their price target to 267, saying it was time to scoop up the struggling tech stock as it's ready to outperform. So some optimism for IBM today, but as you highlight, still underperforming year to date. I want to talk about Carnival now, though. Carnival Cruise Lines was a highly anticipated earnings release just because Carnival, unlike its competitors, doesn't hedge for fuel prices, and obviously that was a big component here. But they ended up beating some of the estimates here, but still seeing a pretty heavy downward move today.
They have, and they've been lower, right out of the gate this morning. And so, while we did see a strong beat, earnings did exceed expectations. Record revenue totaled $6.7 billion as demand remained strong, but adjusted net income of 20%. EBITDA did also hit record levels. Again, showing this continued operating leverage. And they're also seeing a record number of customer deposits at $9 billion, with roughly 93% booked for the year right now as far as their cruises are concerned, at historically also higher prices, signaling at least this strong forward demand and pricing power. Net yields are also at record levels, marking the 12th straight quarter of yield growth, reinforcing again their strength in the broader cruise recovery. But despite the beat, obviously shares have moved lower pretty consistently today. And so we did see that was hugely because of the focus on weaker than expected guidance. Their third quarter and full year earnings guidance came in slightly below expectations, suggesting momentum could moderate from here. And so fuel costs rose nearly 30%, pressuring margins and driving a decline in their gross margin yields. Well, we also do know that geopolitical headwinds like the tensions in the Middle East are impacting some of their key bookings in European markets like the Mediterranean, for example. But bottom line, they do continue to really show strong demand, pricing power, and earnings. But the market is shifting its focus to cost pressures and, again, that softer guidance that does reaffirm some of the fears that for so many months these companies have been basically eating the costs of heightened fuel costs, frankly. And now we're starting to see that upside left is seemingly waning here a bit. So not a huge move lower, and actually amazingly so, some of its cruise peers in the space are pretty much unchanged on the day, but been a pretty substantial downward day for Carnival here.
Yeah, I think the different setup here is that those other names hedge those fuel prices and Carnival doesn't. So with the uncertainty here, we're seeing some of that reflected in those numbers with that 5% move to the downside. But even with that, not even canceling its gains just for the month of June, it was up more than 10% coming into this report. So still higher on the month overall for Carnival. I want to talk about Target now. We got a upgrade at Wolf here, but even more than that, it's named a top pick coming into the year end, which was very interesting, as I feel a lot of the conversation we've had around this name has been in the turnaround plan and some of the missteps.
Absolutely. And so unfortunately for Target, navigating this very difficult, already very competitive big box environment, they just did not have the proper assortment to resonate with consumers. And then we've seen Target specific misstep after misstep that has frankly just really weighed on share price for the last several years. And so Wolf Research with some love though for Target today, and amazingly outperforming the overall market pretty broadly all throughout today's session, as they did upgrade shares to outperform from pure perform, $162 price tag, and again, as you mentioned, naming it a top pick into year end. So they did highlight Target seeing this improved execution as new management does shake up the status quo, seeing now a 3-to-1 skew in shares with upside at around 160, downside risk being 120. I appreciate that range that they gave because you don't always see that from the sell side, but they did say that their summer store resets are accelerating and it's becoming a destination once again. They believe the company's future is increasingly compelling with mid $9 earnings per share possible now by 2027. But if you look at consensus right now, it's pretty broadly hold. We do see still several analysts that have been able to maintain their buy ratings. I mean, there's still about roughly 12 for facts that 23 holds though and 3 sell or sell equivalent ratings, with the average price tags right now standing at around 130, and so high end would be roughly 160, but there's still analysts that do have, I mean, price targets in the 90s. So the key takeaway is Wolf is a bit of an outlier here. The $162 target is definitely at the high end of the street and well above the average target. So the street is not showing this overwhelming strong conviction yet. Most are sitting in that neutral camp or waiting on the sidelines, it seems, to basically, I think, wait till Target can prove themselves a bit more. And this name, shockingly so to me, is up 37% on the year, so it's actually done quite well, but like, where did we come from, right? Like, we were basically still at beaten down levels, and now we're just trying to gain more consistency from Target.
I'm actually really surprised to hear that, but I mean, you bring up a good point. It was coming off of significant lows when you look at Target, but I'm surprised to hear it's outperforming like that. And also, you know, interesting to see whether we start to see more of the sell-side community start to make some adjustments to those price targets, with the average being the consensus right around kind of where we are right now, a little bit lower, and now seeing this one that is much higher, but also this destination once again. I know the company has been under pressure, but I have to say, at least from my shopping perspective, it never stopped being a destination. Yes, I saw everything everyone was highlighting, that it was, the stores weren't cleaned and it was hard to find stuff and they were out of stock of a lot of things. But it never stopped me from shopping there because of the convenience factor. So very interesting to see it's a destination once again, because I want to know who these people were that actually stopped going because of the messy store.
It never was a destination for me. It's a place I avoid like the plague, but that's just because I can't be trusted in a Target. It's my own spending habits that need to be reined back.
Target is a black hole. But another place that is a black hole, at least if you have a young child like I do, is Five Below. They got a downgrade today in that same note from Wolf Research, that where they picked Target as a top pick. Although my daughter Grace has been doing her best to keep up their numbers with her dumpling and Tappa Squishy purchases, but clearly not doing enough in the eyes of Wolf Research.
Okay, hilarious, because the only person I thought of was your daughter when I heard the term the viral squishy dumpling trend. That's a real term apparently, and so thankfully actually to know what these things are now, to have some reference. But that was of note. I mean, driving outsized comps. We also saw that contributed to low teens percentage points to their first quarter comp growth pile, on top of this high single-digit underlying demand. But they did say that this is still working structurally. They're still seeing trend-driven traffic, strong store execution, and social-driven merchandising that's helping to fuel their growth. And they acknowledge that, again, these underlying comps do remain positive in the high single-digit range, suggesting the core business is still strong, but did note the story has shifted from execution to trend timing, meaning that performance is now tied more to fads than fundamentals. And so that does set up now tough comparisons and potential comp contraction, with them modeling some of that near-term risk. And so Five being downgraded right now because it just seemed like, again, they're just highlighting that near-term comps are at risk, but not because the company is like fundamentally flawed by any means. But the debate now will quickly shift to when they can find this next trend to replace the dumplings. That who would have thought we'd ever be saying squishy dumplings on air, but I'll throw it in there again. And so I think that's fascinating. This interesting call on like this cyclicality of specifically Five Below. We so oftentimes bucket them with the dollar stores, but they're not really that type of store, and we're seeing it more and more with increased pricing. Their CEO highlighted the demand for that increased pricing, but it's just not the same type of business that is like mass scale, you know, more of a convenience store. It is truly more of these like viral trends, it seems.
And they do a good job keeping that stock coming, although I know they say they're flagging early signs that this dumpling trend is losing momentum, but I can assure you that in Grace's demographic, it is not, as far as I've seen with the collective pool that I have to study of her soon-to-be third-grade friends. But let's talk about Ross Stores, because they also got a downgrade today, but they did not get a price target adjustment. They're just adjusting the sentiment, but not the target price.
Yes, and I think an interesting call, because they did actually highlight still a lot of things to like off-price. That does remain still one of the strongest trends we're seeing in retail categories in a more pressured consumer environment, supported by this trade-down behavior. And they continue to benefit from this opportunistic buying, as well as excess inventory supply, and this more treasure hunt model that does drive repeat traffic as well as more resiliency. But so Ross is not necessarily dependent on like a single product cycle or a viral trend, but instead it's driven more by value, inventory available, and a macro trade down. And so while this is not necessarily like hugely of a focus in this call, it does then right now create a bit more of a execution driven off price story in the contrast with say like Five Below, increasing their dependence on more of these trend cycles. And so in the current framework, Ross is more macro and value driven than say Five Below being more trend and momentum driven. And so the note we did see was out of Wells that did actually downgrade shares to equal weight from overweight. Unchanged price target though of 245. But I think what's interesting again is that you see like Wolf's coverage today, because it was broadly retail. They're rotating away from more of these trend-dependent retails towards execution and consistency. Five Below seen more as that high beta, trend-sensitive, near-term comparable risk type of play, where Ross is lower beta, historically at least, structurally supported by off-price demand. And again, this desire to feel like you're getting a good deal from a consumer standpoint. But I mean, Ross has been one of these names that consistently has delivered pretty strong earnings, as well as like TJX, where they're operating in not really a commerce-driven world either. It's been interesting to see this specific niche of retail that has done surprisingly well.
I have a guest coming up in the show who has TJX as a pick, so stay tuned for that one. But Ross trading down more than 3% on that note. Five Below trading down a little less than 3%. Jenny, thanks for breaking all of that down for us. That's Jenny Horn, co-host of Next Gen Investing here on the network. Coming up, we're going to talk about retirement investment strategies and where target date funds might fit in your process. That's all next on Market on Close.
You know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews,
this
and
market's not
insight from analysts,
acting
founders,
a little
and
strange.
market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Market on Close. I'm Marley Caden. Nike trading lower today after Evercore ISI downgraded shares to inline from outperform. The firm also lowered its target on the athletic wear maker down to $46 from $57, noting multiple issues around its turnaround. Evercore cited Nike's unexpected new reset lower in the wholesale channel, its minimal needle-moving innovation in the pipeline into calendar 2027, and some near-term execution issues, including World Cup delivery issues. Let's check in with the athleisure sector, see how Nike is doing. They're down about 1.4%. Also seeing Under Armour lower on the session, Adidas lower as well, down 1.8%, but Lululemon having a nice you're noticing are what are you seeing and how they save and invest for retirement?
Yeah, thanks for having me. Yeah, I think we've just seen so much change, and especially in the last 20 years.
Yep, today's
particularly
theme's
after
been
the
on
2006
investing.
Pension Protection Act.
Investors.
We really saw new investment vehicles sort of take hold in the retirement space. So particularly things like target date funds, which became kind of the default investment option in 401k plans. And so we've just seen them take off, and really for a couple of reasons. One, I think first and foremost, they're professionally managed. They kind of do the heavy lifting for the investor. They do the asset allocation, the rebalancing, the professional management, all of those components. And so we've seen those types of funds grow to roughly $5 trillion in assets where they sit today. So big shift from several decades ago.
Big shift. I mean, as I was looking at some of the data and doing some research of my own on target date funds, I mean, they're offered in more than 90% of 401k plans now. And you mentioned that Pension Protection Act in 2006. That was a major catalyst for adoption. But has automatic enrollment really been one of the biggest retirement success stories in America? Has that really changed the game?
It has, and I think in particular the fact that target date funds are inherently diversified for you. So they're not asking the end investor to pick how much equity, how much fixed income, when to move into equity and fixed income, what type of equity, what type of fixed income. All of those nuanced decisions that can really be tricky if you're a new investor. And so that automatic enrollment has really seen investors go into something that is already diversified for them. And so outcomes in general have been, quite favorable, particularly relative to what were the prior default options before we saw target date funds really come online.
And when you look at retirement outcomes today versus before target date funds became more widespread, how have things improved? What has improved the most?
Yeah, I mean, we've seen I think more and more people become aware that they exist. I think one really interesting fact that we've seen and frankly been a little bit surprised about is just how prevalent they've become among younger investors. We're seeing younger investors more aware of investing in general, financial planning, and also target date funds. I think they're coming to a lot of the same conclusions like, hey, I want to do this, I want to be involved in the markets, I want to save for retirement, but I'm not sure I'm capable of figuring out or have the time to figure out all of these different asset allocation components. And so that's really been a surprise to see that come. I think other things too, we're seeing clients, for example, stay in their 401k plans longer. So whereas in the past they may have started to take withdrawals out once they've reached a certain retirement age, they're staying in plans longer. So sometimes that's meant a little bit higher equity exposure, for example. So all in all, a lot of positive outcomes when it's come to new participants and also the behavior of participants who've been in their plans for a long period of time.
And for viewers who may have a target date fund in their 401k and rarely think about it or perhaps didn't even know what it was before hearing this conversation, what exactly is the fund doing behind the scenes? How is it working for them?
Yeah, it's doing a lot. And I think sometimes there's a misperception that it's just kind of inkling forward, changing equity and fixed income by a certain percentage per year. But there's really a lot more going on behind the scenes. Investment managers who are running these funds are typically looking at all sorts of components, certainly the equity and fixed income mix, but what are capital markets expectations? Where are we in the interest rate cycle? Where are we with inflation expectations? So it's not just the equity and fixed income allocations, it's the subcomponents within it. And so that's really what the manager is looking at. Typically on a yearly basis, they're adjusting that allocation forward. So meaning as you progress towards retirement, it's typically getting more and more conservative. And it's doing it gradually, which is also helping to mitigate some of the issues around, let's say we have a very volatile, market environment or a sharp market decline. Because it's automatically shifting slowly over time, it helps to mitigate some of that potentially large loss that could happen if you made a large shift in the portfolio at one time and perhaps at the wrong time.
And Inga, when I was preparing for our chat today, I noticed one of the primary criticisms of target date funds is that some people view them as being too conservative. Is that a fair assessment? Is that an accurate narrative, or are they running that against the wrong benchmark?
Yeah, I think it's been a little bit of a, we've seen such a strong equity market in the last 15 years. And so I think, unfortunately, as an industry, we've started to measure retirement-focused strategies against broad benchmarks like the S&P 500 or even the subcomponents like the Magnificent Seven. And it's really important to take a step back and say, what is the point of a target date fund? It's to save for retirement. It's to allow investors to have sustainable withdrawals in retirement. And so they're not meant to be highly aggressive, at the more conservative part of the retirement, when you're just about to retire or in retirement. So they are a little bit more conservative, particularly at that point by design. That said, many investors have accounts outside of these plans. So maybe you can have those growthier, more aggressive investments outside of the target date fund. But again, it's important to remember what the point of the target date fund is, and that's to save for retirement and have those sustainable withdrawals.
And one of the trends that you highlighted is that you're seeing growing adoption among younger investors with these target date funds. Why do you think younger workers are gravitating towards them? Is the appeal that they have market exposure without having to actively manage it themselves? Why is that age shifting younger in terms of the attractiveness here?
Yeah, I think it's, again, encouraging that we see younger investors making their financial planning decisions now and wanting to be invested.
Till rate 464. Boy, AMC, if they'd have left that alone, that thing could have probably took off. But
fees falling, we're seeing technology improve across the board. Where do you see target date funds evolving over that time frame?
Good question.
Yeah, I think the adoption is still very much on the table. I mean, I think, again, that appeal of not having to manage that portfolio yourself is quite appealing.
It's 227.
And the fact that it evolves with you. So I think we do expect to see continued growth with target date funds. That growth, we have seen it historically over the last several years. So certainly expect that to continue. Fee compression, no question. We've seen fees come down substantially. Average fees for target date funds are less than 30 basis points, and even more so if it's a pure index strategy. And so I think between mass adoption and fees, those are going to be some of the ongoing themes that I think we'll see.
Inga, such a pleasure talking to you. Really appreciate you highlighting this for us. Inga Rockwald, Senior Portfolio Strategist over at Schwab Asset Management. Coming up next, we're going to discuss the top themes that are driving the market and the ways of investing in this current environment. Market on Close will be right back.
Muse at 104 was getting cheap. SPX 73.90s. If we break the 100, boom.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a...
Come on. We're breaking the 100. We got the VWAP on /ES. 73.90s. Break it. Finish the pattern. Break it. We want you to break it. What the heck? Here comes that 270. Oh. Oh. It's breaking it. It's breaking it. It's breaking it. Just under 73.82.50. I think you can do it. Yes.
Portfolio returns.
And as we look at this in this new market regime, we have to talk about the 60-40 portfolio because for years that was the classic. But stocks and bonds have not provided that same diversification that we have traditionally seen. So now we're in this debate of, is that dead? Where do you stand on that narrative? Has the framework fundamentally changed, or is it just temporarily changed?
I don't think it is temporary. I think we are due for a reboot. The 60-40 emerged in 1974 with the ERISA law as a prudent way to diversify, and it was actually a legal duty, a fiduciary duty. And they picked the 60-40 because these two asset classes are actually uncorrelated or lower correlated. If volatility is high, fixed income is sold as a caution, and vice versa. Since 2022, the correlation is positive. And so why is that? High inflation regime and low rates, so you are pretty much pari passu and impacting both sides of the equation. Why do we need a reboot? We need a reboot because you have to expand out of these 60-40. My advice is to say 50% equity is still fair, 30% fixed income, and 20% in the real assets. That's the right diversifier right now.
So if bonds are no longer the shock absorber that they once were, where do you look to absorb those shocks? Is that in real assets? Is that where you're looking?
So real assets serves two purposes. First, it's tied to inflation. Some of them think about commodities or listed infrastructure. But what I like the most about that is that the cash flows are linked to tangible activities. If you are building bridges, the toll that you're getting or cash flow generating. If you are owning a building, the rental yield is coming as well as an equation that is a cash flow positive. And so I like the fact that they are tied with inflation, so they serve as a hedge, but also provide a real economy exposure. And the infrastructure bill is showing that a lot of impact in terms of investment in that asset class. So my answer to you is yes, but, and the but you think about private equity and alternative as the other way to diversify.
And as you look at real assets as a category, which do you think offers the most compelling opportunity right now?
Yeah, so I will say infrastructure and then natural resources. The REITs have been there, they have been the hard time post-COVID, so I will not put that as my trade of the day, but I will say that listed infrastructures and natural resources are very attractive right now.
Got a little sending triangle set up,
And some
triple
of those, do you have
top.
any concerns about that being a cyclical trade?
So,
Yeah, shut up, Marley. 73, 78, 21. Still talking about
I
trash.
would say that the timing is right because we had a sell-off for growth, and then the refuge ended up being small and value, right? So both.
I was watching IWM and it did bounce off the 200 there. I didn't mention it, I don't think. Might have.
Education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time.
Welcome back to Market on Close. FedEx is set to report earnings after the close today. Analysts expecting adjusted earnings per share of $5.91 on revenue of more than $24 billion for the shipping giant. Investors will be watching FedEx's report for insight into the state of the economy, as transports can often be a leading indicator, while also looking for idiosyncratic impacts of the company's spin-off of its FedEx Freight, which also reports earnings later this week. Now it's time for Options Corner. Joining me, Rick Ducat, our lead market technician, to take a closer look at FedEx in advance of its report card after the close. And Rick, we've highlighted this as its first report since the spin-off of FedEx Freight, but as we look at FedEx more broadly against the market, how is it holding up?
Well, it seems to be doing pretty well. If, as you were saying, that this is a barometer for the overall health, this kind of shipping subsector, FedEx seems to be doing pretty darn well. 72.5% up during the past year versus the XLI, 23.7%. Not really the greatest benchmark, kind of a big category with a lot of different companies. But even when we stack up FedEx against some of the other names in the shipping industry, FedEx is at the top of the heap here in green. Meanwhile, its arch rival UPS is the laggard of the group, up only about 5% during the same period. Also looking at Amazon, Old Dominion Freight, XPO Logistics. So pretty interesting company here near those all-time highs. So we'll have to see how earnings comes out here in the post-market.
Yeah, we were pretty close to those all-time highs. The all-time high is about 345. We're not too far off that right now at 318. So as we look at the technical setup coming into this earnings event, what are you seeing?
So we did see a bit of a drop-off today, but it's one that so far seems to have taken us to familiar territory. This area right here represents our old relative lows that we saw near about 319. We're roughly around that area right now. We also could say that, well, we have broken through this upward sloping trend line in blue here. Downward sloping trend line in white is still in play at this time. Pretty common for things to slow down as we head into earnings, this known event risk situation. Traders can be loath to put on big new positions. They might want to be adjusting or taking profits, especially after we've seen this strong couple of quarters here in FedEx as well. So nonetheless, we can see that if we were to look a bit further to the downside, an old high here, subsequent lows after a breakdown, and then another high point here after the breakout reverse back to the downside. 309 stands out as another area of potential importance, as well as 290 based on a gap and some other lows after that. So if we were to think about our moving averages, in this case we have a bit of a confluence. We have our short-term 5-day weekly EMA in dark blue lining up very closely with our monthly teal 21-day EMA. Those come together right around 326, also quite close to our downward sloping trend line. So this gives us an inflection point to watch out for going forward for a possible breakout. Meanwhile, our 63-day quarterly EMA comes in right around 312, so that could be another supportive area to watch out for. RSI drifting lower. Green trend line has been broken. We are below the 50 midline. But as I said, it's really quite common for momentum to start to wane heading into earnings. I don't think I would make too terribly much of that, given that we are right on the verge of this quarterly report today. So when we look at volume profile next, we can see that we did have a smaller node here between about 326 to 335, suggesting there were some takers at these elevated levels. We also have kind of this larger clump of activity here between about 285 to 317. There are some nodes in that area, but that's the general
14 more minutes left
to the near-term downside.
And you said we saw momentum start to wane, which wasn't abnormal, but as far as the options action, what were you seeing there? Did we see an uptick because of the earnings event, or were things relatively calm here?
Yes, 3.54 is where our sizzle came in today, so more than 3.5 times the 5-day moving average of options volume, so a heavier day to be sure. We can see that our orange box here represents our weekly expiration coming up, so plus or minus a 7% move, so some potential for some movement here on the horizon. Meanwhile, our next monthly expiration here is our yellow box, July 17th, plus or minus 9.7%. Today's activity, about 24,500 options or so. 62% were puts. That's more unusual. Typically, you tend to see more calls, so it's always noteworthy, I think, when you see puts outpacing calls. Our June 26th expiration is the highest open interest, 31.7% of all open interest for this expiration weekly contract here. Biggest single trade I saw was a spread, a short strangle here. Only 3 days to expiration, expiring this week. Minus 250, 315 puts, and minus 250, 342.5 calls here. So coming together for about a $281 net credit is this very short-term short strangle.
And as you mentioned, we are under some pressure today for FedEx, down about 3%, trading just above $318. Thanks to Rick Ducat for breaking all of that down for us, our lead market technician here. Coming up, we've got overlooked stocks coming your way. George Tillis has his eye on Backblaze today. It's up more than 40% on a new deal with CoreWeave. He'll break down the news there and what you need to know. That's all next on Market on Close.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides. Live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com. Stay connected to the markets with Schwab Network.
Trying.
24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network.
I almost went in that one there for
on any device for free.
40 cents to 65. If I could have got it, you can got 80 maybe. Yeah, I could have got 80. Ah, darn, 115.
Incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab, they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab. Welcome back to Market on Close. I'm Marley Caden. It's time now for Overlooked Stocks. Cloud storage platform Backblaze is soaring today after announcing a long-term storage agreement with CoreWeave. Joining me to discuss is George Tillis, our senior markets correspondent. Backblaze having a monster day. They're up 43% on this deal with CoreWeave. So take us through this one, George, and why it's so significant.
Well, I think it's significant just because of the news associated with the business, the amount of the deal, as well as some of the prospective positive earnings that are going for the company as well. So I'll explain all that in a sec. But the company essentially, Backblaze, is a traditional cloud storage platform. They provide things like backup services for servers, data, and even personal computers. Typically, smaller and medium-sized businesses use their platform, and I think that's also why the CoreWeave deal is actually quite exceptional for the company. But they provide, high-performance infrastructure services and software services for APIs and, of course, application software backup for other businesses besides data centers and servers, but also the government. I think what's important about the business itself too is that what's nice is their platform helps optimize existing storage and, of course, rack servers. In other words, you don't necessarily need to tie in some vertically integrated software and, of course, hardware. Their business is essentially software agnostic. In other words, it's compatible across multiple types of different storage hardware. And so the deal today with CoreWeave is a multi-year agreement, and it's worth about $335 million. And it's basically providing CoreWeave a cost-effective storage capacity to support their managed storage infrastructure. But the deal, again, worth $335 million, is quite compelling considering that sales for last year were about $150 million. So this deal is essentially more than double their annualized sales, and that's why the stock is ramping up quite nicely today to the upside. If you look at the analyst, now Craig Hallian's got a $16 target, which is approximately the high on the street, with a mid-range around $9 and a low target of $6. One of the other things about the deal is it starts to follow suit with what the analysts are looking at as positive, which includes earnings. I did notice that if you look at the earnings estimates for this year, they're expected to be 12 cents for the full year. Now that's important because if you go back and look last year, for instance, they weren't fully adjusted profitable for the entire year, and that's switching this year, where they're expected to be fully profitable this year and next year. So that alone creates sort of a compelling financial story for this price inflection point. And this deal, from a top-line sales standpoint, I think helps solidify their business on a forward basis, and that's why the stock is up quite a bit today, aside from the overall market drought we're seeing.
Yeah, and you mentioned some of the analyst commentary around this. I happened upon a note from William Blair. I mean, they upgraded them to market perform from underperform just on this contract alone, saying that they say the win validates its positioning as a hard disk drive-based storage layer for AI infrastructure, and also said that the magnitude of the commitment, what you highlighted, how big it is, and the nature of that relationship demonstrates that Backblaze can play a pivotal role in this emerging neo-cloud architectures. Also saw 6 analysts have revised their earnings upward now for the upcoming period. So reinforcing this positive outlook here. I mean, again, it's an overlooked stock. It trades at, you know, a much lower price than some of these other names that we talk about more regularly here. But as you look at it going into earnings here, I mean, can it sustain this kind of momentum off of this one deal, George?
So that's a good question. First off,
Ooh.
the reason I brought these numbers is because this top line sales deal with CoreWeave is quite large relative to the trailing revenues. So this will move the revenue guidance higher, and the price is following suit with that. The other thing is, like I said, the earnings estimates were already looking positive. So it looks like, aside from this deal, they started to
95 to 25, just
in the underlying
boom.
business and the financials. I noticed that gross margins had actually
It's like
improved
that.
by about 10% or 1,000 basis points in the last versus last 5 years. The question is will it continue? Well, if you look at the 1-year chart, it's hitting some new highs. So there's a possibility what we're seeing today as a gap and go continuation. But there's also, if you look at a 5-year chart, potentially a restricted
Look like it hit a
barrier that
speed
goes
bump.
back to early
Got a flat tire.
of around $12.20. Now these are just rough numbers, but you'll see that that on a weekly chart on the 5-year basis, that it might find some resistance around 12 and a quarter. So for what it's worth, it could continue from here just based on the size of the deal and of course the compelling story behind it. Because the other thing about its business, which I find quite interesting, is that it's more agnostic based, because a lot of companies don't want and can't afford perhaps the large-scale needs that competitors provide. These competitors include Azure, Microsoft, Google, and Amazon. So for smaller players who want the non-vertical integrated component of those larger cloud providers,
Correct.
Companies like Backblaze provide those agnostic services.
Yeah, great day for Backblaze, though. New 52-week high, up 43%, trading at $11.62. We will have to wait until August to get their next report card in terms of their earnings. But, George, really appreciate you breaking all of that down and the significance of this deal for that company. That's George Tillis. We are coming up on the end of our session here. That means Alex Coffey will be joining us to break down today's action. And we'll also have earnings from FedEx. That's all coming up next on Market on Close.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time...
Less than a minute.
Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the...
There it goes. Well, not a bad day today. I got stuck in a couple trades. So I got in and out of them. But yes, all in all, not a bad day. That morning breakout was like done and gone. So I'm going to do something. I don't know if I'm too hungry or not. I might just sit here and drink my hot chocolate real fast and think about dinner. So we'll see you tomorrow. Have a good day.